total regulatory capture of the Treasury and other key financial agencies. Starting with former Citigroup CEO Robert Rubin, 3 of the last 4 Treasury secretaries under Democratic presidents Rubin, Larry Summers, and Jack Lew have had close Citigroup ties. The 4th, Tim Geithner, was offered the CEO position at Citigroup, but turned it down. President Obama also appointed from Citigroup the Federal Reserve's Vice Chairman Stanley Fischer, the U.S. Trade Representative, and his deputy at Treasury, Nathan Sheets, and Marissa Olago, responsible for much of the collapse as global head of compliance at Citigroup during 2003-08. These links to what Bill Black has called a criminogenic institution should serve as fatal resume blots. Instead, they evidently qualified such officials for the highest positions, where they set to work to dismantle Dodd-Frank regulations and to continue the support and subsidies for Citigroup, much as the Republican Treasury had supported Goldman Sachs. Rubin protégé Geithner had cultivated close ties to Citigroup. Its CEO Sandy Weil had offered Geithner the job of CEO after Charles Prince resigned in November 2007. Instead of functioning as the tough cop on the beat in regulating Citigroup, Geithner hobnobbed, holding 29 breakfasts, lunches, dinners, and other meetings with Citigroup executives, report Pam and Russ Martins. Rumor had it that Geithner was prepared to move up from his $400,000 a year salary at the New York Fed, but then was asked to become Treasury Secretary in the incoming Obama administration to use his influence to protect Citigroup and its fellow Wall Street institutions as the crisis unfolded. Baer describes how Rubin's protégé Geithner duly lobbied to defend it by using that familiar saw, "If we didn't support Citi, it could destabilize the system." As Baer summarized the pressure from Geithner and Paulson this way, "They would bring me in after they'd made their decision on what needed to be done, and without giving me any information they would say, 'You have to do this or the system will go down.' If I heard that once, I heard it 1,000 times. Citi is systemic, you have to do this." No analysis, no meaningful discussion. It was very frustrating. The bank had long been notorious for stretching the envelope, most of all when it merged with Travelers Insurance in 1998. Travelers had bought the brokerage firm Salomon Brothers the year before, so the merger created a conglomerate that was illegal under the Glass-Steagall Act, which separated retail deposit banking from investment banking. That acquisition made Glass-Steagall's nullification an urgent objective for Citibank. The Travelers merger created fierce pressure to revoke the signature 1933 Act of Franklin Roosevelt. Free market lobbyists pressured the Clinton administration to abolish the law Citigroup had blatantly violated. Rubin and Summers at Treasury led the deregulatory charge, with Alan Greenspan cheerleading at the Federal Reserve. In November 1999, Texas Republican Senator Phil Gramm, Iowa Republican Congressman Jim Leach and Virginia Republican Congressman Tom Bliley sponsored the Financial Services Modernization Act of 1999. It was an Orwellian euphemism to characterize disabling the New Deal as modernization. In the wake of the 1929-31 financial crisis, the idea of modernizing finance was to insulate retail consumer banking from Wall Street speculation. It took only a decade for the deregulation of mortgage credit and commercial lending to become tangled in a web of interbank speculation in casino derivatives. Citigroup became the most reckless banking conglomerate making the worst financial bets. Backed and applauded at the highest levels of government, the deregulatory environment created by reversing the array of New Deal controls proved the genesis of the 2008 crisis. Robert Rubin shepherded Wall Street's lobbying effort to deregulate banking and turn the financial system into a free-for-all to repeat the experience of the vast S&L frauds of the 1980s. Having used his post at Treasury to help legalize Citigroup's 1999 merger with Travelers, Rubin joined Citigroup to exploit the new deregulated freedom, turning the bank into a Democratic Party version of Charles Keating's Lincoln S&L. But whereas Keating was jailed, Rubin's Citigroup alumni were handed the reins of government, control of the Fed and exemption from prosecution for the mess they created at vast personal financial benefit to themselves. At Citigroup, CEO Rubin enjoyed the usual enormous salary boost that the Japanese call descent from heaven, over $10 million annually. using the conglomerate's deposits and borrowed funds to gamble on mortgage-backed securities, MBS, and collateralized debt obligations, CDOs. He lost heavily, but kept raising Citigroup's bets, evidently hoping to cover his losses by making a killing somewhere else at someone else's expense. This financial gaming dragged the bank's retail operations under, and matters got worse after 2007, when Rubin had handpicked Vikram Pandit, a hedge fund manager from Morgan Stanley, to become the new CEO. The selection of Pandit, Bear wrote, simply reaffirmed that Citi was no longer a bread-and-butter commercial bank. It had been hijacked by an investment banking culture that made profit through high-stakes betting on the direction of the markets, in contrast to traditional banking, which focused on making loans to people based on their ability to repay. As Citi's position worsened in 2008, Bear wanted the FDIC to at least consider the feasibility of putting Citibank, Citigroup's insured national bank subsidiary, through our bankruptcy-like receivership process. That would have enabled us to create a good bank/bad bank structure, leaving the bad assets in the bad bank, with losses absorbed by its shareholders and unsecured creditors. The FDIC agreed to guarantee Citigroup's issuance of new debt, providing it was used for lending to help stimulate the economy. But the FDIC examiners discovered that Citi was using the program to pay dividends to preferred shareholders, to support its securities dealer operations, and, through accounting tricks, to make it look as if funds raised through TLGP Temporary Liquidity Guarantee Program debt were actually raising capital for Citi's insured bank. Paulson and Gaithner worried that singling out Citi for special aid would cause a loss of faith in Wall Street as a whole. Deeming the bank systemically important, meaning that it owed so much to other institutions on swaps and financial gambles that these counterparties would lose heavily if Citi went under, they warned that panic would spread if depositors and correspondent banks recognized how its managers had created a largely empty shell that in many ways resembled AIG's financial house of cards. To cloak an emergency $25 billion loan to Citigroup, Paulson called the 9 leading Wall Street bankers together and informed them that each of their banks would have to accept a $25 billion loan from the Treasury whether they liked it or not, as part of the capital purchase program announced on October 14. This scheme was designed to make Citigroup's subsidy appear to be part of saving the system, by which they meant saving the deregulatory philosophy of Greenspan, Rubin, and Summers. Citigroup received hundreds of billions of dollars in bailout funding. Converting the Treasury's $25 billion loan into preferred stock alleviated its over-leveraged debt/equity ratio. The Treasury also extended the bank a $45 billion credit line, and gave it a guarantee for $300 billion in troubled assets, mainly junk mortgages whose market price had fallen by 60 to 80%. These actions saved the bank and its bondholders, but Citigroup stock plunged below $1 by March 2009 as its equity value fell by more than 90%, to just $20 billion compared to $244 billion in 2006. This was $5 billion less than the Treasury's TARP loan. The government had advanced more than the entire market value of the nation's most reckless and formerly largest bank. It is a sign of that bank's success in regulatory capture that public officials were able to resist taking control and running it in the public interest, or even changing its management, not to speak of making its counterparties and bondholders take a haircut for having enabled the bank's disastrous Rubinomics policy. Paulson's TARP plus the Treasury's decision to value Citigroup's assets at fictitiously high levels saved the bank's stockholders from being wiped out, setting the stage for its stock to more than quadruple from under $1 in early March to over $4 a share. It reverse split 110 in May 2011, so its 2014-15 value of $49 a share represents $4.90 in former terms. Troubled Bank of America also made enormous gains after being rescued from FDIC takeover, which would have been the real rescue. The Fed backs the Treasury's bailout much more heavily, stonewalling requests from Congress to find details about what junk mortgages and other toxic waste the Federal Reserve was accepting in exchange for its swaps. Chairman Bernanke claimed that politicians had no right to know how the public purse was being put at risk. Bloomberg filed a Freedom of Information Act request, and nearly 3 years later, in July 2011, the Government Accountability Office provided Senator Bernie Sanders with a report detailing $16 trillion of Fed loans and swaps. It revealed how the officers of Wall Street's leading banks who sat on the New York Federal Reserve Board gave their own firms the fortune of a century to tide them over. As widely rumored, Citigroup, Bank of America and the insurance conglomerate AIG were prominent among the financial institutions that turned over $2 trillion worth of toxic mortgage packages and illiquid junk bonds to the Fed in order to avoid having to taking a loss in the open market, where demand for such packages had dried up once the widespread corruption was recognized. Taking the money and running, bankers emptied out the proceeds of government loans by paying bondholders, large depositors, and counterparties in full. They even continued to pay dividends to stockholders. Wall Street barely missed a beat with their bonuses, Baer noted. Bank-friendly writers and lobbyists fostered a myth that the economy needed its investment banks to remain solvent to keep the economy functioning. But many former officials, including Baer, Sigtrups Neil Barofsky, and Reagan administration budget director David Stockman, rejected the claims that public guarantees for reckless bank loans was needed to protect insured depositors. Retail savings and checking accounts were never threatened by the bad gambles that banks made. But this myth had to be promoted in order for Paulson, Gaithner Bernanke and other bank protectors to persuade Congress to overrule Baer and make government, taxpayers, pay. Their aim was to save the banks from being nationalized, and to protect bankers from being prosecuted for fraud or reining in the exorbitant salaries and bonuses they had given themselves. No attempt was made to change the system that had led to the crash. If the traditional bank reforms had been preserved, then the FDIC would have closed down Citigroup and the government would have regulated the derivatives market. If the legal system had worked, chief executives of Wall Street's major investment banks and the crooked brokerage companies that promoted and sold liars' loans would have landed in jail. Instead, banks paid civil fees often covered by insurance policies without their executives being prosecuted. Instead of saving the system, the financial oligarchy made its move to end economic democracy. It saved its own future, not the existing status quo. In addition to Citigroup, the vast pyramid based on debt-leveraged bets on financial securities was rescued. To resume paying out salaries and bonuses each year, banks had to repay their TARP loans. They did this by borrowing from the Federal Reserve, which provided credit without the restrictions that TARP credit had entailed. Over and above the TARP's $700 billion, the Fed extended $2 trillion in cash-for-trash swaps, which expanded to $4 trillion under the quantitative easing program through 2014. Bailouts as a substitute for financial reform. The government could have created money to write down negative homeowner equity, as it had done with the banks. It could have bought bad mortgages at market prices and written down the debts more realistically, in keeping with the going rental value. Instead, the Treasury, Federal Reserve and Congress left the debts in place. They remained a barrier to hopes for upward mobility, which already had been stifled since the 1980s. Wealth became much more concentrated at the top of the pyramid as the economy at large limped along after 2008. This polarization is one of the distinguishing features of rentier and financial wealth as compared to industrial wealth. Under the pretense of restoring normalcy, the new financial oligarchy achieved a political coup to ensure payment of debts owed mainly to the banks, bondholders, and the 1% behind them. Most people hardly realized that Congress, the Treasury, and Federal Reserve had joined to endow bankers, bondholders and speculators with massive fortunes. The closest parallel is Alexander Hamilton's commitment to pay off the Continentals the paper money the American colonies fighting for their independence had used to pay militiamen and suppliers. The currency had lost nearly all its value, but was bought up by speculators, the vulture funds of their day. Treasury Secretary Hamilton paid them off in full, ostensibly to show the fiscal dependability of the new U.S. government. Speculators used their gains to buy up land in a follow-up series of frauds. Many of the nation's early fortunes thus were created at a stroke of the pen. The process was repeated in 2008. It was applauded most loudly by the coterie of pro-financial economists calling themselves the Hamilton Project, featuring leading Obama administration figures Geithner, Summers, Rubin, Peter Orszag, and also Roger Altman. Enriching a financial class rife with fraud and corrupt insider dealings inspired a long-standing mistrust of bankers and speculators at America's birth. This resentment inspired Andrew Jackson to close down the Bank of the United States in 1829, and to block creation of a real central bank for almost a century. But when the 2008 bailouts took bad debts onto the national balance sheet, the public accepted the giveaway reluctantly, but under the false impression that there was little alternative. For the Treasury, Federal Reserve, and much of Congress, Wall Street is the economy. At least it is the sector from where financial officials are drawn, and from which politicians derive their largest campaign contributions. This makes it easy to believe that giving banks special tax breaks and privileges to earn their way out of debt is synonymous with saving the economy. The reality is that bailouts are being done at the expense of business, consumers, and industry. The bailout was premised on the illusion that the financial problem was one of temporary illiquidity, not insolvency and the need for deep financial restructuring. Assuming that there was only a liquidity problem, the infusion of money into the banks, their bondholders, and uninsured depositors, was supposed to enable the banking system to start lending again, reinflating housing prices and presumably the economy. But there was almost no chance of this really happening, because the legacy of bad loans left banks with little ability or desire to undertake the new lending. So Washington's excuse for the TARP and the subsequent Treasury and Federal Reserve bailouts was based on deception. Banks did not start lending again to reinflate real estate prices, because the market already was fully loaned up. Lending also dried up to the small and medium-sized companies that were responsible for most growth in job creation over the preceding decade. In the consumer market, banks scaled back their credit card exposure, as well as other consumer loans and business loans after 2008. Refusal to admit the problem of insolvency and how debt deflation would aggravate bankruptcy and unemployment was a key factor for giving the banks the enormous subsidies they received since 2008, saving the claims of bondholders and large depositors on the economy. Erroneous economics thus proved highly purposeful and self-interested. Reviewing Geithner's fanciful memoir Stress Test, Paul Krugman pointed out, the Obama administration never really tried to push the envelope on either fiscal policy or debt relief. And Geithner's influence was probably an important reason for this caution. He believed that restoring that confidence by saving the banks was enough, that once financial stability was back the rest of the economy would take care of itself. And he was very wrong. Geithner was wrong because, Krugman continued, unlike a financial panic, a balance sheet recession can't be cured simply by restoring confidence. No matter how confident they may be feeling, debtors can't spend more if their creditors insist they cut back. But Geithner never mentions the almost equally classic analysis of debt deflation by the American economist Irving Fisher. All he did was give the banks what they wanted, using confidence as a kind of rhetorical incantation as if it were a force in itself. Keeping the pre-2008 buildup of debt in place suffocated the recovery. To make matters worse, the post-2008 debt deflation was reinforced by the Obama administration's fiscal deflation. It tried to pay for the bailouts cost by cutting Social Security, health care, and other programs, including federal revenue sharing with the state and cities. Adding insult to injury, Wall Street's defenders adopted a blame the victim strategy. It was as if poor blacks and Hispanics, the targets most prone to be stuck with predatory liars' loans at exploding interest rates, were cheating Wall Street sharpies rather than the other way around. Reckless borrowers were blamed, not reckless lenders, except for Fannie and Freddie for trying to promote a rise in home ownership to those who evidently could not afford it. The bailouts endowed a financial class that is evolving into an aristocracy, locking in its gains by shifting taxes off its wealth to push the U.S. and global economy into chronic austerity. This policy can only be defended by deception. Popular opinion in 2008 opposed subjecting 10 million American homeowners to foreclosure. They did not cause the crisis, after all, banks did. No politician could have won re-election by coming right out and promising public giveaways to Wall Street and labor market flexibility, breaking union power, reducing wages, and scaling back pensions. Meaningful democracy by informed voters had to be subverted. Using the 2008 financial crisis as their opportunity, financial elites set out to reverse the social democratic philosophy that had guided fiscal and monetary policy since 1945. 15 Wall Street's pretends to insure against the crash. Recognizing Gaithner's tsunami of deceit is actually central to recognizing what happened during the bailouts. Gaithner was hired to lie, steal, and cheat on behalf of bankers, and he did so. The Gaithner era is increasingly seen as a time of betrayal and lies, not just disagreements over ideas. Matt Stoller, the con artist wing of the Democratic Party, 2014. The transition from the Bush to the Obama administration was marked by an affair rife with conflict of interest between Treasury officials and Goldman Sachs. On the surface, the scandal appeared to be a public takeover of American International Group, AIG, whose London office had insured junk mortgage packages of Goldman and many European purchasers. Yet AIG's property and casualty insurance arms were not endangered, nor had it originated or packaged junk mortgages. The problem was that its financial products division, AIFP, in London insured them, for only a tiny premium. This trade in credit default swaps and related derivatives gave credence to the illusion that the mountain of bad mortgage debt could be carried without lenders or investors suffering a loss, simply by negotiating offsetting option and insurance contracts. In order to have worked, the insurance premiums would have had to be large enough to build up reserves to pay for the trillions of dollars in losses that resulted from overlending. Instead, risk models and ratings agencies said, no risk from junk mortgages. Wall Street denied that a bubble existed, and AIG pretended to insure against its collapse. The charade was made real by government intervention. But when Congress would not go beyond the TARP's $700 billion at the outset, the Fed and Treasury carved up AIG as a sacrificial lamb to save other financial giants from losses and to preserve the illusion that financial asset prices were justified and that debts ultimately could be paid. What was rescued was not AIG, but the illusion that Wall Street's deregulated financial system could make the economy richer rather than poorer. Tim Gaithner's guiding principle upon being promoted to Secretary of the Treasury was that the financial sectors, and hence, the 1%'s, outsized profits and bonuses were a necessary condition for broader economic recovery. The reality was that the Federal Reserve's $4 trillion in quantitative easing helped support the debt burden by reinflating asset prices. Coupled with debt deflation for the rest of the economy, this asset price inflation while keeping debt deflation for the 99% has polarized the distribution of wealth and net worth since 2008. That this policy was deliberate is reflected in the deception and secrecy that the Treasury and Federal Reserve tried to maintain to hide its insider dealings rank with conflict of interest, while the Obama administration used junk accounting to pretend that taxpayers gained. Fiction was piled upon fiction to deter recognition of how unworkable the financially gerrymandered economy had become. None of the players or public agencies in this episode are very attractive. In 2005, New York Attorney General Eliot Spitzer had forced AIG's board to depose its CEO, Morris Greenberg, for creating offshore entities and convoluted reinsurance transactions to avoid taxes. The Securities and Exchange Commission then brought civil charges. But the corrupt practices that took place in the wake of Greenberg's tenure proved much worse than tax dodges and misstated earnings. AIG's London office branched out into financial derivatives and credit default swaps, CDs, insuring liars' loans to which Wall Street institutions ascribed fictitiously high valuations and ratings agencies gave risk-free AAA appraisals. To put matters bluntly, AIG and its counterparties were negligent in trusting Wall Street's banks and underwriters, trusting the bond ratings agencies pasting AAA labels on junk, trusting the U.S. Federal Reserve and other public agencies or Britain's Financial Services Agency to ensure honest dealings and trusting neoliberal Larry Summers and investment bank capo di tutti capi Robert Rubin that financial markets were self-regulating and hence needed no intrusion from government that merely would raise the cost of doing business. The cost of this misplaced trust added up to trillions of dollars. But the dynamics of this sophisticated con game never seem to appear in academic models purporting to explain how economies actually work in today's financialized world. Wall Street financed the junk mortgage bubble largely by selling bad loan packages to European banks, whose money managers, like their U.S. counterparts, were under pressure to find the highest short-term yields available. The European banks bought U.S. mortgages, and compensated for the risk by purchasing credit default swaps, CDs. AIG London sold some 3/4 of its CDs to European counterparties. A.I.G.'s trading partners were not innocent victims here, blamed Senator Christopher J. Dodd, Democrat from Connecticut's insurance sector, presiding over a congressional hearing on the bailout. They were sophisticated investors who took enormous, irresponsible risks, pretending to protect themselves by taking out default insurance from AIG without daring to ask whether the company had enough reserves to cover the toxic financial waste it was insuring. Regulatory agencies from Britain to America turned a blind eye. That often happens when banks are making a lot of money quickly and capture the regulatory agencies by using political campaign contributions to influence policy or exploit the revolving door in which bank managers are loaned to government agencies to defend their companies and class. When the crash came, traditional policy would have let bad debts default, leaving the courts to decide who owed what. AIG probably would have gone bankrupt, and its default insurance payouts would have been scaled down to its ability to pay the defrauded pension funds, German Landesbanks, and other investors for the junk mortgages they had bought from Wall Street. Or perhaps AIG would have ridden the storm out and seen its derivative prices recover, as later occurred, while holding onto its cash by accusing Goldman of misrepresentation. Instead of letting this scenario unfold, the Treasury rushed to save appearances by making reality conform to Wall Street's selfing Enron-style junk mark-to-model accounting. It intervened to pay all parties, as if their financial claims were honest and viable. The assumption was that reviving the bubble would enable the economy to recover by borrowing enough more to keep paying the debt service mounting up. The story trickled out slowly, with the most sordid details revealed in the 2014 trial where Greenberg and his company, Star International, sued the U.S. government. Under oath, former Treasury Secretary Paulson and various Federal Reserve officials explained why they had felt it necessary to find a major source of bailout money for Wall Street above and beyond what politicians were willing to commit. There was not enough TARP funding to pay, without spurring a political revolt. So AIG had to be emptied out to save them, by taking it over and giving it a quick $85 billion, later augmented to $182 billion, to rescue the actual beneficiaries, Goldman Sachs and other big investment banks. Of course, AIG was by no means innocent. The prospect of more and more debtors taking on exponentially rising debt had created a huge market for writing default insurance contracts. AIG's London division won business by charging low fees for insuring many of the worst liars' loans being dumped onto US and European markets. No attempt was made to build up enough reserves to cover the risks being underwritten. But until the collapse arrived, this underpricing of insurance fees enabled AIG's London managers to pay themselves enormous salaries and bonuses, as if they were making money on realistic risk assessment. London as the global center for junk banking and fictitious insurance, AIG had already started writing credit default swaps through its London office by 1987. Finance Minister Gordon Brown's Light Touch Financial Services Authority was leading the global banking and insurance sector's race to the deregulatory bottom. This prompted many US and foreign banks to relocate to London. They were swiftly followed by Icelandic and Russian kleptocrats. By 2000, AIG's financial products division made credit default swaps its primary business, moving into the subprime area in 2003 and drawing up its first multi-sector CDs in 2004. While many counterparties purchased these contracts to hedge or minimize credit risk, AIG essentially took the other side, a one-way, long-term bet on the U.S. mortgage market, the Congressional Oversight Panel noted in its 2010 report, The AIG Rescue. Federal Reserve Chairman Ben Bernanke described the affiliate as an undercapitalized hedge fund, basically, that was attached to a large and stable insurance company. In the United States, local insurance regulatory agencies were largely vigilant in overseeing the safe investment of reserves. But AIG bought a small savings bank, which allowed it to choose as its national regulator the Irresponsible Office of Thrift Supervision, OTS. The Congressional Oversight Panel's report notes that the OTS, cynically dubbed the Office of Theft Supervision for its deregulatory attitude in the S&L crisis of the 1980s, lacked anywhere near the resources needed to supervise AIG's far-flung operations. It showed little interest in AIG's complex bets on prices for junk mortgages. The Congressional Oversight Panel traced AIG's failure to the refusal of Gaithner and his colleagues to regulate the web of proliferation of bad loans. Everyone involved in AIG's rescue had the mindset of either a banker or a banking regulator, meaning deregulator or indeed, active protector of the financial sector. It is unsurprising, then, that the American public remains convinced that the rescue was designed by Wall Street to help fellow Wall Streeters, with less emphasis given to protecting the public trust. Many regulatory agencies could have dealt with CDOs and CDSs on the grounds that they affected the solvency of banks, insurance companies, and their counterparties. But credit default swaps are exempted from state gaming laws, so they are not deemed to be gambling. They also are not considered securities, so they are not regulated by the Securities and Exchange Commission. Nor are they regarded to be normal insurance, and so are not overseen by insurance regulators. So no regulatory agency seemed appropriate, leaving checks and balance nowhere to be found. In any event, Wall Street lobbyists make sure that Congress only approves officials drawn from the sectors they are supposed to regulate, acting as lobbyists for their sector and even for their own firms. AIG's early default contracts contained clauses that protected its U.S. operations. But the company lost its AAA rating in March 2005. This meant that counterparties could contractually demand more collateral if the value of London's CDOs began to deteriorate. The division's head, Joseph Cassano, won more business, highly profitable for himself, by giving clients recourse to AIG as a whole. In effect, he bet the firm. This played out just as the FBI was warning of an unprecedented wave of mortgage fraud. Seeing mortgage underwriting standards erode, AIG stopped underwriting new contracts on subprime multi-sector CDOs. But many of the older contracts permitted portfolios to be updated as old loans matured, and clients substituted junk mortgages. Precisely because everyone knew that the mortgage market was riven with fraud, AIG raked in money. Fannie Mae and Freddie Mac saw their profits soar as well, turning financial fantasies into high salaries and bonuses. This easy money simply reflected the fact that default time had not yet arrived. While European financial institutions were buying mortgage packages simply to obtain slightly higher than normal interest, Goldman sought to make money from losses rather than gains. Hedge fund maven John Paulson became a billionaire by getting Goldman Sachs to help him set up a fund of especially fictitious mortgages, and taking out credit default insurance betting that they would crash. Goldman sold this toxic waste to its clients, and took out bets for billions of dollars with AIG London that a financial accident would happen. This sucker portfolio formed the basis for its demand that AIG pay more and more on an almost weekly basis as the mortgage market unraveled in 2008. The insurance industry's role in the fire sector, finance, insurance, and real estate, fire, have had a symbiotic relationship throughout history. Like Las Vegas casinos, insurance is all about arbitraging probability curves, from lifespans to accidents and other casualties. Lloyd's of London was founded in 1688 at dockside coffee shops largely to insure shipping. Life and casualty insurance emerged later in the 18th century, based on probability computations for longevity and property loss frequencies. Today's banks oblige mortgage borrowers and other debtors to insure their lives and property pledged as collateral against what they owe. Insurance companies invest their reserves in the funds they manage in the financial sector and real estate. It was to create a closer synergy along these fire sector lines, the euphemism for an opportunity for self-dealing, that Citicorp merged with Travelers Insurance in 1998, prompting its campaign to dismantle Glass-Steagall's banning of such vertical integration. This act was repealed in 1999, followed on December 21, 2000 by the Commodity Futures Modernization Act deregulating speculation in financial derivatives. One of the Clinton administration's final measures, this modernization turned high finance into speculation. Larry Summers, Tim Geithner, and Alan Greenspan deemed secrecy the antithesis to regulation to be necessary for the unfettered operation of free markets. But without a regulated open market there is no way of knowing what derivatives are worth, or how great a risk they may pose for banks that belong to conglomerates speculating in derivatives. This became clear by September 2008 when money managers ran for the exit and financial markets froze, recognizing the widespread fraud that had led to imbalance between what mortgage debtors owed, what insurance companies guaranteed to banks and speculators, and the economy's ability to pay. Nobody could know whether overnight loans to banks would be repaid. This was the inevitable result of regulators choosing not to regulate and markets using fictitious models free of reliable oversight. Insurance companies had developed a market for risk arbitrage along similar lines to those they had developed to insure against property and casualty losses. But within a decade the outbreak of collateralized debt obligations, CDOs, and credit default swaps, CDs, engulfed Wall Street's investment banks and AIG in webs of Black-Scholes probability curves. By ensuring this toxic financial waste, London's Financial Products Office thus did not make products in the classical sense of commodities produced by labor. It was a case of innovators combining Joseph Schumpeter's creative destruction with a race to the bottom. What was destroyed was the very idea of government regulation, along with the rule of law as formerly understood. Along with high finance in general, the insurance sector became an addendum to casino capitalist gambling, calculating standard deviation ratios for changes in interest rates, stock prices, and other financial variables. AIGFs in particular engaged in computerized modeling and speculation that had little to do with industrial and other capital investment, but with debt pyramiding on its rush to insolvency. AIG's London Financial Products Office charged unrealistically low fees to insure against the risk of non-payment on junk mortgages. This underpricing attracted business whose premiums meant higher bonuses for managers. AIG projected this revenue stream from CDOs as earnings, without accounting for the tens of billions of dollars in payouts soon to come. The investment banks that made or packaged junk mortgages claimed not to be at risk because they were purchasing default insurance. This options trading enabled all players to make short-term gains until the financial bolero abruptly stopped. The illusion that insurance can cope with systemic collapse paying off all those bets would have required hundreds of billions of dollars to be kept in reserve enough to equal the size of the meltdown. The magnitude of default was far beyond what AIG's London office had kept as reserves. Neither its counterparties nor the bond ratings agencies dared ask how much AIG was setting aside to back its default insurance policies. Judge Jed Rakoff called this willful ignorance, and likened it to criminal negligence. If not legally amounting to fraud, it was willfully reckless short-termism, evidently meant to enable all parties to claim plausible deniability. When the collapse occurred, optimistic illusion is the handmaiden to irresponsible greed. Unacknowledged prospective losses mean higher rewards for managers, until the business finally blows up. Former bank regulator Bill Black quoted Jamie Dimon of J.P. Morgan to explain the strategy that led AIGF's managers to attract enough business to pay themselves high salaries and bonuses. Low-quality revenue is easy to produce, particularly in financial services. Poorly underwritten loans represent income today and losses tomorrow. What made AIG systemically important was the degree to which its London operations were interwoven with Wall Street's gambles on junk mortgages. The Federal Reserve and Treasury claimed that an economy-wide meltdown was imminent if AIG were not bailed out by enough to pay Goldman Sachs and other banks 100 cents on the dollar for the financial weapons of mass destruction they had planted in the company's London affiliate. Paulson even said that unemployment could have risen to 25% if AIG had not been bailed out. The alternative was bankruptcy, he claimed, which would have buckled our financial system and wrought economic havoc. Wall Street's casino, the financial system, profits from the illusion that defaults can somehow be covered by private sector insurance. It is as if everyone can buy options to avoid the systemic risk that results from overlending. This illusion helped Wall Street shut its eyes to the looming convulsion that cost far more than any insurance company reserves ever would be able to pay for. Wall Street, the City of London and other financial centres had simply pretended to insure against the uninsurable. The reality is that insuring against any economy's overall debt overhead is impossible in principle, because in the end the debts cannot be paid. It is magical to believe that money can be lent out as debts grow exponentially without limit. The magic of compound interest leads in due course to debt deflation. The insurance obligation to make losers whole becomes unlimited, far beyond the ability of default swaps or other financial insurance to cover the losses that stemmed from deregulation and financial fraud. Any scheme to protect against debt defaults is bound to be underinsured in the absence of regulatory agencies to prevent fraud. The only way for these gambles to be paid in full when the insurance companies acting as bookies lack sufficient reserves is for the government to make up the gap. This is what happened in 2008. The Treasury and Fed picked up the tab, claiming that this was a necessary price to pay to restore stability. By stability they meant preserving the fiction that much of the economy was not insolvent. What was restored was largely a state of denial regarding the underlying cause of the financial products crisis, the mathematical models of efficient markets and Black-Scholes regression analysis that presumably could make the junk mortgage phenomenon risk-free at merely nominal cost. Ultimately, it took billions in public subsidies to save the fiction of the bankrupt deregulatory ideology. The crash was what Charles Perrow terms a normal accident in the sense of being built into the financial system's design. The bailout did not excise the cause of the inevitable accident by reversing the deregulation of banking and gambling. No banker was prosecuted, and the bailout terms did not even slow the explosion of financial salaries and bonuses. The government settled all the bets at 100 cents on the dollar when the insurance bookie went broke. There was no haircut, thanks to the availability of AIG's solvent operations that could be seized to pay the financial casino's winners. Bailing out Wall Street, not Main Street. It was all done under the distress sirens of imminent crisis. Every con man knows that the mark should not be given time to think things through. Speed is of the essence for high-pressure salesmanship. In September 2008, AIG's counterparties, headed by Goldman Sachs, wanted money fast. And they wanted to avoid taking a haircut. Under the circumstances, only the government had enough to pay. Politicians rammed the bailout through with minimal discussion by crying havoc, warning that the economy would collapse if the government did not come to the rescue. What seems so ironic in the AIG affair is that the pressure involved an insurance company. Anyone who has tried to collect on a claim knows that the tactic of any insurance company is to stall as long as they can to avoid having to pay in full. Wall Street Senator Charles Schumer, Democratic chairman of the Joint Economic Committee, wildly exaggerated when he warned, if AIG went down, it would affect Main Street more than Wall Street. AIG was, after all, one of the largest providers of property and other forms of insurance. But its basic vanilla insurance business didn't need bailing out. Well regulated by local state agencies, it never faced a threat of insolvency, because its local offices for property and life insurance were well backed. In contrast to the public relations pretense for making AIG the hapless recipient of the first bailout, the Treasury's payments to AIG's Wall Street counterparties had nothing to do with saving Main Street's retail life insurance and casualty policy holders. A Wall Street Journal editorial exposed the cover story as a sham. The Treasury and the New York Fed appear eager to show that continuing to pour money into AIG is about saving Main Street, not just Wall Street. But, state laws segregate the assets needed to protect policyholders within the highly regulated insurance subsidiaries at AIG, and if they were to fail, state guarantee funds exist to ensure claims are paid. New York State Superintendent of Insurance Eric Dinallo agreed, if AIG had gone bankrupt, state regulators would have seized the individual insurance companies. The reserves of those insurance companies would have been set aside to pay policyholders and thereby protected from AIG's creditors. AIG's U.S. consumer and basic business policies were fully backed under state insurance agencies, just as the plain vanilla operations of Citibank and other U.S. banks were protected by the FDIC. To be sure, AIG's insurance companies were so intertwined with each other and the parent company that policyholders would have been paid, but only after a potentially protracted delay. But when are insurance payouts not tardy? The threat that local AIG offices would run out of cash like ATM machines was a myth conjured up to pretend that the bailout was to protect normal policyholders, and only incidentally happened to pay Wall Street's high-rolling counterparties that had placed winning bets against AIG London. These gambling contracts had nothing to do with life insurance, property, or casualty insurance. They were legally subordinate to AIG's normal retail and commercial insurance business. Rating agencies started to downgrade CDOs in 2007, prompting AIG London to write down its credit default swap portfolio by $11.5 billion. Further declines during spring and summer of 2008 enabled Goldman to demand more payments, using its models, that is, its own dice, to value the junk mortgages it had insured. The Congressional Oversight Panel reports that a battle of the models ensued between AIG and its counterparties, resulting in protracted discussions on valuations and corresponding collateral obligations. As a pair of New York Times reporters summarized the conflict, the further mortgage securities prices fell, the greater were Goldman's profits. In its dispute with AIG, Goldman invariably argued that the securities in dispute were worth less than AIG estimated and in many cases, less than the prices at which other dealers valued the securities. The bank resisted, for example, letting third parties value the securities as its contracts with AIG required. And Goldman based some payment demands on lower-rated bonds that A.I.G's insurance did not even cover. Goldman's abrupt demand for payment triggered AIG's collapse. Goldman insisted that AIG cover the losses that Goldman's own models predicted the mortgages would suffer. If the Treasury had not taken over AIG and made it pay everything Goldman asked for, Goldman would not have made a killing. Without a bailout for AIG, payoffs on the junk mortgage gambles would have had to be scaled back all across the board. Some of the world's largest banks would not have been able to collect their winnings. The Treasury's solution to save everyone from loss, of their bonuses as well as their firm's net worth, was to give Goldman Sachs an immediate $13 billion for its credit default insurance contracts with AIG, while Société Générale and Deutsche Bank were handed another $12 billion each. There was no investigation of their claims, no haircut on any bill submitted. No wonder AIG's largest stockholder, Maurice Greenberg, brought a $25 billion lawsuit claiming that the Treasury had looted AIG to save Goldman and other firms from their own insolvency. AIG's lawyers could have insisted that Goldman exaggerated the valuation in its favor. Insurance companies contest claims all the time. But Paulson and Gaithner felt that Goldman and other big banks needed money quickly, being only days from insolvency. So on September 16, the day after Lehman failed, the Treasury created a windfall for favored Wall Street institutions by taking over AIG and making good on whatever its counterparties said might be owed, starting with the $85 billion that rapidly ballooned to $182 billion. This intervention enabled Wall Street's pretenses to come true, paying 16 investment banks every penny of what they claimed to be winning on their bets against AIG's London office on credit default swaps, as Chapter 17 will discuss. 16 bailing out of Goldman via AIG. It's as if the New York Fed used AIG as a front man to bail out big banks all over the world. Senator Charles Grassley, summarizing his Congressional Oversight Panel's findings, July 23, 2010. Much of the real motivation for seizing AIG was dragged out of witnesses in the lawsuit brought by Maurice Greenberg, whose Star International was AIG's largest shareholder. When the 6-week trial finally began in September 2014, former Treasury Secretary Hank Paulson acknowledged that popular anger at Wall Street's investment banks had made Congress unwilling to appropriate more than the $700 billion in TARP funding. The money to cover investment bank losses had to be found elsewhere. Next to Citigroup, Goldman seems to have been the most overstretched. But it managed to take charge of the bailout on all government levels. Former CEO Hank Paulson at Treasury said that he stood largely aside, but former Goldman CEO Stephen Friedman had become chairman of the New York Fed. Most directly, Paulson appointed Goldman board member Edward Liddy as AIG's CEO. Liddy had been a member of the board of Goldman Sachs since 2003 and head of its audit committee since 2007. He held a considerable amount of Goldman stock when the bailout took place, a conflict of interest blunting AIG's ability to resist Goldman's demands. Pressed by Goldman officers to accept the position, Liddy was appointed A.I.G's chief executive on September 18. But he remained a Goldman director until September 23, and he testified that he attended a Goldman board meeting by telephone on September 21. Later that evening, Mr. Liddy led an AIG board meeting where he urged the insurer's directors to accept the government's costly bailout. Costly to AIG, that is, it proved to be a bonanza for Goldman. Goldman said, in effect, "We need this much," and asked Gaithner at the New York Fed to make AIG pay it, and also to pay Merrill Lynch, Bank of America, Citigroup et.al. This prompted Rep. Stephen F. Lynch, a Democrat from Massachusetts, to respond to Treasury Secretary Gaithner at a congressional committee hearing on January 26, 2010, "I think the commitment to Goldman Sachs trumped the responsibility that our officials had to the American people." One reporter found only two possible explanations for the overly solicitous treatment of Goldman and the others. The first is that their own financial position was so precarious that accepting anything less than the billions they expected from AIG would have destabilized them, too. Which is to say, it really was a backdoor bailout of the banks, many of which, like Goldman, claimed they didn't need one. Alternatively, maybe Mr. Gaithner simply felt that Goldman and the like had a more legitimate claim to billions of dollars in funds than the taxpayers who were footing the bill. The asymmetry in how AIG was treated, compared to Goldman, Citigroup et.al. In contrast to TARP and special loans made to Citigroup, Fannie Mae, Freddie Mac, and Merrill Lynch at concessionary interest rates, the government charged AIG a high rate. Thomas C. Baxter Jr., the New York Fed's general counsel, described the 14% rate, and 8.5% on the credit line that AIG did not draw down, as loan sharky. The problem was not merely the high interest rate the government charged AIG for loans that it was forced to spend on paying Goldman and other counterparties. AIG had good reasons not to pay anywhere near what Goldman demanded, and even to contest payment on the grounds that Goldman misrepresented the junk mortgages it insured and then bet against. Early that year, other insurance companies had started to negotiate CDO write-downs with their counterparties. By the start of 2008, it was clear the insurance companies were running out of funds, so MBIA, AMBAC, and others then did what cash-strapped companies normally do: they settled with bondholders at a discount of between 10% and 60% of face value. But in contrast to the write-downs that other insurance firms obtained from their counterparties, the former Goldman officials in charge of AIG did not let it impose haircuts on its derivatives contracts with Goldman or other counterparties. Instead of bargaining with Wall Street bank over valuations of their securities, the Fed blocked AIG from doing so, by taking 79.9% of its stock. This was the only financial institution over which the government took actual control. Its preferred stock holdings in Citigroup did not involve voting rights, and hence did not enable it to interfere with policy. But the Fed's takeover of AIG was done on terms that committed the company not to question any payments made, not to contest the demands of Goldman or other counterparties to write down what it had to pay them, and not to file for bankruptcy. AIG was still solvent and current on its payments at the time of its takeover. Looking back at the fact that most junk mortgages were still being paid at a higher rate than pessimists had thought, New York Times journalist Gretchen Morgensen asked, why would those companies agree to pay out in full to a policyholder even if a fire had not occurred? Reviewing the details of the double standard imposed on AIG, Morgensen later suggested that perhaps the government saw an opportunity in the insurer's liquidity crisis, it could become an enormous taxpayer-funded piggy bank from which the government could funnel billions to a throng of teetering banks. Remember, taxpayers were growing increasingly outraged by bank rescues in fall 2008. The alternative was write-downs and lengthy court proceedings. A bankruptcy judge could invalidate, as a voidable preference, the transfer of collateral or money from AIG to Goldman if the transfer took place within 90 days of the filing of the bankruptcy petition. The last thing Wall Street firms wanted was to drive AIG bankrupt. A financial corpse would yield up much less than 100 cents on the dollar. The banks wanted to be paid in full, without the delay that bankruptcy proceedings entail. Chapter 11 of the U.S. Bankruptcy Code includes a cram-down provision that allows the courts to confirm a bankruptcy plan over the objection of some creditors, preventing a few recalcitrant parties from holding up the settlement. The mere threat of bankruptcy thus gives distressed debtors enormous leverage. Even first-year law students in Contracts 101 learn that there are numerous exceptions to the sanctity of contracts. One pension fund advisor noted, "Contracts are legally abrogated every day. A big part of our court system is given over to litigating disputes over the enforceability of various commercial contract provisions." But instead of using this threat of bankruptcy when the government interceded on behalf of Goldman and other counterparties, Tim Gaithner, Obama economic advisor Austin Goolsbee, and Larry Summers lamely express fake anger to the media about how much they hated to bail out AIG but felt obliged to defend the banks on the grounds of the pretended sanctity of contracts. The threat of deferring payment for years as tedious lawsuits ran their course could have saved AIG as much as half the ultimate $182 billion it was stuck with. This prospect would have encouraged its counterparties to acquiesce quickly for a smaller payment, as typically is done in such cases. By contrast, the Congressional Oversight Panel points out, the government chose not to exploit its negotiating leverage with respect to the counterparties. Once the government made clear that it was committed to the wholesale rescue of AIG, it lost the significant leverage it might have had over the thousands of AIG creditors. Indeed, the panel concluded, even after the Federal Reserve and Treasury had decided that a public rescue was the only choice, they still could have pursued options other than paying every creditor and every counterparty at 100 cents on the dollar. Arrangements in which different creditors accept varying degrees of loss are common in bankruptcy proceedings or other negotiations when a distressed company is involved, and in this case the government failed to use its significant negotiating leverage to extract such compromises. To have allowed AIG act in its own interest would have brought down the edifice of fictitious finance capital valuations, revealing the junk mortgage fraud. So AIG had to be stopped from defending itself and setting a legal precedent for writing down junk mortgage derivatives vis-a-vis Wall Street's financial behemoths. At one point in the trial, Greenberg's lawyer, Mr. Boyce, zeroed in on the idea of whether some banks that were insolvent were given more lenient loan terms than AIG. The plaintiffs argue that AIG at the time was solvent, but suffering from a liquidity crisis. The government disagrees. Using one of Mr. Gaithner's unpublished book interviews, he raised the subject of Citigroup and Bank of America, two banks that received bailouts in the crisis. Certainly Citi and B of A were insolvent, Mr. Gaithner had said during the book interview. The two men then engaged in a lengthy back and forth over the definition of insolvent. In the ordinary course of business, the well-established rules of bankruptcy would have led AIG's counterparties to write down their claims. Instead, rescuing AIG transformed Wall Street's risky derivative wagers into government-guaranteed obligations. It was as if the high-risk trade in default insurance derivatives deserved the same backstop as FDIC-insured savings deposits and checking accounts. The scare tactic was that the alternative was chaos. On the systemic level, this meant simply that some gamblers could not collect from what had been organized as a rigged game. Gaithner explained to President Obama that chaos meant asking Goldman and other banks to take haircuts on the killings they had made, and even further, not paying Wall Street speculators their expected bonuses and salaries in full. Covert maneuvering and influence peddling by Wall Street over the Fed and Treasury. When pressed by Congress and the financial media, the Federal Reserve and Treasury resisted identifying the recipients of the bailout money for months, citing confidentiality agreements. The panel notes that Goldman has declined to supply the panel with the identities of its own counterparties or any documentation with respect to those relationships or its own hedges on AIG. The fact that Goldman and the Fed fought so hard to keep matters secret suggests that they knew quite well that Goldman was not being honest in claiming that it had fully hedged its AIG exposure and thus would be unaffected by AIG bankruptcy. However, Bloomberg finally extracted the details of the deal by filing a Freedom of Information Act request. The documents it obtained revealed that the banks that bought the swaps from AIG are mostly the same firms that underwrote the CDOs in the first place. In some cases, banks also owned mortgage lenders, and they should be challenged to explain whether they gained any insider knowledge about the quality of the loans bundled into the CDOs. As one observer put matters, this is tantamount to building a house, planting a bomb in it, selling it to an unsuspecting buyer, and buying $20 billion worth of life insurance on the homeowner who you know is going to die. To get paid quickly on its own terms, Goldman went to Tim Geithner, president of the New York Federal Reserve. Nicknamed the bailouter-in-chief by Sheila Bair, Geithner selected Morgan Stanley as legal advisor to the New York Fed to come up with a solution that would restore normalcy, that is, save Goldman from loss, just as the TARP bailout was saving Citigroup. The way in which the Fed intervened in the AIG-Goldman squabble stood in sharp contrast to how it had strong-armed Wall Street banks to bail out long-term credit management in 1998. This was the principle of shared sacrifice that J.P. Morgan had organized in the wake of the 1907 crash. But the Congressional Oversight Panel pointed out that a decade of political maneuvering since 1998 had enabled Wall Street to commandeer the reins of U.S. regulatory agencies, the Federal Reserve and Treasury, which compelled the government to pay when the 2008 bubble burst. By providing a complete bailout that called for no shared sacrifice among AIG and its creditors, the Congressional Oversight Panel concluded, FRBNY and Treasury fundamentally changed the rules of America's financial marketplace with regard to how the world's largest banks, government policy, and whether or how economies cope with their bad debt overhead. By bailing out AIG and its counterparties, the federal government signaled that the entire derivatives market, which had been explicitly and completely deregulated by Congress through the Commodities Futures Modernization Act, would now benefit from the same government safety net provided to fully regulated financial products. In essence, the government distorted the marketplace by transforming highly risky derivative bets into fully guaranteed transactions, with the American taxpayer standing as guarantor. Still, the panel pointed out, until the afternoon of September 16, 2008, it was at least possible for the government to suggest that it would let AIG fail, as a means to demand concessions from AIG's counterparties. This would have been a credible threat given that the government had just let Lehman fail. Instead, Geithner was able to intervene thanks to a little-known clause in the Federal Reserve Act giving it authority to exercise incidental powers as shall be necessary to carry on the business of banking within the limitations prescribed by this act. As CD's spreads on AIG widened in November, the New York Fed set up a special set of funds, called Maiden Lane, a street near the New York Fed, to buy the mortgage-backed securities held by AIG's counterparties at 100 cents on the dollar, effectively cancelling out the CD's contracts. This was miles above what those assets could have fetched in the market at that time, if they could have been sold at all. This purchase paid off the gamblers, and stopped further AIG liability. Soon the price of these securities recovered, so AIG would not have ended up having to pay anywhere near as much to its counterparties as the Fed paid. Geithner's web of deception. Geithner claimed that as head of the New York Fed through 2008 he had no choice except to pay AIG's counterparties in full, because one bank was French. Hence, he pretended, he had to grant the U.S. banks all their winnings on the toxic waste bets they had insured with AIG. His excuse was that French law did not permit write-downs for its banks. Indeed, he said, it would be downright criminal for a French bank due to what, in reality, banks all around the world have been doing for many decades, taking a haircut on what they are owed. This is what the Brady bond write-downs of Latin American debts were all about in the 1980s. It is what Donald Trump has demanded of his banks often enough, and what companies under pressure normally do. The reason for Gaithner's French charade became apparent when it turned out that a chunk of the $11 billion paid to Société Générale was subsequently transferred to Goldman under a deal the two banks had struck when Goldman had packaged the junk mortgages selected by John Paulson. Paying Société Générale was really a way to pay Goldman. The press was full of reports of how unyielding the French were on insisting on no write-down until Sigdrupnil Barofsky issued his report describing how outrageous was the claim that U.S. law did not permit discrimination among claimants. Gaithner's position was that if the Federal Reserve had to pay the French bank Société Générale in full, it also would have had to pay Goldman Sachs and other U.S. financial casinos in full. But Gaithner pretended that his Federal Reserve Bank of New York had no choice but to avoid paying any bank less than 100%, because its own rules prevented it from discriminating and paying the French more than Goldman. All this soon was shown to be a lie, denied by the French. Barofsky accused Gaithner of telling the public that the French government had forcibly rejected any concessions from its banks. To find out for himself, he reports, I arranged for a Saturday afternoon call with the French regulator. She emphasized that she had not slammed the door on negotiations and had been more than ready to engage in them with the Fed so long as they were at a high level and universal. But she told us that the Fed officials had never seriously pursued that option, commenting that she had been surprised when the Fed officials had never called back. When I asked her about the Fed's assertion that it would be illegal under French law to agree to a discount, she said that the French government could have waived that restriction. But with no negotiations, no waiver. News leaked out that UBS, Union Bank of Switzerland, had quickly agreed to a 2% haircut, which would have amounted to $280 million for starters. Gaithner failed to report this offer, presumably telling UBS to sit tight while he insisted that the Treasury pay all the banks in full. His subordinate, the New York Fed General Counsel, Thomas Baxter, confirmed that the Fed staff had consulted with Gaithner about UBS's offer and that, instead of telling them to negotiate further, Gaithner had given the order to effectively pay the bank's full price for the bonds. We were stunned. Rather than pounce on UBS's apparent willingness to negotiate and use that as leverage with the others, he had simply folded the tent. Describing the stonewalling he received about all this, Barofsky writes that Gaithner, who by this time had moved up to Treasury, served Goldman and other banks by undercutting any chance of getting relief for the taxpayer by deciding that no one's concession would be accepted unless all of the banks agreed to the exact same percentage reductions. Gaithner emerged from this episode as something of a partner in crime for giving in so quickly when Goldman and other banksters reached for the moon. I've always wondered why none of A.I.G's counterparties didn't have to take any haircuts, remarked Sheila Bair upon leaving the FDIC. There's no reason in the world why those swap counterparties couldn't have taken a 10% haircut. There could have at least been a little pain for them. They didn't even engage in conversation about that. You know, Wall Street barely missed a beat with their bonuses. The bonus kerfuffle distracts attention from where the bailout money went. It is an indication of the extent to which the banking system and high finance had degenerated into grabitization that Gaithner whined that it would signal the end of capitalism not to keep paying bonuses and salaries to the bankers whose behavior had caused the crash. In his 2015 memoir Believer, My 40 Years in Politics, President Obama's campaign advisor David Axelrod reports that he was livid when he found out that Gaithner and Summers had quietly lobbied against an amendment to the stimulus that would have restricted the payment of bonuses at firms that received bailout funds. Those bonuses had become a huge political sore point for the administration, but the finance guys argued that retroactive steps to claw back the money would have violated existing contracts. This would be the end of capitalism as we know it, Gaithner told Axelrod. Law professor Bill Black explains how this one-sided idea of breaking contracts favored Wall Street against the economy and its long-term viability. Preventing banks that received bailouts from paying future bonuses is not clawing back bonuses. Clawing back bonuses means recovering bonuses that were improperly paid based on false accounting statements that massively overstated bank income. Neither of the practices I have described would have violated existing contracts. Even before Axelrod's revelation, the matter had come to a head regarding AIG's bonuses to the company's financial wreckers. On March 17, 2009, precisely half a year after the bailout, AIG announced that it would pay $165 million in retention awards, its euphemism for bonuses, to 400 employees. At its London office, total bonuses were said to possibly reach $450 million for the financial unit, and $1.2 billion for the entire company over the next 2 years. Although the $165 million in bonuses amounted to only 0.1% of AIG's $182 billion bailout, it afforded an opportunity to distract attention from the much larger giveaways to Wall Street bankers. Having voted for the AIG bailout as a senator, President Obama now tried to publicly distance himself. "I've asked Secretary Geithner to use that leverage and pursue every legal avenue to block these bonuses and make the American taxpayers whole." Larry Summers chimed in, "There are a lot of terrible things that have happened in the last 18 months, but what's happened at AIG is the most outrageous." As the Wall Street Journal editorialized over these crocodile tears, the Washington crowd wants to focus on bonuses because it aims public anger on private actors, not the political class. Since September 16, AIG has sent $120 billion in cash, collateral and other payouts to banks, municipal governments, and other derivative counterparties around the world. It's not capitalism, in which risk-takers suffer the consequences of bad decisions. Only the top-ranking too-big-to-fail banks were saved from the debt leveraging that plagued the rest of the economy. AIG's counterparties were liberated from losses, but homeowners suffered defaults, while cities and states faced abandonments and plunging tax revenues. Employees lost their jobs, normal investors lost, and taxpayers were stuck with the obligation to pay the Wall Street giants. President Obama capped the hypocrisy by asking Treasury Secretary Geithner to prepare an accounting charade to give the impression that the government actually made money on the deal. This contrived exercise served to distract attention from the fact that the Federal Reserve's maiden lane entity had paid 100% of the face value of CDOs that were selling on the open market at only half the price. Geithner's public relations calculation did not take into account such overpayments, tax giveaways, subsidies, and below-normal interest rates that financial analysts normally use to evaluate gains and losses. These multiple forms of giveaway broke more than a century's tradition for how governments are supposed to handle crises, prompting the Congressional Oversight Panel to conclude, the government's actions in rescuing AIG continue to have a poisonous effect on the marketplace. They reflected how the financial marketplace Wall Street had captured government regulatory agencies, disabled congressional oversight and neutered the law courts in order to make sure that no bank manager or CEO involved in the financial crisis would ever be jailed, fired, or even have his salary and bonuses clawed back. Geithner will appear repeatedly in the next few chapters, flying to Europe as well as around the United States to make sure that his Wall Street constituency would be paid at the economy's expense. Reviewing how his memoir Stress Test, 2014, sought to whitewash his behavior by depicting himself as a firefighter, constantly on call to extinguish a fresh blaze, Financial Times columnist John Kay found many things wrong with this analogy. The stuff Geithner used to douse the fires is not cold water but a stream of liberal credit, precisely what set the blaze alight in the first place. Better, perhaps, to limit access to matches and petrol, and to construct fire breaks. Perhaps the problem is one for the police as well as the fire service. Handcuffs might be as useful as the fire hose. The obvious question that government regulators sought to prevent the public from asking was why not nationalize the reckless banks whose entire net worth was less than the government's $25 billion TARP loan? Citigroup and Bank of America, and very nearly Goldman and other investment banks, were insolvent without the government giveaways. Taking over ownership and operating them as a public financial option would have enabled the government to fire the officers responsible for the bad, often crooked, loans, and recoup what they had paid themselves in salaries and bonuses on the deception that their management was making money, not losing it. After all, bank managers of such institutions did not provide productive management but just the opposite. They acted in a predatory way that poisoned the financial system with toxic waste. The government's failure to take ownership gave managers, stockholders, and bondholders a free lunch. Why did the government only move against AIG, and even then, not to stop rewarding its London financial managers, but to pay those of Goldman and other Wall Street institutions to preserve and subsidize the behavior that had caused the crisis? A New York Times editorial summed up the inequity at work regarding the corruption and insider dealing that emerged from Greenberg's lawsuit over the seizure of AIG to pay better connected bankers. Mr. Greenberg rests his claim partly on the fact that the government imposed tougher terms on AIG than on bailed-out banks. The government, for example, took a controlling equity stake in AIG, largely wiping out shareholders. In contrast, it left shareholders at bailed-out banks intact, even at arguably insolvent institutions like Bank of America and Citigroup. The injustice in that disparate treatment, however, is not that AIG was treated too harshly, but that the banks got off too easy. If the government had taken control of, say, Bank of America, taxpayers would have shared directly in its recovery. Instead, the subsequent gains flowed to shareholders who, but for the bailouts, would have been ruined. The government also took control over how the AIG bailout money was spent. The bank bailouts, in contrast, had virtually no strings attached. That harmed the public because there was no way for the government to force the banks to increase lending and help homeowners, even though officials had said that the bailouts would foster lending and foreclosure relief. It's certainly true that the government deserves criticism for how it spent the AIG bailout money. It funneled the money to the banks to make them whole on deals they had done with AIG, instead of requiring them to absorb some of the losses. But again, the real victim of the overly generous treatment of the banks is the American public. Fortunes were made by betting on the inability of debtors to pay and being able to collect via government bailouts to favored insiders. This money could have been created just as readily to save homeowners from default. But it was given to the banks, while letting them foreclose on mortgages gone bad at the very outset. The economy has not recovered except for the economy of the 1%. The next few chapters will trace how this bad debt dynamic is unfolding from the United States to the Eurozone. 17 Wall Street takes control and blocks debt write-downs. The President Obama chose his team, and when there was only so much time and so much money to go around, the President's team chose Wall Street. Elizabeth Warren, A Fighting Chance, 2014. Voters in modern democracies tend to support politicians who draw the most beautiful pictures of how a fair and prosperous economy would operate. The more clearly a candidate can vocalize popular desires for upward mobility, lower living costs and deterrence of fraud and greed, the more likely they are to be elected. As the quip attributed to George Burns, Groucho Marx, and others puts it, the secret of life is sincerity and fair dealing. If you can fake that, you've got it made. What voters wanted in the U.S. 2008 presidential election was a change away from multi-billion-dollar gifts to Wall Street and the Cheney-Bush foreign military adventures. Barack Obama presented himself as the hope and change candidate. In an atmosphere shaped largely by public anger at the bailouts, he and other Democrats spoke of writing down mortgages for underwater homeowners, rolling back bank salaries and bonuses, and re-empowering the regulatory agencies that the Reagan, Bush, and Clinton administrations had gutted. Congress had not written any of this into its TARP legislation or pressured government agencies to limit how banks could spend the giveaways they received. The hope was that this would change with a strong voter mandate that gave Democrats control of the House of Representatives and Senate as well as the presidency. The political path was open to enact far-reaching reforms. Obama quickly slammed the door shut. Although having run on a populist platform, his role was to deliver his Democratic Party's liberal constituency of urban labor, racial and ethnic minorities, environmentalists, and anti-war advocates to his campaign contributors. Over the past half-century, the Democratic Party's strategy has been to create a menu of promises in two columns. Column A reflects the hopes and changes that voters want. That is the platform on which the Democrats ran. Column B represent what the party's major contributors and lobbyists want. Obama won the election by verbalizing the hopes of the 99%, but did in practice what his campaign Backers from the 1% wanted. His language was populist, his policies oligarchic and aimed to prevent change. Adept at applying this about-face with grace and a smile, Obama named former investment banker Rahm Emanuel his chief of staff to stifle the party's left wing, and appointed Clinton's old Rubinomics gang to key policy positions, headed by Larry Summers as chief economic advisor, and Gaithner at Treasury to block bank regulation or debt write-downs. Instead of responding to public aspirations to appoint regulators of Wall Street, the top administrative bureaucracy was drawn largely from Goldman Sachs and Citigroup, excluding anybody as truly regulatory as the Bush administration's Sheila Bair or Neil Barofsky. Post-2008 economic policy became that of the campaign contributors who comprised the Wall Street-financed Democratic Leadership Council under Clinton. The continuity runs from the Clinton to Obama administrations via the economic policy of Summers and Jack Lew, another Rubin colleague. At the Justice Department, Eric Holder and Lanny Breuer blocked prosecution of bankers and pulled funding from FBI or Securities and Exchange Commission investigators of financial and corporate fraud. Obama's naming of a Wall Street-approved cabinet showed his intention to block the reforms that most voters backed and expected, headed by debt relief. What voters got after 2008 was a financialized deep state concentrating more wealth in Wall Street's hands, no follow-through on Obama's airy talk of raising the minimum wage, and a drive to reduce the federal budget deficit at the expense of Social Security and other New Deal economic programs instead of public spending to fuel recovery. Assigning financial policy to Gaithner to block debt relief, Obama left economic policy to the Treasury, assigning Secretary Gaithner the pro-bank role that Rubin had executed under Bill Clinton. Gaithner already had served Wall Street as president of the New York Federal Reserve, whose website describes its core mission as being in part to supervise and regulate financial institutions in the 2nd District centered in New York City. Gaithner promised his congressional questioners at his March 2009 confirmation hearings that he had refused to perform his designated task. First of all, I've never been a regulator. I'm not a regulator. What then was his job? Sheila Bair and Neil Barofsky have described his actions to circumvent public regulations, first at the New York Federal Reserve and then as Treasury Secretary, lying outrageously to defend Citigroup. Citigroup's chairman Robert Rubin had sponsored Gaithner to head the New York Fed, and had been grooming him to become Citigroup's CEO as George W. Bush's administration was ending. But rumor has it that Gaithner was asked to defer his descent from heaven into Wall Street's high-salary world in order to become Treasury Secretary and protect the banks, especially Citigroup, from what were feared to be congressional pressures to regulate it more in the public interest. Gaithner quickly set to work crafting an even more bank-friendly policy than his predecessor Paulson had done. Under Gaithner's direction, bailout funding was made unconditional rather than subject to regulatory tightening. No firing of management, or even a cutback in salaries and bonuses. No cleanup in shady mortgage practices. The MERS, Mortgage Electronic Registration Systems, scandal unfolded with zero government protection of homeowners against false bank documentation of just who owned the mortgages and how much was owed. Just how remarkable a feat this subversion of regulatory cleanup was is reflected in the fact that by April 2009, TARP Inspector General Barofsky had opened 20 criminal fraud investigations into the $700 billion program and its cash for trash dumping of junk mortgages on the Fed and Treasury. An early report sharply criticized the government for failing to hold financial institutions accountable for the money they were given. Charging that the plan carries significant fraud risks, the Inspector General's report pointed out that almost all of the risk in this new trillion-dollar plan is being borne by the taxpayers. The so-called private investors would be able to put up money they borrowed from the Fed through non-recourse loans, meaning if the toxic assets purchased proved too toxic and the scheme failed, the private investors could just walk away without repaying the Fed for those loans. The government is purchasing the most suspect of the bank's mortgage packages. Gaithner's undercutting of TARP showed that despite protests from Congress and the public, Wall Street could still get away with theft. Refusing to enforce reforms, Gaithner became bolder as he saw his actions backed by President Obama, Chief of Staff Emanuel and Democratic congressional leaders. Former IMF economist Simon Johnson observed that troubled banks usually are cleaned up as a condition of official assistance, either by being forced to make management changes or being forced to deal with their bad assets. This was the approach favored by Ms. Baer when she was at the FDIC. The idea that there was no alternative to Mr. Geithner's approach simply does not hold water. Obama's false promise to write down bad mortgages nowhere was Geithner's unconditional support for the banks more blatant than in his neutering of President Obama's promise to reduce the debts of underwater homeowners in the Home Affordable Mortgage Program, HAMP. When $50 billion in TARP funds were committed in 2009 to help homeowners through HAMP, Obama announced his intent to help up to 4 million struggling families stay in their homes through sustainable mortgage modifications. Hundreds of billions more were still available and could have been used by the White House and the Treasury Department to help support a massive reduction in mortgage debt. In fact, as Barofsky reports in his book Bailout, the conflicts of interest baked into the program would render it ineffective unless principal reduction was made mandatory. Geithner pretended that the losses that the banks might suffer on their first and second mortgages could push them into insolvency, requiring yet another round of TARP bailouts. Instead, he insisted that lenders be compensated for their losses on liar's loans. Supported by Geithner, the banks banded together against underwater homeowners. The message was clear, Barofsky concludes: no way, no how would Treasury require principal reduction, even when Treasury's analysis indicated it would be in the best interest of the owner, investor, or guarantor of the mortgage. President Obama permitted Geithner and the Treasury to block the HAMP, derailing hopes for a housing recovery by leaving it to the largely bank-owned mortgage servicers, and to Fannie and Freddie, to determine if such relief would be implemented. The effect was to leave the economy debt-ridden rather than writing down mortgages. A conflict of interest between banks and homeowners was inherent in the HAMP program. In addition to their first mortgage, many homeowners had taken out equity loans as a second, subordinated mortgage, that is, second in line to be paid in case of default. Often the same bank held both mortgages. Because first mortgages are the first in line to be repaid, secondary creditors bear the loss if a debtor defaults, which is why these second mortgages almost always bear a higher interest rate. Banks used government subsidies to write down first mortgages, for which the government reimbursed them, so that they could enable homeowners to continue paying their equity loans or other second mortgages in full. The banks thus were able to collect on liar's loans that were not subject to government reimbursement, thanks to the fact that the initial plan didn't require the banks to write down second liens they may have held, like home equity lines from borrowers whose original loans were modified. To dilute public support for writing down underwater mortgages, bankers and Geithner mounted a propaganda campaign to pit debtors against each other. Their divide-and-conquer ploy was to characterize homeowners with negative equity but who still had enough income to afford to pay for their mortgages as free riders. It would have paid for such individuals to walk away and buy a similar home at a lower price, leaving the banks holding the bad mortgage. But bank lobbyists and the Treasury tried to goad the homeowners into staying current on their payments, even when their mortgage debts were more than the home was worth. Warning about the moral hazard of irresponsible mortgage debtors getting a free ride, banks incited responsible borrowers to resent debtors who were offered relief for mortgages larger than the market price would cover. Baer accused Geithner of using the moral hazard argument in a one-sided way to buttress this double standard, saying that he didn't want to reward the behavior of those who knowingly got in over their heads. He had no such concern for the mega banks. Ultimately at issue, she concluded, was whether our financial system should be based on a paradigm of bailouts or on one of accountability. Geithner's opposition to debt write-downs shows that instead of seeking to create a viable financial balance, the Treasury promoted a one-sided financial grab by Wall Street, leaving the economy in a debt trap. Matters got much worse when banks saw that the Geithner-Obama program enabled them to make much more money by foreclosing, and running up fees and penalties, than by writing down debts. What sophisticated real estate investors do when in negative equity? The decline in real estate prices confronted heavily mortgaged homeowners with a choice. The economic option was to walk away from their property. This is called jingle mail, for the sound made by putting the keys to the house in an envelope and mailing or handing them back to the bank, returning the collateral pledged to back the loan. Owners who walk away from underwater property lose whatever they have put into their home, but at least free themselves from having to pay much more than it is worth. It pays to make a new start with a smaller debt or simply to rent. The ethic of walking away from underwater real estate deals is practiced more cynically by the wealthy. Wall Street investors call this strategic default. But mortgage bankers urge less affluent homeowners to take an uneconomic view of debt in terms of a personal ethic of responsibility, a moral obligation to pay debts. While manipulating the moral bias of homeowners to stay put and keep paying the banks for loans in excess of the home's still falling market price, the Mortgage Banking Association was walking away from its own underwater headquarters. It had bought the 10-story glass building in Washington, D.C. in 2007 with a $75 million mortgage. Like millions of American households, the Wall Street Journal noted, the association found itself stuck with real estate whose market value has plunged far below the amount it owed its lenders. The story is one of hilarious hypocrisy. Having put down only 5% of the purchase price, the trade group decided to strategically default on its mortgage when the property lost $34 million, 45%, in the declining market. The association rented offices 5 blocks away, announcing that continued ownership of the building, which was financed with $75 million of variable rate debt, would be economically imprudent. It ended up being sold for just $41.3 million. The association's CEO John Corson refused to confirm just how much money it saved by walking away from the property, but he urged homeowners to keep paying their loans even if that no longer seemed to be in their economic interest, because defaults hurt neighborhoods by lowering property values. What about the message they will send to their family and their kids and their friends? He asked. Evidently, corporate personhood is not subject to the ethic urged on homeowners not to walk away from underwater property but to forego their economic choice. The idea was for debtors to do as banks say, not as they do. The path not taken, debt revision for underwater homeowners. Bear described how Gaithner blocked the FDIC from taking over bad banks, keeping them under Treasury protection by crying havoc that a public takeover would crash the economy and ignite a depression. This drowned out the ability of public ownership to cope with what actually has pushed the economy into depression, keeping the debt overhead on the books, shifting toxic waste onto the government's balance sheet, and setting the groundwork to slash Social Security, health care, and other social spending. Instead of ending bailouts, Gaithner recruited administrators from the Fed who shared Chairman Greenspan's anti-regulatory views. Their deregulatory blueprint for reform gave him unilateral control to block real reform. For his part, Gaithner criticized his nemesis Senator Elizabeth Warren for allegedly not understanding the nature of fairness, claiming that the central paradox of financial crises is that what feels just and fair is the opposite of what's required for a just and fair outcome. He meant that what Wall Street claims to be fair is just the opposite of what the economy needs to recover. In his mind, what his Wall Street clientele required was a free hand in predatory lending and rent extraction, wealth creation rentier style. Warren was worried about the right things, he said, but she was better at impugning our choices as well as our integrity and our competence than identifying any feasible alternatives. Gaithner's job as Treasury Secretary was to ensure that there is no alternative. He was backed by President Obama, who in 2015 echoed Gaithner's condescending attack on Warren when she criticized the Trans-Pacific Partnership proposed dismantling of public regulation and tax policy. Gaithner's claim in his selfing memoir Stress Test, that he did not simply serve the large banks in the way he sought to resolve the debt problem, elicited a torrent of rebukes from officials who had dealt with him. Glenn Hubbard, former chairman of the Council of Economic Advisers in George W. Bush's administration, for instance, had joined with Columbia University professor and housing market expert Christopher Mayer to propose a plan for the incoming Obama administration late in 2008. Their proposal was to offer millions of Americans the ability to refinance their mortgages into lower-rate loans, by directing the giant government-controlled mortgage guarantors Fannie Mae and Freddie Mac to refinance the mortgages on their books into lower interest rate loans. The idea was to save Fannie and Freddie from having to write them off as bad loans, while reducing mortgages to affordable market levels. This would have freed more homeowner income to spend on the economy at large. After Gaithner's book came out, Hubbard told the news media that Gaithner opposed the plan in 2008 and again in 2011 when there was talk of reviving it. Tim Gaithner personally and actively opposed mortgage refinancing, constantly. The Wall Street Journal quoted his colleague Christopher Mayer as saying that it never seemed like Gaithner and the administration were ever working that hard to help stop foreclosures, and in fact that he never even tried. Along similar lines in spring 2009, Illinois Senator Dick Durbin had sought to change the bankruptcy code so that homeowners who were underwater could modify their mortgages during the bankruptcy process. Durbin's aim was to reverse the unanimous 1993 pro-bank Supreme Court decision blocking homeowners from using bankruptcy as a vehicle to write down their mortgages. The problem, however, was that Congress almost always has given favorable treatment to mortgage lenders rather than to debtors. It did so in 1978, using the excuse that more security for the banks, that is, less security for borrowers, would encourage the flow of capital into the home lending market. When bankruptcy reform passed the House and Durbin proposed in April 2009 to amend the bankruptcy law to permit mortgage write-downs, the financial services industry pulled out all the stops, arguing that a right of bankruptcy for a homeowner would increase the cost of home loans, undermine the sanctity of contracts and promote, of course, moral hazard. And Obama supported the banks. Prior to the presidential election he had said that he would back a change in the bankruptcy laws to make it easier for families to stay in their homes. But he changed his position when Gaithner opposed any such change, claiming, and repeating in stress test, that it would not be effective. Support resurfaced for the need to write down debts whether by bankruptcy or loan renegotiation with the publication of House of Debt by University of Chicago finance professors Amir Sufi and Atif Mian. Contra Gaithner, they argue, letting bankruptcy judges write down mortgages and providing an ambitious mortgage refinancing plan would have reduced foreclosures. For example, Gaithner could have pushed for a policy to give bankruptcy judges the ability to write down mortgage debt in a Chapter 13 bankruptcy mortgage cram down. He could also have put forth an ambitious plan to allow solvent underwater homeowners to refinance into lower interest rates. Gaithner objected that seeking such write-downs would have further stressed a crowded bankruptcy system. But in reality the threat of cram down would have induced more out-of-court renegotiation of mortgages. Joe Nocera of the New York Times cites an email from Baer pointing out that giving homeowners an opportunity to file for bankruptcy would prompt mortgage holders to renegotiate the debt to a level that could be paid. And Sufi blames the Obama administration's obsessive focus on saving banks that kept homeowners from being helped. Obama's advisors chose early on not to expend political capital forcing banks to forgive mortgage debt. The tragedy was that saving the banks will not save an economy if households are left drowning in a sea of debt. Gaithner turns the Home Affordable Mortgage Program, HAMP, into a fiasco, emphasizing that Congress intended HAMP to be an essential part of the TARP bank bailouts. Barofsky describes how Gaithner derailed the program, using demagogic ploys to stall reform, with no intention of following through on the public promises being made. Gaithner only wanted to bail out the banks, not the economy. By late 2009, it was becoming apparent that Treasury refused to hold the banks accountable for the abuses to which they subjected homeowners in the program. Less than 8% of the funds originally allocated in TARP for foreclosure relief has actually been spent. The Treasury had no intention of actually fixing the program, and Gaithner refused to penalize servicers who refused to comply with the program or, for that matter, with the law. Describing the cynicism behind the HAMP program's execution, Barofsky writes how Gaithner told him that the plan all along had been for the banks to foreclose, but to avoid throwing underwater homes onto the market all at once. To prevent property prices from collapsing, which would have slashed the value of mortgage claims that banks held on their books, the HAMP plan was simply to delay the process, by giving homeowners a false hope of having their mortgages written down. The most widely cited passage of bailout describes how Gaithner blurted out, "We estimate that They can handle 10 million foreclosures, over time, referring to the banks. This program will help foam the runway for them, by keeping the full flush of foreclosures from hitting the financial system all at the same time. Slowing the pace of foreclosures would avoid crashing the market. It also would give the largest and most troubled banks an opportunity to run up late fees and penalties against mortgaged homes. These fees were charged against the property's ultimate selling price, at the debtor's expense, while slowing the pace of distress sales and hence the decline in prices for the real estate that backed bank mortgages. Barofsky found that the Obama administration made no attempt to deliver on its preposterous claim that it would modify mortgages downward. It left the debts in place while foreclosures proceeded at a pace chosen by the banks. Responding to Gaithner's attacks and stress test, Barofsky let loose and called him the guy who was the architect of a financial crisis in one aspect, from his job at the Fed. He's the one who botched the bailout in ways that have caused the untold suffering of millions of people. When someone like that comes after you, it's almost a badge of honor. Behind Gaithner, of course, was Obama himself, quickly breaking his campaign promise to extend the bailouts of the banks to include rescuing underwater homeowners from the mortgage debts that remained in place as real estate prices plunged. That he cared more for Wall Street than for distressed homeowners was made clear by the Federal Reserve's move to save financial institutions holding underwater mortgage-backed securities, MBS, by buying $2 trillion of these bad debts from the banks. This money could have been used to save homeowners, and with them the neighborhoods being devastated by bank foreclosures, leaving taxes unpaid while empty houses fell into ruin. Obama's smoothness in misleading voters. One of the first books giving an intimate look inside the Obama administration, Ron Suskind's Confidence Men, reported that on March 27, just 2 months after taking office on January 20, 2009, the new president invited the executives of 13 leading Wall Street institutions to the White House. After listening to their arguments for why banks had to continue paying bonuses, ostensibly to get the best talent to manage their money, Obama told them, "Be careful how you make those statements, gentlemen. The public isn't buying that." He explained that only he could provide them with the political shield needed to forestall public pressure for reform, not to mention prosecution of financial fraud. "My administration is the only thing between you and the pitchforks." One leading banker attending the meeting told Suskind, "The sense of everyone after the meeting was relief. The president had us at a moment of real vulnerability. At that point, he could have ordered us to do just about anything and we would have rolled over. But he didn't. He mostly wanted to help us out, to quell the mob." As Suskind summarizes the result, which would shape the incoming administration's policy, Obama had them scared and ready to do almost anything he said. An hour later, they were upbeat, ready to fly home and commence business as usual. Obama smoothly marketed his policies defending Wall Street in his interview with Steve Kroft on CBS's 60 Minutes, broadcast on December 13, 2009. Shedding crocodile tears over the fact that bankers have not shown a lot of shame about their behavior and outsized remuneration, the president tried to gain sympathy by showing that he knew very well why voters are mad at the banks. "Well, let's see. You guys are drawing down $10, $20 million bonuses after America went through the worst economic year that it's gone through in decades, and you guys caused the problem. And we've got 10% unemployment." Voicing the feelings of most voters as if they were his own, he continued, "I did not run for office to be helping out a bunch of fat cat bankers on Wall Street. Nothing has been more frustrating to me this year than having to salvage a financial system at great expense to taxpayers that was caused in part by completely irresponsible actions on Wall Street." But as Barofsky pointed out, rather than being scaled down in proportion to their epic failures in risk management, compensation for the top 25 Wall Street firms in 2010 actually broke records at $135 billion. What Obama's administration did was precisely to help the fat cat bankers on Wall Street. The ones he had invited to the White House in March were his major campaign contributors, and his heart seemed to be with them. His interview shows that he knew just what he was doing when Gaithner and other officials bailed out Wall Street institutions too big to fail, there is a culture there that feels that it's always making good decisions, and if it's not, then it's somebody else's fault. And that has to change. And the only way to change it, obviously, because so far at least, I haven't seen a lot of shame on their part, is to make sure that we've got a regulatory system in place that prevents them from putting us in this kind of pickle again. On March 13, 2014, however, the Inspector General of the U.S. Department of Justice, DOJ, found that DOJ did not uniformly ensure that mortgage fraud was prioritized at a level commensurate with its public statements. For example, the Federal Bureau of Investigation, FBI, Criminal Investigative Division ranked mortgage fraud as the lowest criminal threat in its lowest crime category. Additionally, we found mortgage fraud to be a low priority, or not even listed as a priority, for the FBI field offices we visited. In addition, the IG reported, many Assistant United States Attorneys, AUSA, informed us about underreporting and misclassification of mortgage fraud cases. Matters ended even worse than Barofsky had suspected. When the dust had settled by 2015, 6 years after the program's inception, a report by the government's official monitor Christy L. Romero showed that only 887,001 borrowers had had their mortgage costs reduced. Instead of helping some 4 million borrowers get loan modifications, banks participating in the program have rejected 4 million borrowers' requests for help, or 72% of their applications, since the process began. The program was merely voluntary, and banks managed to lose the paperwork on applications or otherwise stalled. Citi Mortgage, a unit of Citibank, had the worst record, rejecting 87% of borrowers applying for a loan modification. JP Morgan Chase was almost as bad, with a denial rate of 84%. Romero's report criticized the Treasury for not making sure that homeowners were not wrongfully rejected. While Gaithner blocked the regulatory system from writing down debts, Attorney General Eric Holder blocked the Justice Department from making perpetrators pay for their excesses. Their mantra was that the economy needs bankers to resume lending so that borrowers can go deeper into debt, as if this really will create more jobs and restore prosperity. As President Obama put matters in his 60 Minutes interview, now that the system is stable, I think it is very important for us to get a system in place that prevents us from being lassoed to folks who are making bad decisions and benefiting from it. And what's most frustrating me right now is you've got these same banks who benefited from taxpayer assistance who are fighting tooth and nail with their lobbyists up on Wall Street or up on Capitol Hill fighting against financial regulatory reform. But the economy still is not stable, largely because President Obama appointed deregulators precisely to lasso the financial system to folks who are making bad decisions and benefiting from it. Like Margaret Thatcher in Britain, he claimed that there was no alternative to giving bankers everything they ask for. Obama was enabled to move to the right by Wall Street loudly proclaiming that he was hurting them, not helping them. Ron Suskind explained to Jon Stewart on Comedy Central why President Obama kept Tim Gaithner on as Treasury Secretary despite his refusal to draw up a plan to take over Citigroup as he was asked to do. Jon Stewart, we keep hearing that Wall Street guys hate Obama. And my sense is, why? They've had it as good as anybody in this country over these past 2.5 years, probably better. What's their beef, in this? Applause, Ron Suskind, it's interesting. I asked the same question. I talked to a senior Wall Street guy and said, what gives with this thing with Obama? You know, you're after him, he's anti-business. You know, God. He couldn't have done more. He basically opened the federal purse for you guys. He saved your skin. And he says, no. You see, of course he's not anti-business. But when we say he's anti-business he just ends up doing more for us. So we're going to keep saying it. The road to debt peonage. Bankers' product is debt. They promote the cover story that lending on easier terms, larger loans against income and property values, will widen the market for home ownership. There is no doubt that liar's loans, Fraudulent property appraisals and restrictions on debtors' access to bankruptcy relief enable more people to get the credit needed by homes. But to the extent that the economy-wide effect of such looser credit terms is to bid up real estate prices, home buyers are obliged to go even further into debt to obtain housing. Banks end up with the lion's share of real estate rental value, which is paid out as interest. Mortgage credit becomes predatory when it is not created with safeguards to keep loans within the reasonable ability of home buyers to pay. The old guideline was 25% of the borrower's income. Easy bank credit turns the security of home ownership into debt-ridden austerity and hence chronic financial insecurity. This is the situation into which the U.S. economy has been pushed today. A similar proliferation of real estate debt has forced Eurozone economies into debt deflation and austerity. On both continents, the cost of irresponsible lending is being borne by the borrowers, and behind them, taxpayers, not the lenders. Limiting the safety valves of bankruptcy and debt write-downs, there is no opportunity to bring bank loans in line with the ability to pay. What appears at first glance to be credit to enable people to buy homes thus becomes a lifetime claim on a widening swath of their earnings. That is the bank's marketing plan, to siphon off the benefits of rising wages and salaries as debt service, preventing this income from being used to raise living standards. Without jingle mail, banks will lend beyond the value of the collateral being pledged, intending to come after the debtor's overall income, and that of co-signers, as in the case of most student loans, and failing that, to make taxpayers pay for their losses. This public liability for bad bank loans is what wrecked Ireland and other Eurozone countries. The remaining chapters of this book describe the oligarchic strategy of bankers in what has become a class war against labor and the economy, using foreign debt pressure on governments to privatize and untax resource rent extraction. 1 Gretchen Morgensen, A Slack Lifeline for Drowning Homeowners, The New York Times, August 2, 2015. 18 From Democracy to Oligarchy. If we cannot change economic policy through elections, then elections are irrelevant and it is useless to vote. Georgos Katragalos, the administrative reform minister in the new Syriza government in Greece. We are living today in a transition period much like that of Athens c. 330 BC when Aristotle wrote his Politics. Seeing inequality widen as his city-state became an empire, he described how wealthy families tend to emerge within democracies to become a financial oligarchy. Book V of Politics traces how these oligarchies indebt a rising proportion of the population to themselves, creating hereditary estates on which to found aristocratic dynasties. In time, rivalries develop within the leading aristocratic families, and some decide to overthrow other elites of the old order by taking the multitude into their camp. In the 7th century BC, populist tyrants gained power in Corinth and other wealthy Greek cities by cancelling the debts, redistributing the land and driving the old ruling elites into exile. Democracy was introduced more peacefully by reformers in 6th century Athens. Solon banned debt bondage in 594, and Cleis thence locked in political democracy in 508. But an oligarchy emerged once again, to be followed by aristocracy, democracy, and so on in Aristotle's eternal political triangle. Destruction of democracy by the creditors and property owners who make up the 1% thus is not a new phenomenon. The leading Roman historians blamed the destruction of republican liberty on the rising power of creditors overpowering democracies. Using violence to block the reforms proposed by the Gracchi brothers in 133 BC, Senate leaders initiated a century of social war that ended in debt deflation and, in due course, serfdom. From Greece and Rome to today's world, the driving force in the transition from democracy to oligarchy has been the fight by creditors against debtors. From the United States to Europe, creditors are taking over government agencies to control public policy and the tax system to undermine debtor rights, privatize public property in their own hands, and impose the modern equivalent of debt serfdom. Gaining this degree of control in democracies requires winning voter approval. A deceptive mask of demagogy is created to depict government as costly and inherently corrupt, as if planning by the financial sector is more efficient and not even more corrupt, and as if government is not the only power able to check fire sector rentiers. The trickle-down economics of Ayn Rand and Friedrich Hayek is mobilized to persuade voters that a mixed public/private economy of checks and balances is the road to serfdom, so as to clear the path for a financial road to neo-feudal financialization of basic infrastructure, home ownership, education, health care, and retirement savings. In this way, the controls over state power are subtly maneuvered from democratic means to the demands of the oligarchs. The state will remain in financial hands until the power of oligarchs to control government fiscal and monetary policy is checked, along with their rhetorical deception as to how economies work. In the fiscal sphere, for instance, the wealthy 1% seek to avoid being taxed by appealing to all taxpayers to demand cuts, as if there is no distinction between earned and unearned income, between productive and predatory ways of gaining wealth, between gains for the 99% and those of the 1%. Bankers and elites accuse regulation and law enforcement as being incursions on personal freedom and free enterprise, and depict financial reform as deregulation, the opposite of what reform era meant a century ago. Financial strategists in nations subject to democratic ratification of policies face a challenge over how to get voters to elect governments that impose austerity, regressive tax policies and anti-debtor bankruptcy laws of the sort that authoritarian Third World oligarchies and military dictatorships imposed from the 1960s onward. Financial tacticians start by limiting the sphere over which democratic choice is allowed. Control over the executive branch of government is shifted to central banks and treasuries staffed by bank apparatchiks. The cover story for this regulatory capture is that central bank independence from partisan politics is a hallmark of democracy, as if making financial policy independent from oversight by elected legislators is democratic. Bankers trot out neoliberal professors to preach that only professionals drawn from the ranks of leading financial institutions, i.e., to act as their lobbyists, have the expertise needed to set monetary policy. This ideology denies that there is any such thing as careers in public service to check the potentially predatory behavior of high finance. The only entrance path to regulatory agencies is held to be the revolving door between the large financial institutions and government. Today's financial alliance with real estate and monopolies, the financial sector has not always opposed democracy. Chapter 4 has described how bankers supported democratic reform in 19th-century Britain, forming an alliance with industrial interests to extend voting rights to the population at large to roll back the landed interest. This aim of taxing and controlling rentier interests was a driving force of Europe's 1848 revolutions. The goal was to break the stranglehold of surviving post-feudal landlord interests that controlled governments and enacted protectionist agricultural tariffs such as Britain's Corn Laws, aiming at self-sufficiency rather than foreign trade. To profit from the burgeoning industrial prosperity, foreign trade, and its associated investment in railroads and canals, the liberal financial industrial program sought to free markets from these legacies of feudalism. Up to the outbreak of World War I in 1914, reformers in the leading industrial nations aimed to make economies more competitive by bringing prices in line with actual necessary production costs, by minimizing the rake-offs extracted by absentee landlords and monopolists. Today's financial sector and the 1% behind it has inverted this political program. It has joined in an alliance with real estate, natural resources, and monopolies. Instead of public investment in infrastructure to lower the costs of doing business, this fire sector alliance is hijacking governments to promote privatization and rent extraction. The free market has been redefined to mean freedom for the rentier class to create a tollbooth economy, not freedom from their predatory incursions to extract unearned income in today's new enclosure movement. Its advocates trumpet this not as class war, but as the end of history, as if it is inevitable and there is no alternative. The first incursion is made in the executive branch of government via central banks and treasuries. The strategy is to impose pro-creditor laws governing bankruptcy and foreclosure, regulation, and taxation of bank activities and property. Toward this end, finance capital now operates largely through supranational financial institutions. Staffed with Geithner-like clones in today's banalities of economic evil, the IMF and World Bank. Followed by the European Central Bank and European Commission, seek to impose austerity and privatization sell-offs while loading economies down with domestic and foreign debt that becomes today's main lever of control, claiming that all this will make economies richer and raise living standards. Populist politics in the service of Wall Street. The transition phase to oligarchy retains the political trappings of managed democracy. Throughout the world, the traditional left has become so neoliberalized, one may almost say Thatcherized, that its 19th-century origins are long forgotten in favor of today's postmodern focus on social and cultural issues. Economic policy is left to seemingly objective technocrats drawn from the right wing. Tony Blair's New Labour Party in Britain, the French Socialist Party under François Hollande, and Greece's PASOK Party behind George Papandreou did not propose economic or financial alternatives to the privatization, austerity, and tax shift off the FIRE sector onto labour. All saw their support plunge in the June 2014 Europarliament elections, when the only parties talking about economic issues were right-wing populists, with the exception of Syriza in Greece and Podemos in Spain. Since 2008, Obama has adopted a similar strategy of ethnic and cultural identity politics, remaining silent about his economic agenda to defend Wall Street against debt write-downs, and to deregulate finance, supporting the Proker-Barrett Trans-Pacific Partnership and its associated Trade and Services Agreement, TISA. Obama also cemented the groundwork to balance the budget by a neoliberal reform program of downsizing Social Security and Medicare to pave the way for their privatization. The Thatcher-Pinochet rhetoric of labor capitalism and worker ownership of the means of production, by stock ownership managed by Wall Street, was trotted out to urge employees to take responsibility for their retirement by placing their pension savings in the hands of money managers. This was the goal that George W. Bush had sought but failed to achieve in 2004 when the stock market faltered. A Republican president hardly could have succeeded in privatizing Social Security over a Democratic Congress. Only a Democratic president could mute such opposition, just as in Britain only the Labour Party could have silenced left-wing opposition to out-Thatcherizing the Conservatives by privatising the railroads and other transportation in the notoriously pro-financial public-private partnerships. The way in which Obama stacked his 2009 Federal Commission on Fiscal Responsibility and Reform revealed the policies his backers wanted to see rationalized to the public. To head the panel he appointed Clinton corporatist Erskine Bowles and former Republican Senator Alan Simpson. Bowles and Simpson defined fiscal responsibility as balancing the budget, without raising taxes on the wealthy, and reform as cutting back Social Security. The goal was to finally achieve Wall Street's dream of steering Social Security contributions into privatized accounts that money managers would invest to further financialize the economy, with an initial influx of funds to bid up stock market prices in a new bubble. When Obama's Bowles-Simpson Commission urged Social Security reform to balance the U.S. budget, they did not have the crude excuse that European politicians used: the Euro Treaty limits budget deficits to only 3% of GDP, as discussed in the next chapter. This constraint enables governments to blame the Constitution for blocking Keynesian expansion since 2009, as if austerity is a fact of nature instead of a tactic in class warfare. The assumption that no government spending can take the form of capital investment, and that all budget deficits are simply a deadweight drain on the economy, inverts the direction in which civilization has been traveling for thousands of years. There is no accounting offset for public investment as an asset, reducing the deficit from current spending. It is as if only the private sector has a balance sheet with assets and productive spending on it. The irony is that account-keeping and profit and loss statements were innovated in the temples and palaces of Mesopotamia some 5,000 years ago. European Central Bank and IMF credit is extended to governments only to give to banks, to lend to bid up real estate and asset prices and thus save themselves from losses on the overlending that is shrinking the economy. Austerity and privatization is built into the model and is applauded as lowering production costs, rationalizing labor and making economies competitive. All this requires an ideological bodyguard of junk economics. Public disdain is averted by pretending that the lobbyists are specialists and hence their economic class war is above politics. The U.S. presidency and foreign prime ministers now leave policy making to apparatchiks nominated by major campaign contributors. Nominal heads of state use their office as a bully pulpit to preach neoliberal economic ideology in the service of financial elites. A common tactic to sell anti-labor reforms, one should call them counter-reforms, is to blame the US and European budget deficits on populations aging and receiving more expensive health care, and on social programs benefiting low-income families rather than on the financial minority getting richer by shifting the tax burden onto labor to cause austerity leading to falling tax revenues and deeper budget deficits. Blame is placed on the victims, not their financial victimizers. Debt polarization likewise is depicted as a demographic problem, characterizing creditors as the elderly who have saved prudently for retirement, not the 1% who inherit fortunes without having to save wages from their own work. The polarization of wealth thus appears to be the result of objective natural causes, not partisan oligarchic politics. Indeed, as tax revenues fall in response to rising debt service and the tax burden shifts onto labor, along with higher rake-off of prices for privatized hitherto public services, financial lobbyists use fiscal deficits as an opportunity to call for auctioning off public infrastructure. Creditor leverage over public deficits, especially in foreign currency, is wielded to turn public roads into toll roads. Other public investments are financialized as similar toll booth opportunities. These privatizations increase the cost of living and doing business, making the economy higher cost even as it is being impoverished. That is how democracy devolves into neo-feudal oligarchy. To the financial sector, the most important privatization is that of money creation. The aim is for economies to become dependent on bank credit rather than government spending to provide the money and credit needed to grow. This dream was realized during Bill Clinton's administration, which ended the 1990s by running a budget surplus, that is, by taxing more out of the than spending into it. The money supply grew solely by expanding the economy's debt overhead, not by government money creation. Quantitative easing subsidizes asset price inflation for half a century after the 1930s. Deficit spending was viewed as a way for governments to revive economies in times of slowdown. Government money creation to finance deficits was viewed as increasing output and employment. And as full employment was approached, consumer prices and wages would increase in proportion to growth in the money supply. This tendency of government spending to raise prices encouraged bondholders and anti-labor interests to demand monetary tightness and high interest rates to keep wages from rising. Today's financial interests have made an about-face. They are all in favor of money creation by central banks as long as it is not for Keynesian spending on public projects that employ labor or otherwise increase the purchase of goods and services. This money creation was not counted as part of the federal budget deficit because it was treated as a quid pro quo, as if the Fed were merely providing short-term liquidity in exchange for a swap of sound long-term assets. It did not confront the solvency crisis when it pumped in good official money in, over, payment for the junk mortgage credit created by the banks. But this sleight of hand merely covered up the debt overhead problem. Providing liquidity to banks and stopping a run by depositors does nothing to resolve the debt burden. Without writing down debts, subsidizing the banks leaves the overhead in place to continue siphoning off so much income that more breaks will occur in the economy's chain of payments. A short-term solution of confidence does not solve the long-term problem that should be rattling confidence that an economy can truly recover without debt write-downs. The key principle in such situations is that debts that can't be paid, won't be paid. The Geithner-Obama administration pretended that the economy could carry them and pay them off, if only the banks were given enough to lend yet more money to the indebted economy. That was supposed to be what quantitative easing was all about. The new Wall Street-endorsed easy credit was not spent into the economy by paying for public services or investment in public infrastructure. It was not given to homeowners or used for debt relief. Instead, the Federal Reserve provided credit to Wall Street banks at near-zero interest rates under quantitative easing, QE. The excuse was that banks would turn around and lend out this money to revive the economy. Bank lending at interest was claimed to be more efficient than government spending by bureaucrats, as if all public spending was simply a deadweight loss. This deceptive logic has proved to be flat wrong and, in fact, a deliberate diversion from where bank credit actually goes and what it is spent on. The first financial fiction is that economies can extricate themselves from debt by borrowing yet more from banks, presumably to make new debt leveraged. Gains from rising asset prices being inflated by this credit. So we are plunged back in the bubble economy's game plan. The reality is that since 2008, banks have not lent out their bailout funds or their reserves at the Fed to put America back to work, pumping credit into domestic investment or consumer spending on goods and services. Wall Street has used the Fed's helicopter money drops mainly to speculate in foreign currencies and interest rate arbitrage. Banks have extended credit for derivatives gambles, takeover loans and other transactions in financial securities and assets. But they have pulled back their lines of credit to home buyers and credit card users, and to small and medium-sized businesses. Mortgage debt has been called in rather than increased, credit card debt has been scaled back, and small and medium-sized businesses have been unable to borrow more. The only category of lending that has spiked upwards is student loans. In contrast to the past century of economic models that treated capital investment as responsive to interest rates, the aim of today's QE to lower interest rates is not to make new tangible capital investment more profitable. It aims first and foremost to reinflate asset prices for the securities that banks hold and lend against. Secondarily, QE makes debt-financed corporate takeovers and raids more profitable, as well as stock buybacks. Such debt financing is the antithesis of new capital investment and employment. By trying to preserve wealth in the form of creditor claims held mainly by the 1% against the 99%, the Fed's QE policy actually makes new tangible investment relatively less remunerative than speculation. New hiring is not spurred. Low rates do subsidize the banks, but their lending and speculation is decoupled from tangible investment in the real economy of production and consumption. To make matters worse, today's low risk-free interest rates tempt pension funds to gamble in a desperate effort to make the returns needed to pay pensions without requiring larger employer contributions. They are gambling in the Wall Street casino, which always wins against its counterparties and customers. In economies plagued by debt-ridden austerity and tax favoritism for finance and rent extraction over labor and industry, low rates of interest fail to stimulate real investment. This dynamic results in what Keynes called a liquidity trap, where low interest rates fail to fuel new capital investment and employment. This scenario is plaguing the U.S. economy today, while Europe is engulfed even more deeply in debt deflation. Banks oppose solving the problem of debt deflation by writing down debts to free more income for spending on goods and services. They advocate reducing wages and scaling back pensions to squeeze out more and more income to pay exponentially rising debt service. Where is a viable left, and what should its program be? In autumn 2008, voters were up in arms against the bailouts to Wall Street on terms that shifted the losses from reckless lending, financial deregulation and outright fraud onto the government and therefore taxpayers. Yet they were powerless to deter Democratic and Republican leaders from supporting Wall Street and blocking debt write-downs. Likewise in Ireland, the government yielded to Eurozone demands that it turn reckless bank losses into heavy tax burden to weigh down the economy and drive many Irish to emigrate. Spain, Portugal, and Greece were all conquered democratically by high finance, taking on debt to the IMF and ECB to bail out government bondholders. Voter reaction finally erupted in Europe's May 2014 elections, which saw a stunning reaction against the ruling coalition of right and nominally left parties. New parties on the nationalist right and populist left emerged to redraw the electoral map. Paul Craig Roberts noted that the major media in the United States and Europe heavily demonized third parties, such as Nigel Farage's Independent Party, 1993, in the UK and Marie Le Pen's National Front Party, 1972, in France. The establishment is already at work explaining that these electoral victories along with Virginia Tea Party brats are due to their anti-immigration status. However, the main target of Farage and Le Pen is not immigrants but the relinquishing of authority to a European Union bureaucracy run for bankers and bondholders. Nationalists were offering almost the only available protest, as the left parties were still demoralized and almost embarrassed to campaign for economic resistance to the financial takeover of Europe. In contrast to Social Democratic and Labour parties a century ago, there is little political advocacy of public investment, taxing rentiers, or even restoring more progressive taxation of income and wealth in general. The resulting political vacuum has seen only right-wing parties protest against pro-creditor regimes. The U.S. reaction closest to that of Europe occurred in the June 2014 Virginia primary. David Bratt, a hitherto unknown and barely funded Tea Party candidate, unseated Republican congressional leader Eric Cantor. His message was explicitly anti-Wall Street, all the investment banks in New York and D.C. those guys should have gone to jail. Instead of going to jail, they went on Eric's Rolodex. Denouncing the conservative Republican Congress as much as Democrats for being in the pocket of Wall Street crooks and D.C. insiders, Brad accused the folks who caused the financial crisis of occupying prime positions in the Obama administration as well as the Republican leadership. The common denominator inflaming the anti-government passions of the Tea Party in the United States and the nationalist anti-Euro parties in Europe is outrage against governments that have been hijacked by bankers to impose financial austerity and reverse classical progressive taxation. The real solution is not the Tea Party's nihilistic reaction against government as such, but to mobilize its regulatory and tax politics, and legal system, to support economic growth and prosperity. Financial interests have secretly manufactured a faux oligarchic populism opposing taxation and regulation. Yet like Europe's nationalist parties, the Tea Party is capable of making a tactical left run around the traditional labor-based parties. Its success reflects the failure of traditionally left parties to put forth a sufficiently radical alternative. Debt deflation, austerity, and the crisis of democracy. Europe as well as America is now being obliged to pay down debts run up during the bubble years that peaked in 2008. Paying mortgage debts, student loans, credit card debt, corporate debt, state, local and federal government debt transfers income and increasingly, property to bankers and bondholders. This debt deflation stalls economic growth by shrinking spending on goods and services, and hence on new capital investment and employment. When the Japanese private sector began to deleverage in the early 1990s, Wolfgang Munchau noted in his Financial Times column, the government increased its debt to absorb the shock. But the Eurozone's fiscal compact imposes fiscal deflation on top of debt deflation. This will increase the political backlash. Even if deleveraging could work economically, which is not clear, it may not work politically. Voters will revolt against being subjected to debt deflation and austerity while the 1% monopolize the gains. The question is, how will the political resistance to the financial power grabs be manifested? Will popular frustration take the form of unfocused anti-government politics hijacked by the vested financial interests? Or, will the classical progressive reform movement reassert itself? The emerging financial oligarchy Wall Street's lobbyists have drafted a Trans-Pacific Partnership and its European counterpart whose terms the Obama administration has kept secret even from Congress. What is known is that these treaties would block governments from regulating the financial and corporate sectors to enact environmental protection and impose cleanup charges. The object is to remove policy from democratic choice by shifting control of government to a technocrat bureaucracy drawn from the financial and other rentier sectors and run by an army of Geithner lobbyists who will tell the public that there is no alternative to shifting tax policy and monetary power from elected governments to the IMF and the European Central Bank, Wall Street, and the City of London. Neoliberal politicians claim to feel the pain of indebted and unemployed voters, but say there is nothing they can do except to follow this advice to impose austerity and bail out the banks so that they will be able to lend more. The rising debt service and debt-inflated housing prices in the face of falling wages were ignored until the Occupy movement explained why the economy is stalling, deteriorating consumer demand as income is earmarked for debt service. It should not be surprising that an economy 70% dependent on consumer spending stalls when creditors, monopolists, and property owners extract tribute from indebted borrowers, renters, students and users of public infrastructure services. In effect, these groups are paying reparations for losing the financial and neo-class war that they didn't even realize was being waged. So we are brought back to the fact that in biological nature parasites produce an enzyme that sedates the host's perception that it is being taken over by the free luncher. In today's financialized economies, the enzyme consists of junk economics. The popular media distract attention from how it has been possible for the Federal Reserve to create what is now more than $4 trillion in quantitative easing without spurring price and wage inflation. Morally, why have the bank's large uninsured depositors, bondholders, and gambling counterparties been bailed out in a period of debt deflation for the rest of the economy? Why did the Fed not create this credit to pay off the debts? Why were the debts left in place, leading to foreclosures that destroyed entire neighborhoods while the largest banks were rescued to resume their extravagant bonuses and dividend payouts? Selling out voters to campaign contributors promoting pro-1% policies has led both major U.S. political parties to be distrusted by large swaths of the electorate. In view of how the Occupy Wall Street demonstrations won worldwide emulation by catalyzing awareness of how big money has corrupted our government and our economy, it seems remarkable that no Democratic or other would-be left coalition has sought to mobilize the widespread rejection of today's pro-bank policy. Advocacy of truly socialist policies might stun the Beltway class with its popularity, as Syriza has done in Greece, described in Chapter 24 below. The Tea Party, and libertarians with roots in the anarchist tradition, fail to realize that only a government strong enough to tax and regulate Wall Street can check today's financial and rentier power grab. Attacking big government without distinguishing between big oligarchy and a progressive-era mixed economy, what used to be called socialism, dilutes efforts to regulate and tax wealth, and ends up being manipulated to support the vested interests, Koch brothers style. Why hasn't a Syriza-type third party arisen in the United States? Why do labor unions, racial and ethnic minorities and taxpayers shy away from creating an alternative to the Democratic Party whose Wall Street Rubinomics wing has seized control? Why is no interest group focusing on financial reform to a degree that environmental protection, racial equality, or even gay rights have done? From the United States to Europe, the leading traditional parties are supporting yet more privatization, financialization, and rent-seeking. This abandonment of what used to be the progressive era's Great Awakening has enabled the financial oligarchy to undercut democratic politics, the courts, the tax system, and even the law. Yet no party has mobilized the righteous indignation that Occupy Wall Street liberated by expressing what most people felt, that the alternative to the 1% monopolizing wealth is debt write-downs and financial reform to create a public banking option. 19. Europe's self-imposed austerity. If there is a second meltdown, it probably will not come from some new panic over the sudden discovery of toxic assets. It will come from a political revolt against the retrenchment, austerity, and social destruction to which the crisis has led. That revolt probably will not originate in the United States. But it might come in Spain, Portugal, Ireland, Italy, or Greece. Especially from Greece. And it would not be a minute too soon. James K. Galbraith, the first great financial crisis has not ended, the international economy. Fall 2013. Fiscal austerity was written into the Eurozone's 1993 Maastricht criteria. A condition for governments adopting the euro currency was to limit budget deficits to only 3% of GDP, and overall government debt to 60% of GDP. This blocks the now 28-member Eurozone governments from reviving employment by public spending programs. The Eurozone consists of users of the euro, which is simply a currency like the dollar, not to be confused with the European Union. The Eurozone and euro therefore are lowercase, not proper nouns, reflecting also the continent's low self-esteem. Even more deflationary are the euro's monetary constraints. In contrast to the U.S. Federal Reserve's ability to create new money, the European Central Bank, ECB, was not set up to monetize government spending. Article 123 of the Lisbon Treaty, effective since December 2009, prevents it from lending directly to governments. The ECB only buys bonds from banks and other holders, not directly from governments. Leaving governments without a vehicle for their own money creation has plunged the Eurozone into much deeper unemployment and debt deflation than the United States has suffered. Yet the hard money constraint seems so technical that instead of denouncing it for crucifying the continent on a cross of privatized bank credit, Europe's major socialist parties from Tony Blair's New Labour in England to George Papandreou's PASOK in Greece have been neoliberalized and are leading the fight to impose monetary austerity and privatization. Scaling back public spending and privatizing infrastructure is neoliberalism's alternative to classical social democracy. Privatizing money creation and basic infrastructure is a revolutionary reversal of government's traditional role. Creating money was long assumed to be a public function, indeed a key criterion of qualifying as a nation-state. For thousands of years money was a creation of palaces, temples, and other public institutions. But bank lobbyists and anti-government ideologues designed the Eurozone in a way that deprives governments of a central bank able to do what the Bank of England and the US Federal Reserve were created to do: monetize deficit spending. The task of providing the economy's rising need for money and credit is left to bankers and bondholders. Privatizing credit and debt creation leads to debt deflation while at the same time adding financial carrying charges to the cost of living and doing business. Combined with fiscal deflation, limiting the size of government deficits and shifting taxes regressively off wealth onto consumers, this squeezes economies. This straitjacket is euphemized as the Stability and Growth Pact, an Orwellian label for imposing instability and stagnation. It is part of the EU Fiscal Compact that went into effect on January 1, 2013. The pact centralizes the power to oversee national budgets in the hands of the European Commission, the European Union's executive body. There is no provision to write down mortgages or other personal and business debts. Payment to bondholders, but not pension debts to labor, is enforced even when this pushes economies into depression and bankruptcy. Uninsured depositors, bondholders, and counterparties are to be paid in full, with interest, even in reckless banks, until Russian and other depositors in Cyprus banks were singled out to take a bail-in hit in 2013. Like the U.S. Treasury and Fed, the EC and ECB are controlled by the banking sector, whose war against government's role in the economy is aimed most of all against labor. Europe's Troika, the ECB, European Commission, EC, and the International Monetary Fund, IMF, deems double-digit unemployment, rising emigration, and distressed sales of public property to be a price worth paying to dismantle government's ability to create money, tax wealth and invest capital in public infrastructure. These neoliberal constraints are neoliberalism's alternative to classical social democracy, depicted as milestones on civilization's road to the end of history. Seeking to break labor union power, especially in the public sector, and depress wage levels, financial planners pretend that economies can work their way out of debt by internal devaluation, slashing wages and public spending, ostensibly to make economies more competitive and help their exports. Rising unemployment and emigration are held to redistribute labor where it is needed, that is, needed to prevent wages from rising in more rapidly growing economies. What ends up being exported is the most employable and skilled labor. Capital flees as well. Two of the major victims, Latvia and Ireland, are applauded as success stories along this road to debt serfdom, as if their tax shift onto labor and falling wages are not an economic death grip but pave the way for a future takeoff. The terms reform, streamlining and greater competitive efficiency are favorite neoliberal euphemisms for turning the EU constitution into a straitjacket to block recovery. All this is a far step from classical free markets. The political economy of industrial capitalism aimed to replace post-feudal monopolies, absentee landlordship, and banking with public ownership, or at least to fully tax rent extraction. Today's post-classical view is that all government spending and taxes are inefficient and inflationary. There is no recognition that providing public services at cost or freely will lower prices. Another fiscal element of this financial war is to applaud privatization sell-offs as being more efficient, despite the rising prices that economies must pay for essential services financed by interest-bearing debt. Prices for infrastructure services rise for privatized monopolies, which are allowed to incorporate the takeover interest charges into their rate base, while treating them as tax-deductible. These policies raise the cost of living and squeeze household budgets even as wage levels fall. The effect has been to leave Latvia and Ireland, as well as Greece, in an economic dead zone. These countries are being forced to relinquish control over government monetary policy and to relinquish public taxation or minimization of the economic rent from land, natural resources, and infrastructure monopolies, while tax revenue falls and labor has had to emigrate to find work in the creditor nations. Forcing taxpayers to pay for policies dictated by unelected financial bureaucrats. Political theorists define a state as having three paramount powers: to create money, levy taxes, and declare war. By depriving member governments of the ability to create their own money, the Eurozone's Lisbon and Maastricht treaties block countries and the Eurozone itself from monetizing their fiscal deficits. The Eurozone is thus repeating the creditor-oriented policy that led to debt deflation after Europe's Napoleonic Wars ended in 1815, and after America's Civil War ended in 1865. First Britain and then the United States rolled back the price of gold, and hence of commodities and labor, by running budget surpluses to suck money and income out of the economy. It is the same deflationary ideology that led Germany to try to pay unpayably high reparations to the Allies, who in turn imposed austerity on themselves by trying to pay their arms debts to the United States after World War I. Such austerity is the creditor's idea of a well-run economy. Prices and wages fall, increasing the difficulty of paying back debts taken on at the higher old prices. Unemployment suppresses wages, leading to defaults that transfer property to creditors. When bankers depict this debt and price deflation as stability, they simply mean increasing their power over labor and industry. What is remarkable is that today's debt deflation is occurring without a war having taken place. This time the most problematic debts are private, owed by home buyers and businesses. Public debts stem increasingly from tax cuts on property and wealth, and in Ireland, from taking bad bank debts onto the public balance sheet. Ireland's real estate bubble, economic miracle, the ECB's prime directive mirrors that of the U.S. Treasury under Paulson and Gaithner since 2008. Governments are to take full liability for paying uninsured bank depositors and bondholders, even when high interest rates are paid by banks engaging in reckless lending and insider dealing. Next to Iceland's three notorious banks that collapsed in 2008, Landsbanki with its IceSave affiliate, Glitnir, and Kaupthing, the two most reckless European banks were the Anglo-Irish Bank and the Royal Bank of Scotland. All these banks attracted mainly foreign hot money unconcerned with risk. ECB President Jean-Claude Trichet visited Ireland's central bank in May 2004 and praised its Celtic Tiger takeoff, 1994 to 2007. The process of transformation that Ireland began over 4 decades ago has become a model for the millions of new citizens of the European Union. Ireland's economic miracle, the financial sector's euphemism for a bubble, combined a race to the fiscal bottom with an absence of bank regulation. The country's low 12.5% corporate income tax attracted high-profit U.S. firms such as Google, Facebook, Twitter and Yahoo to make Ireland their global headquarters to avoid worldwide taxes. Irish banks increased their borrowing from foreign depositors and bondholders from €15 billion in 2004 to €110 billion in 2008. The vast inflow was squandered to fuel a real estate bubble that inflated property prices fivefold by 2007. A remarkably high 87% of Irish families bought homes on credit, leaving few people to buy the new luxurious mansions being built by developers without much concern for actually finding buyers. Most of the bank loans had no foundation in realistic market valuations. By far the most heedless loans were made by Anglo-Irish Bank. By no stretch of the imagination were Anglo-Irish's madcap lending practices systemic. It was not a regular bank serving the overall economy, but a financial operation advertising for large wholesale deposits, mainly from non-Irish investors, and lending them to large borrowers, especially to the bank's owners to buy its stock, bidding up its price much as Iceland's banks had done. This self-financing is an age-old fraud scheme, and most countries ban it. But like Iceland and other countries whose light touch permitted bad banks to end up crashing the economy, Ireland had no real bank regulators. It relied on the advice of its central bank. And the advice of central bankers is the same everywhere: Don't interfere with lending, and make sure that all creditors get paid in full, even speculators. That is how financial free markets preserve confidence. It ends up meaning bailouts. Bad lending and fraud crash the banks. The property bubble burst when new deposit inflows and hence, bank lending stopped in 2008. Seeing housing prices begin to plunge, large depositors started to withdraw their funds from Irish banks. Interest rates rose sharply as bondholders anticipated that the government might leave bad debts to be settled between reckless banks and risk-taking speculators. That would have been the most logical thing to do, after all. The bank run prompted the ECB to make the same misrepresentation to Ireland that the US Treasury was making at home. It insisted that the problem was only one of temporary illiquidity, as if banks' loans were sound and fully backed by the value of collateral. The real problem was insolvency from junk mortgages and insider deals to bank owners. The collateral ended up being mainly empty or half-built houses. Crooked bankers understate their losses, and international financial institutions, such as the ECB, back their overly optimistic promises that the problem is minimal, easily handled and only temporary. This is the financial sector's chronic cloud of illusion, a failure to distinguish between a liquidity problem and underlying insolvency. Blind to this distinction, Ireland's government took the ECB's advice to deter a run on the banks by providing an unlimited guarantee to uninsured large depositors and bondholders that it would stand behind the banks and pay the full high-risk, high-interest rates promised. Most of these large depositors were foreign, mainly from Britain. They played the extractive role that British landlords had played in the 19th century. Ireland had a long tradition of fighting landlords, from the Catholic Association of the 1820s to the Land League of the 1880s, and Sinn Féin that won independence from England in 1922. But its political leaders surrendered to European credit lords without a fight. Like Iceland's banks, those of Ireland were far too big to rescue without bankrupting the country. Ireland's 6 largest banks claimed that their overall losses were merely €4 billion. Anglo-Irish banks officers upped their early estimate, but still lied when they asserted that they had only lost €7 billion. The government became an accomplice, soon punished by voters, by accepting this pretense and yielding to ECB advice to take full liability for paying large depositors and bondholders. On January 20, 2009, Ireland took Anglo-Irish onto its balance sheet as public liability. The bank's officers were fired, but they just laughed when the government asked them to please forego the lucrative golden parachutes they gave themselves on their way out. There was no Irish deposit insurance agency to bail out large depositors, and indeed no legal obligation to do so. Ireland could have let its banks default, wiping out the deposits or loans invested in bad loans. But as the extent of bad bank lending became more obvious and defaults seemed likely by November 2010, the ECB and IMF arranged a €100 billion loan to the Irish government, claiming that this was necessary to avoid financial contagion throughout the Eurozone. Gaithner nudges Ireland's 2010 capitulation to the ECB. According to the now classic accounting of Dublin economics professor Morgan Kelly, Tim Gaithner played an intrusive role in pressuring Ireland to capitulate to the ECB, the IMF, which believes that lenders should pay for their stupidity before it has to reach into its pocket, presented the Irish with a plan to haircut €30 billion of unguaranteed bonds by 2/3 on average. Finance Minister Brian Lenihan was overjoyed, according to a source who was there, telling the IMF team, "You are Ireland's salvation." The deal was torpedoed from an unexpected direction. At a conference call with the G7 finance ministers, the haircut was vetoed by U.S. Treasury Secretary Timothy Gaithner, who believes that bankers take priority over taxpayers. The only one to speak up for the Irish was UK Chancellor George Osborne, but Gaithner, as always, got his way. An instructive, if painful, lesson in the extent of U.S. soft power, and in who our friends really are. The ECB walked away with everything it wanted. The IMF were scathing of the Irish performance, with one staffer describing the eagerness of some Irish negotiators to side with the ECB as displaying strong elements of Stockholm Syndrome. A senior U.S. official issued a weasel-worded protest pretending that it was impossible for an American to dictate European bank policy. The official pointed out the ECB and the European Commission, EC, did not want to impose haircuts on bondholders who loaned money to Irish banks. The ECB and EC were both dead opposed and they are decisive. The US is not a decision-maker on European issues. In other words, all central bankers are willing to crucify economies on a cross of debt. They don't need US urging. Ireland's central bank governor Patrick Honohan duly conveyed the ECB's policy to Lenihan. The pliable finance minister filed to recognise that debts taken on by governments are different from what banks owe uninsured depositors and private bondholders. Government borrowings from official international institutions such as the ECB or IMF are almost impossible to write down. Once Ireland capitulated to the ECB, it was too late to write down the bad bank debts because depositors and bondholders already had taken their money and run. Dublin professor Kelly, cited above, argued that Ireland should not have maintained its September 2008 bank guarantee long after it had become clear that the bank losses were insupportable. The government should have seen that it had been misled and that the ECB was not giving advice reflecting the national interest, but defending its constituency bankers. Bondholders and uninsured depositors should have been given shares in the bad banks, instead of borrowing from official financial institutions to cover depositor withdrawals. Instead, paying off these risk-taking creditors created a lost decade of Irish growth. The government issued €31 billion of promissory notes to the European bank authorities that advanced the funds to wind down Anglo-Irish. When interest charges are included, the total cost to the exchequer is estimated at €47 billion over 10 years. For the 6 main Irish banks, Dublin faces a bill of at least €63 billion. The sum rose to $85 billion in dollar terms by the start of 2014. To put it in perspective, the European Union has just agreed to create a fund of $75 billion to deal with all future banking crises in its member states. Ireland had agreed to pay more than all the rest of Europe put together for all of the continent's bad bank loans. Under the former Bagehot rule, bad banks were supposed to be left to fail. Their stockholders and large uninsured depositors would have been stuck with a loss, and bondholders would have been paid in bank stock rather than cash. But what Sheila Bair observed regarding the US bailout, "It's all about the bondholders," was repeated in Ireland. To save everyone from taking any loss, the government agreed to take full liability, even for asset-backed securities and subordinated debt. Anglo-Irish's failure would not have injured Ireland's economy. But by the time the public guarantee expired in 2010, private creditors had run off with the money. Their place was taken by EU financial authorities. Even the Financial Times editorialized that this heavy official borrowing was a great mistake. By taking on the liabilities of the banking system in full, Irish taxpayers have rescued foreign creditors, who should have taken a hit for the crash. When Eurozone leaders decide about Ireland's bank debt, they should not use the behavior of a few reckless bankers as an excuse to punish an entire country. The government transferred all the losses from earlier debt leveraging onto taxpayers. The national debt nearly doubled, from 64% of GDP in 2009 to 125% by 2013. All of Ireland's GDP growth was earmarked to pay the ECB for the loans that enabled foreign bank creditors to receive high-risk interest without having to suffer any loss, as if putting the interest of speculators first is perfectly natural. No referendum asked voters what they wanted, but their choice became clear in January 2011, 2 months after the capitulation. Fianna Fáil and its Green Party allies were voted out overwhelmingly and replaced by a Fine Gael/Labour coalition led by Enda Kenny. But the new government maintained its commitment to pay the European Union's rescue package, turning Ireland into what a Financial Times editorial characterised as Europe's indentured slave. Dublin's European partners want Irish taxpayers to throw more money into holes dug by private banks. As part of the rescue, Dublin must run down a pension fund built up when Berlin and Paris were violating the Maastricht rules. So long as senior bondholders are seen as sacrosanct, fire sales of assets carry a risk of even greater losses to be billed to taxpayers. Enda Kenny, Fine Gael's leader and presumptive Dowsiak, claims he will renegotiate the deal. The likely outcome is a face-saving but useless compromise. In return for a lower interest rate, Mr. Kenny will stand by his predecessor's suicidal conflation of bank and sovereign debt. That is indeed what happened. Ireland voted with a 60% majority in May 2012 to accept the fiscal pact, without any relief for the harsh loan terms accepted by the previous regime. That prompted nearly 10% of the population to vote with their feet and leave almost 400,000 out of 4.5 million since 2007, mostly the best educated youth, emulating their counterparts in neoliberalized Latvia and Greece. David Begg, head of the Irish Congress of Trade Unions, claimed, "The Troika has done more damage to Ireland than Britain ever did in 800 years. Jamie Smith noted in the Financial Times, 1 in 5 of the 942,440 outstanding mortgage accounts has either fallen into arrears of more than 90 days or has been restructured because of a borrower's inability to pay. About half of the 101,652 restructured mortgages, in which homeowners or buy-to-let investors are offered interest-only deals, have slipped back into arrears." The ECB and other creditors applauded Ireland's willingness to impose austerity to pay for the debts that it naively had believed were making it rich in the years leading up to 2008. A video has gone viral on the web of a Troika delegation meeting with Irish officials in Dublin early in 2012, in which ECB representative Klaus Mazuch tried to curry popular support by telling reporters about how well Ireland was coping. His sanctimonious narrative prompted journalist Vincent Brown to stand up and ask about the fact that the ECB forced our government to guarantee private bankers' debt that our public finances could ill afford? Debts that the Irish people never consented to through their elected representatives? Your central bank forced our government to bail out private bankers so that non-Irish banks to which the money was ultimately owed would not need to be bailed out by Frankfurt, Berlin, or Paris. Why did Europe's central bank, our central bank, force a small nation to take on private debts without their consent? Ireland's new president Michael Higgins, who assumed office in November 2001, complained that his country was praised as the Eurozone's model bailout patient simply because we are pragmatists instead of seeking a confrontational stance against drastic budget cuts. It would have been of immense benefit naturally to growth, employment creation, and investment if the commitment of separating banking debt from sovereign debt had in fact been implemented. But this hand-wringing was as far as he went. The IMF issued a scathing report in January 2015 blaming Ireland for taking neoliberal ECB advice and borrowing from it and the IMF. Despite IMF compliance and partnership in the loan, the report faulted the Irish government. The failure to bail in unsecured creditors to a bank rescue that cost Irish taxpayers €64 and bankrupted the country was based on the view that doing so would have serious adverse spillover effects in other Eurozone countries, even though such risks were not obvious. Moreover, the level at which Irish bank bonds were trading at the time implied that holders of senior unsecured bank bonds were expecting to take a haircut on their bond holdings, according to the fund. The IMF's observations, in a report published today that is effectively its verdict on its role in the €67 Irish bailout, are likely to reignite arguments in Ireland about the cost and consequences of the bank rescue, the most catastrophic financial event in recent Irish history. The IMF said that as a result of the failure to impose losses on bank creditors, many in Ireland question why Irish taxpayers should be the ones covering the cost of addressing such euro area-wide concerns. A bail-in or other solution that would have mutualized these costs would likely have resulted in more equitable burden sharing. Nonetheless, the IMF report concluded, Ireland's bailout was unnecessary to prevent contagion. It was part of the cry havoc strategy that bankers deployed from the United States to Europe. The IMF appears unconvinced by arguments that imposing the haircut would have spread contagion across the Eurozone. Even if spillover risks were important, steps could have been taken to ring-fence these through appropriate policy responses in the affected markets. By 2014, Ireland's level of investment fell to 9% of GDP, comparable to Guinea-Bissau, Yemen and Somalia, all beset by strife and civil war. Housing prices fell to half their 2007 level. But Irish families remained liable for the full mortgage debt they borrowed. That dynamic is the root cause of the country's debt deflation, unemployment, and emigration. Some 165,000 Irish people between the ages of 15 and 24 have emigrated in the past 5 years, while the proportion of the population aged between 15 and 29 fell from 23.1% in 2009 to 18% in 2014. An estimated 1 million active Irish passport holders were living abroad. That is more than a fifth of the Irish population, which stood at 4.6 million in April 2014. Ireland is making marginal progress toward alleviating personal suffering from bankruptcy by shortening the period of bankruptcy punishment from 12 to just 3 years, and urging banks to write down mortgage debts to reflect actual market prices. But there is nothing like America's jingle mail practice in which homeowners can walk away and free themselves from debt, leaving the bank holding properties on which it has overlent. Irish debtors are liable to pay mortgages that often are twice what their home is worth in today's still crumbling market. Without much prospect of earning their way out of debt, they find themselves obliged to emigrate. Without recognizing that the government was recklessly advised from the start and therefore making an about-face regarding the debts to the ECB and IMF, all that Ireland can do is take marginal and token steps within its financial straitjacket. Britain has no such pragmatic shyness. On January 14, 2014, Conservative Chancellor of the Exchequer John Osborne told a conference, "The biggest economic risk facing Europe doesn't come from those who want reform and renegotiation, it comes from a failure to reform and renegotiate. It is the status quo which condemns the people of Europe to an ongoing economic crisis and continuing decline." The next day, Nigel Farage, leader of the UK Independence Party, announced that Europe's parliamentary elections in May 2014 are really going to be a battle of national democracy versus EU state bureaucracy. Up until now everybody has thought the development of the European Union was inevitable. That myth of inevitability will be shattered by the European elections this year. And so it was, with rising counter-pressure in 2015 by populist anti-creditor parties. Membership in the Eurozone has become synonymous with financial dominance, debt deflation, and government responsibility for bailing out banks, their uninsured depositors and bondholders, all in the context of light-touch deregulation permitting fraud to flourish, with its costs being shifted onto taxpayers. The missing alternative is debt write-downs. The virtue of a debt write-down policy, permitting mortgage debtors to walk away and leave their banks holding the empty property bag, is that it obliges banks to be prudent not to overlend. At least, that was the theory before banks began to securitize bad mortgages and sell them to naive buyers. Ireland provides a prime example of what happens when debts are not written down. 1 in 6 mortgage borrowers are in default on their loans. However, 2/3 of those loans have never been restructured. What is still missing, in many quarters, is recognition by bureaucrats and bankers that failure is an inevitable part of the market system, and that it sometimes pays to wipe the slate clean rather than endlessly sweep problems under the carpet. Letting borrowers run away from bad loans may not be healthy, but it is even less healthy to leave a chunk of the population trapped in the virtual prison of debt that can never be repaid. Instead of coming to this recognition, Ireland became one of the harshest critics of Greece's attempt in 2015 to avoid succumbing to the Irish disease. Criticizing Syriza's bold stance, Ireland's leaders in effect said what must have been on their minds: "My God, what have we done? Even the IMF is criticizing us for going along with Europe and bailing out the banks and imposing austerity. If Syriza wins and reverses austerity in Greece, then our sacrifice of our economy and the poverty we've imposed has been needless and we didn't have to do it." 20. The financial conquest of Latvia, from the Soviet orbit to neoliberal austerity. The European debt crisis is not a conflict among nations. The financial crisis in Europe, like all financial crises, is ultimately a struggle about how the costs of the adjustment will be allocated, either to workers and middle-class savers or to bankers, owners of real and financial assets, and the business elite. Michael Pettus, Syriza, and the French Indemnity of 1871-73. The Baltic Tiger miracle has been as disastrous as that of Ireland. On January 1, 2014, Latvia's government accepted the Eurozone's ideology of fiscal and financial austerity, despite opinion polls showing a majority of voters opposed to joining. While Greece and other countries were debating whether these conditionalities would drive them out of the Eurozone, and Icelanders lost interest in joining it, Latvia became its 18th member. As Europe's most extreme neoliberalized economy, its experience provides an object lesson for the dynamics of debt deflation, public spending cutbacks and refusal to tax land rent or monopoly rent, which pro-bank writers applaud as a success story. It certainly has been a success story for Swedish and other bankers. Post-Soviet economies were free of public debt, business debt, real estate, and personal debt or other bank loans when they obtained their political independence in 1991. Their residential and commercial real estate, transportation facilities, and highly educated population could have provided the foundation for a competitive low-cost modern economy. Every family could have been given its home at a nominal price. Prime real estate and infrastructure monopolies were turned over to insiders on such terms. But by the time most families started to buy home ownership, prices were soaring. The debt-free situation with low housing costs and a broad array of public services did not last long. Latvia imposed Europe's heaviest taxes on labor and industry, and the lightest on real estate and finance. Its minuscule property taxes left almost the entire rental income available to be capitalized into bank loans, and property prices spiked to among the highest levels in Europe. Like other post-Soviet economies, Latvians wanted to achieve the prosperity they saw in Western Europe. If Latvia actually had followed the policies that built up the industrial nations, the state would have taxed wealth and income progressively to invest in public infrastructure. Instead, Latvia's miracle assumed largely predatory forms of rent-seeking and insider privatizations. Accepting US and Swedish advice to impose the world's most lopsided set of neoliberal tax and financial policies, Latvia levied the world's heaviest taxes on labor. Employers must pay a flat 25% flat tax on wages plus a 24% social service tax, while wage earners pay another 11% tax. These three taxes add up to nearly a 60% flat tax before personal deductions. In addition to making labor high cost and hence less competitive, consumers must pay a high value-added sales tax of 21%, raised sharply from 7% after the 2008 crisis. No Western economy taxes wages and consumption so steeply. Latvia's heavy taxation of labor finds its counterpart in a mere 10% tax on dividends, interest, and other returns to wealth, and the lowest property tax rate of any industrial economy, as described below. This fiscal policy retards employment while subsidizing the real estate bubble that is the chief feature of Latvia's Baltic miracle. From the time the Baltics achieved their independence from the Soviet Union, they opened their economies to foreign bank affiliates, mainly from Scandinavia. Latvia's few domestic banks were created by insiders to handle their own operations, and increasingly to receive government deposits, which they lent to themselves or to business associates to buy up the assets being privatized. When the largest bank, Parex, with 17% of Latvian deposits, became insolvent in November 2008, the government took it over to avoid seeing its own deposits wiped out, and to stop a bank run to Swedish banks. Foreign bank branches financed the real estate boom, whose interest charges became a financial tax burdening the nation's labor and industry. As occurred in Ireland, leaving the debts in place when the bubble burst drove an estimated 10% of the population to emigrate. Yet voters have kept re-electing governments committed to austerity. The explanation is to be found in the trauma associated with Russian domination during and after World War II. Stalin arrested, killed, or drove into exile an estimated 50,000 Latvian professionals in the 1940s. Bringing in Russian workers created a legacy of resentment that made the Baltics turn toward Europe after the Soviet Union broke up. Revival of nationalism enabled neoliberal politicians to play the ethnic card, pointing to the fact that the major critics of austerity are parties supported by the Harmony Center coalition, backed largely by the one-third of the population that is Russian-speaking. Those who advocate taxing real estate and financial wealth, or even supporting public spending, protecting consumers, and other economic regulation are accused of threatening a return to communism. A black and white contrast is drawn, either Soviet-style socialism, or neoliberal ideology denying that there is any such thing as a viable mixed economy. Latvia's alternative to Soviet-style bureaucracy was a far cry from classical democracy, utilizing its endowments to achieve an American or European-style success. It fell subject to a smash-and-grab privatization of the Soviet-era assets created prior to 1991. Instead of undertaking the social spending and infrastructure investment found in successful Western economies, the Baltic miracle featured a privatized oligarchy, dependence on foreign banks, and wage austerity. Latvia's fire sector bubble in the absence of a Federal Reserve-style central bank to finance its post-Soviet transition, Latvia relied mainly on Scandinavian banks. Supplemented by flight capital from Russia, this foreign credit inflated the Baltic real estate bubble. Foreign banks found a fertile ground in Latvia's tax policy that left almost all economic rent tax-free. Early property taxes were a fraction of 1%, at unrealistically low land appraisals. Even as land prices soared, Latvia left property almost tax-free, finally enacting a modest real estate tax schedule in 2013. The other loan market was for the public assets being privatized, mainly former public monopolies. Sweden became the major source of loans to the Baltics. Its banks allocated credit where they found the most money could be made for speculation and real estate. Almost no effort was made to restructure industry and agriculture to generate the foreign exchange to import capital and consumer goods not produced at home. No longer having Soviet markets to supply after the old USSR production linkages were uprooted, industrial enterprises were dismantled for their land value, scrapped or gentrified into real estate developments. Foreign borrowing enabled Latvia to finance its import dependency and trade deficits until 2008. Families borrowed from foreign bank branches to buy apartments or build homes, taking out loans denominated in euros or other foreign currency. The resulting real estate bubble solved Latvia's balance of payments problem of how to pay for deepening foreign dependency. This reliance on foreign banks was common for the post-Soviet countries, mainly to buy housing that was escalating in price. But it proved to be a Ponzi scheme based on borrowing more and more money. Little lending was used to put in place means to earn the foreign currency needed to pay back the debts. Latvian tax policy was as much to blame as financial policy. Instead of taxing the land's soaring site value, Latvia left it free to be pledged to bankers to keep the real estate bubbles expanding. The country did not even have land value map when it gained its independence. The Soviet Union did not charge rent, so Latvia's property tax agency had only the 1917 real estate assessment records to go on, some 3/4 of a century out of date. Even today, 2015, Latvia has no land assessment map, and its property tax structure is the most inequitable in Europe, contributing to the country's polarized Gini coefficient for wealth and income distribution. Its low property tax is largely responsible for the heavy debt burden on real estate, because whatever the tax collector relinquishes is available to be paid to banks as debt service. The combination of heavy taxes on employment, little tax on property and a flood of foreign bank credit to inflate real estate prices was the essence of the Baltic miracle. It was applauded as if debt-financed real estate were a sign of prosperity, not an overhead imposing heavy housing and financial charges paid to foreign banks. Until 2015, Latvians were paid wages in domestic lats, but owed their mortgages in euros, with some sterling, Swiss franc, and dollar loans. Letting foreign bank branches make loans almost entirely in foreign currency violates a prime directive of sound financial policy: to avoid currency risk, do not take on debts denominated in a foreign currency. A weakening balance of payments leads to a declining exchange rate, raising the domestic currency cost of paying these debts. Soon after the crash of September 2008, foreign banks stopped the mortgage lending that was Latvia's main source of financing its trade deficit. Flight capital from Russia into Latvian banks also abated as oil prices fell. Back. To prevent the Latvian lat from depreciating, the government sharply cut back spending. The resulting austerity program was given a neologism, internal devaluation, meaning lower wages by running a budget surplus to drain spending power out of the economy. The austerity program prompted 10,000 Latvians to turn out in protest on a freezing and dark January 13, 2009. By March, Latvia was suffering the world's steepest one-year plunge in house prices, which had peaked in April 2007. Despite having emerged debt-free in 1991, Latvia had become Europe's most debt-strapped country, without using this credit to modernize its industry or agriculture. To prevent a run on the currency, Joaquin Almunia of the European Commission presented a letter to Latvia's Prime Minister and Finance Minister on January 26, 2009, spelling out the terms on which the ECB and IMB would lend Latvia money to support its exchange rate. The letter directed Latvia to use the credit exclusively to pay its debts to Western bank affiliates and for targeted capital infusions or appropriate short-term liquidity support for banks. However, financial assistance is not meant to be used to originate new loans to businesses and households, that is, not to help Latvia develop export capacity to earn its way out of debt. Worryingly, we have witnessed some recent evidence in Latvian public debate of calls for part of the financial assistance to be used inter alia for promoting export industries or to stimulate the economy through increased spending at large. It is important actively to stem these misperceptions. Eurozone and IMF credit thus was provided only to support foreign banks. Supporting the exchange rate enabled investors and kleptocrats to move their funds out of the economy for more foreign funds than if the lat depreciated. Many Latvian officials had a personal interest in avoiding devaluation of the lat. Most that I have met had heavy foreign currency mortgages. Central bank head Ilmars Rimzovics was said to owe euro debts that would have left him underwater on his several mortgages if Latvia had devalued following the 2008 crash, even though his salary was higher than that of Ben Bernanke at the Federal Reserve, despite the fact that Latvia's GDP is only about half that of today's collapsed Detroit area. Commissioner Almunia's conditionality left Latvia in the position of a nation defeated in war and having to pay reparations, in this case to meet Swedish demands that banks must be paid in full, on time and without a haircut before money could be spent to revive the economy. Latvia's government succumbed to a literal Stockholm syndrome, defending the Swedish financial interests that were reducing its economy to debt bondage. This debt deflation hardly is what Latvia expected when it turned to the West for assistance. The neoliberal advice it received was simply to privatize its assets with an anti-labor flat tax such as no EU nation imposes on its own population. US and European trained advisors turned a blind eye to the fact that the post-Soviet economies were paying for imports simply by borrowing against the property with which they emerged at independence. The core EU nations stood by for 2 decades watching insider dealings that their own prosecutors never would have permitted at home. Saving Latvia's banks, not the economy. By the spring of 2010, Latvia's real estate prices had plunged by 70% and the government was aiming to reduce public sector wages by 30%, hoping that private sector wages would follow suit. On May 25, I headed a foreign advisory delegation with Jeffrey Summers that met with the Financial and Capital Market Commission. Our discussion focused on how the banks were coping with the real estate crisis. The Commission's chairperson, Irina Kremain, explained that her agency's role was simply to see that the banks remain solvent by making sure that their loans were secured by adequate collateral, without regard for the economy-wide cost. Kremain told us that despite her regulatory agency's warning about the real estate bubble, Latvia's mortgage debt was twice as high as would have been the case if bank regulators had moved as fast as Estonia and Lithuania. The problem was regulatory capture. Commercial banks were her agency's source of funding. Swedish banks, in particular the largest lenders in Latvia, blocked tighter regulatory standards. Wanting to make the largest loans possible, they opposed attempts to confirm their income or loan quality. So the Latvian authorities saw their role simply as being to make sure that the banks could get repaid for their loans and remain solvent, regardless of how reckless their lending was. It was indeed reckless. In June 2006, my colleague Jeffrey Summers had asked the head of the real estate division for one of the top Swedish banks in Latvia why it was continuing to lend to an inflated property market. "We know it will crash," Summers was told, "but everyone's annual bonus depends on making more money, and we can't stop now." The financial dancing thus continued, just as it did in the United States and other countries. The bank regulators told us that it would be central planning to set higher capital adequacy and reserve requirements against mortgage loans. The reason European Union rules give little regulatory power to governments is precisely to prevent such allegedly arbitrary intrusions into ostensibly free markets, the kind of regulation that is done quite normally in the United States and Britain. By preventing Latvia from requiring higher reserves for mortgages than for loans to industry and commerce, neoliberal ideology blocks regulators from stopping the real estate bubble, even if they might want to do so. One of the reasons for our visit was the absence of an up-to-date land register to assess property. The regulators coped with this problem by shifting the backing for bank loans away from actual property values to focus on the borrower's income, getting not only the borrowers themselves, but as many members of their family as possible to co-sign the loan as sureties, whose income the banks could garnish in case of default. This saved the banks but devastated families when housing prices in Riga plunged 68% from their 2007 peak, pushing 54% of Latvian real estate into negative equity. This approach was the opposite of the American jingle mail permitting borrowers to walk away from underwater mortgages. Latvian banks had no responsibility to relate loans to the property's value. When defaults spread as real estate prices fell deeper into negative equity, banks went after the family members who had co-signed mortgage loans. The regulators told us that they could not direct banks to write off part of their loans, because that would be the equivalent of nationalization. Their only recourse was to ask that banks voluntarily reconfigure the loans, which, of course, the banks showed little interest in doing. So the officials charged with regulation merely sat back while banks siphoned off Latvian income and paid it to their head offices in Sweden and other credit capitals. Any thought of steering finance to promote lending to industry or commerce or to avert a real estate bubble by taxing real estate site rents was rejected as interference with the market, a euphemism for letting banks do whatever they want. This inability to regulate banks in the public interest effectively places them in the role of central planners. The economy-wide effect of such financialization was that many homeowners had to earmark 30 to 40% of their income to pay banks. If they lost their job, or if internal devaluation reduced their wages, the banks got to take whatever their seniors earned. Neoliberal debt deflation, emigration, and financial tribute. This predicament left homeowners in negative equity with the classic neoliberal free market choice: pay up, or free themselves from debt by emigrating. Some 10% of Latvia's population has left since 2000, and roughly 14% of the working age population, with emigration accelerating after the 2008 crash. In 2013, a full 10% of Latvian live births were reported to have occurred in Britain. As in other countries subjected to austerity, Latvian emigration is concentrated in the most highly educated and employable population, 25 to 35 years old. Latvians joke about collapse by 2030, by which time the last person to leave the airport is asked to please turn off the lights. Emigration entails a loss of the capital that has been invested in rearing, educating, and training labor that is forced to migrate to find work. What is now driving European labor to emigrate is harsh debt policy. One is reminded of Adam Smith's discussion of how fugitives from the Italian town of Lucca brought silk manufacturing techniques to Venice in 1310. He blamed Italy's oppressive political autocracy. But instead of blaming Europe's most dramatic internal devaluation for these new exiles, many Latvians accept the applause from neoliberals celebrating their country as a success story. It has been made the poster child for the kind austerity imposed on Greece, Spain, and Italy. Neither Ireland's nor Latvia's economic problems and emigration stem from the government spending that neoliberals blame. The problem was irresponsible and unregulated commercial banking, reinforced by the idea that economies can get rich by borrowing abroad to inflate real estate prices at home. Real estate's rental value was transferred to foreign bankers in the form of interest charges, with reckless banks being bailed out at taxpayer expense. It was a travesty of free markets to lower wages and domestic spending by enough to pay loans extended at far above market levels. The effect of this neoliberal policy can only be debt deflation, depression, and more emigration. Bank-oriented planning blocked Latvia from creating a public bank to finance its post-Soviet transition. The population's checking and savings deposits and even those of public agencies had nowhere to be placed except in private banks. The moral of Latvia's and Ireland's economic plunge is thus the opposite of what neoliberals depict. Banking should be a public utility. Otherwise, its lending preferences will thwart industrial growth, employment, and living standards. Credit will be created mainly to buy or take over existing properties, infrastructure, and companies, bidding up their cost to make basic needs more expensive rather than competitive. Commissioner Almunia's letter to Latvia's leaders reflects the ECB's guideline of printing money only to buy government bonds long since issued, to prop up their price so that bondholders can sell them with minimal loss. That is what ECB President Mario Draghi meant when he pledged in summer 2012 to do whatever it takes to save bond prices from falling as a result of rising interest rates. The EU does little to aid the real economy, but only offers help in sacrificing labor and industry to benefit creditors. The aftermath: banks blame victimized borrowers, not themselves. Most economists depicted the dismantling of Soviet-era industry and the former public sector as creative destruction, a necessary transition toward Western-style market economies. This was achieved by giving public infrastructure to political insiders in a grabitization exercise. The result was a much steeper concentration of wealth than characterizes Western nations. Yet looking simply at GDP growth, neoliberals claimed that until 2008 the Baltics and Central Europe were on a path to catch up with the West. By 2008 it became apparent that the post-Soviet economies had not really grown as much as they had been financialized and indebted. Forbes economist Mark Adamanis calculated in 2014 that if convergence of these economies with those of the West continues at its 2008-13 pace, about 0.37% per annum, it would take the new EU members over 100 years to match the core country's average level of income. To the extent that Central Europe's most rapid and sustained burst of convergence coincided with a credit bubble that is highly unlikely to be repeated, it seems more likely than not that the region's convergence will be slower in the future than it was in the past. The means of self-support have not been put in place. A deepening trade deficit has been financed by foreign borrowing, which now poses a chronic balance of payments drain of debt service. No longer having a real estate bubble to bring in enough foreign exchange to finance the trade deficit, all that these countries have to export is their people. Instead of making economies more competitive, austerity drives those who can emigrate to leave in search of work. As Adamanis concluded, to the extent that Europe's future will be one of tight money and tight budgets, that suggests that Central Europe will be in for a rough ride. Instead of performing a productive function, banks created debts by operating an economy-wide Ponzi scheme, obtaining high short-term returns based on valuations of property whose prices could be supported only by further lending on increasingly easy debt pyramid terms. This inflated the price of housing, the economy's largest cost category. Earmarking income to pay higher debt service was largely responsible for shrinking domestic market demand and employment opportunities. Bank opposition to writing down mortgages to market levels. What should be done to cope with the debt burden left over from such bubbles? To what extent should the banks and bondholders who provided the money for such schemes, at high returns, presumably reflecting the degree of risk, be obliged to absorb the losses? Stated the other way around, to what extent should Latvian debtors be allowed to walk away from property whose mortgage exceeds the market price? These questions were raised in Latvia's Saeima, Parliament, in January 2014 when the left-leaning Harmony Center Alliance proposed an amendment to the nation's real estate tax law to approve the jingle mail principle. The amendment was passed in its first reading. Parliament rules call for 3 readings. But despite being Latvia's largest party, it won 28% of the vote in the 2011 parliamentary election. The fact that Harmony Center's support came mainly from Russian speakers enabled neoliberal parties to accuse its proposal of being pro-Russian and hence anti-Western. These parties united to exclude Harmony Center members from office. Bank lobbyists threatened to sharply raise interest rates and increase the required down payment for new home buyers to 50% or more, compared to the usual 10%, to compensate them for the increased risk if the jingle mail option was legalized. What banks objected to was the idea that they are supposed to allocate the economy's savings and credit by realistically determining how much borrowers can afford to pay. Mortgage loans are supposed to be secured by basing them on the realistic rental value of the property. The jingle mail safety valve keeps banks responsible for competent credit analysis. Banks that fail to do this should bear the loss. Preparing for the CMA's third, final, reading of the insolvency law in June 2014, banks advocated a small print change: the mortgage debtor's obligations would be deleted only in cases when, during the insolvency process, the home is sold, not when the debtor actually stops paying. This would enable banks to prolong the interim and extract payments from debtors and CO signers for as long as possible. The bank lobby prodded the Economy Ministry to send a letter to the CMA on July 3, 2014, asking that the jingle mail draft law, called Abandoned Keys in Latvia, be withdrawn from the plenary meeting's agenda by a majority of votes. Since the draft had been scheduled for consideration, the only ploy was to stall by prolonging the term for proposals. When it came up again, on September 25, Igor Pimenov of the Harmony Center Coalition said, "This abandoned keys provision means much more than a step towards borrowers in trouble. It is the legal framework, which changes dramatically the rules of conduct in the real estate market. It provides a reference that banks and other creditors should be sufficiently responsible and lend proportionately, so that the bank will no longer lend credit that exceeds the value of the collateral." Bank lobbyists used an Orwellian rhetorical twist, urging more freedom for loan takers to accept harsh bank terms. Banks would tell borrowers that a loan would be available to buy a property only if they waive their rights to the abandoned keys clause. The bankers' slogan of free choice thus threatens a loss of economic freedom for home buyers obliged to overpay and overborrow for housing. The effect is to invert the classic banking principle that if loans are made on a realistic basis, property on which debtors default can be sold at a market price that will cover what the bank is owed. The logic for leaving banks in private hands assumes bankers are realistic in their credit allocation. The events of 2008 shattered this myth. As debts proliferate without limit, the ECB and EU Commission pressure governments to reimburse creditors in full. Taxpayers are to make up the losses too large to be borne by mortgage debtors' ability to pay, until the economy grinds to a halt as debt deflation pushes it into bankruptcy. A return to classical bank policy would deem loans fraudulent and annul debts when creditors do not lend with any reasonable calculation of how the debt can be paid in the normal course of economic life. Loans made without such a calculation should be considered predatory. The natural check on such behavior is to permit mortgage debtors to walk away from their homes, free of the debts attached to them, letting title revert to the banks that overlent. Across Europe, except in the post-Soviet economies where neoliberalism is presented as the lone alternative to Soviet-era planning, popular support is rising to reject a Eurozone run in the interests of banks and foreign creditors. A 2013 Eurobarometer survey reported that only 31% of European citizens trusted the European Union, down from 57% on the eve of the 2008 crisis. Support for the euro has dropped sharply to 56% in Spain, 53% in Italy, 50% in Portugal and just 44% in Cyprus. Even in France, support stands at just 63%. By the May 2014 elections, nationalist anti-bank opposition had risen even steeper, led by Marine Le Pen's Front National in France, Geert Wilders' anti-immigration and anti-Islamic Party for Freedom in Holland, Nigel Farage's UK Independence Party, and North Italian separatists supporting Pepe Grillo's Five-Star Movement. Bankers are seeking to capture government and make financial policy immune from democratic choice. What promised to be a progressive social democratic Europe half a century ago is turning into a power grab by financial predators. The EU has confronted Greece, Cyprus, and other indebted economies with an option of suffering debt deflation or leaving the Eurozone. Since Greece's Syriza coalition took the electoral lead in opposing the financial and fiscal austerity, the creditor response has been to dare Greece to withdraw and to suffer a transitional financial chaos if it tries to save itself from being crushed by unemployment, bankruptcy, and emigration. 21 Creation of the Troika, its pro-bank, anti-labor agenda. The idea that the euro has failed is dangerously naive. The euro is doing exactly what its progenitor and the wealthy 1% ERS who adopted it predicted and planned for it to do. Removing a government's control over currency would prevent nasty little elected officials from using Keynesian monetary and fiscal juice to pull a nation out of recession. It puts monetary policy out of the reach of politicians, Robert Mundell explained. Without fiscal policy, the only way nations can keep jobs is by the competitive reduction of rules on business. Hence, currency union is class war by other means. Greg Palast, Robert Mundell, evil genius of the euro. Unlike the bank-fueled real estate bubbles of Ireland, Latvia, and Spain, Greece's problems stem from government debt. Tax evasion was widespread under the alternating conservative and socialist governments that replaced the 1967–74 military dictatorship. Both parties undertaxed the country's tycoons, and wealth in general, and used public employment as political patronage. Budget deficits rapidly increased the public debt. Under the Maastricht Treaty, a precondition for adopting the euro in 2001 was that public debt could not exceed 60% of GDP. To meet this condition, Bank of Greece head Loukas Papademos conspired with Goldman Sachs to create Enron-style off-balance sheet window dressing to conceal the real deficit and debt levels. Papademos sold government debt to the investment bank, promising to buy it back at a much higher price incorporating a higher interest rate. To mask the charade as an interest rate derivative swap, he recorded the sale as revenue, reducing the reported debt but committing the government to pay back Goldman Sachs out of future revenue until 2019. The stratagem came to light 8 years later, soon after the Socialist Party, PASOK, won Greece's national elections in October 2009 behind George Papandreou. His father Andreas had founded the party in 1974, and George had led it since 2004. He had been elected president of the Socialist International in January 2006, and was unanimously re-elected in 2012. So his tenure as prime minister showed how far socialism has moved from what the word meant a century ago. Papandreou's party bowed to the demands laid down by Europe's bankers and bondholders to impose austerity. In December 2009, the Finance Ministry revealed that Greece's 2008 budget deficit was 12.5% of GDP, twice the earlier reported amount and over 4 times larger than the Eurozone's official 3% limit. Investors began selling off Greek bonds, worrying that government could not pay. Falling bond prices reflected the high-risk premium, appealing mainly to speculators. By March and April 2010, the big three accounting firms Moody's, S&P and Fitch lowered Greek bonds to junk status. Fear began to spread that writing down Greek debt might open the floodgates for the rest of Europe, as had occurred in Latin America a half-century earlier. Bonds of Spain and Portugal were sold off in the early months of 2010. With no visible means to pay, these three economies were beginning to look as toxic as the American and Irish junk mortgage markets had become. The IMF loses credibility by joining the Troika to bail out bondholders fearing contagion. The prospect of a debt write-down spreading across the Eurozone in the debt-strapped PIIGS, Portugal, Ireland, Italy, Greece, and Spain, the European Central Bank, ECB, and European Commission, EC, were concerned single-mindedly with saving bondholders from taking a loss. They insisted that Greek taxpayers be liable for the earlier government fraud. The ECB made it clear that it would help Greece only on the condition that it pay bondholders in full. This attracted vulture funds, speculators hoping to make fortunes by buying bonds selling at low prices as investors shied away from risk. They gambled that the ECB and IMF might arm-twist the Greek government to pay more than financial markets and ratings agencies believed was realistic. As the IMF's annual meeting in Washington approached in April 2010, Greek officials urged its staff economists to concur with the ratings agencies and markets, and urged the ECB to moderate its hardline position and write down the debt. For the IMF, Greece's dilemma seemed a godsend, offering a chance to recover its position as an honest broker assessing public debt-paying capacity. It had lost credibility in 2001 by participating in a bailout of Argentina that went bad almost immediately. By 2006-07 the Great Moderation was peaking, leaving the IMF with no major customers. Debtor governments recognized that the IMF's knee-jerk austerity medicine threatened to bleed their economies and make them even less able to pay bondholders. To be accepted by the Eurozone's financial agencies, the IMF agreed to a Faustian bargain. The European Commission was staffed by pro-austerity bank ideologues, and the ECB was run by hardline monetarist Jean-Claude Trichet. He did not want fund involvement except as window dressing to endorse his demands for payment in full. Before heading the ECB, Trichet was chairman of the Paris Club, created in 1956 to take a hard line with the Argentine government on behalf of creditors. At the ECB he continued the Paris Club's default position, insisting that public sector debtors or guarantors can and must pay whatever is owed. This involves not admitting that any limit exists as to how much can be paid, because recognition of a limit would lead to the conclusion that bondholders must take a haircut for having lent too much. Fearing that IMF analysts might take this position, as they indeed did, the European Commission negotiated an austerity program before the IMF could get involved. The ECB and EC excuse for refusing to take a loss on their bailout loans is that to do so would violate the EU rule that no country's taxpayers should support another country. The ECB refuses to think about creating tax-free electronic money for this purpose. This makes the European Union different from a true political union such as the United States. It is every country for itself. It is as if each state in the United States had to be self-sustaining, with no tax revenue raised in any given state, say, New York, to be spent in other states. On paper, the IMF's Articles of Agreement seemed to qualify it to play a reasonable mediating role. It had learned from its 2001 Argentine debacle that it should stop lending to debtor governments without concern for their ability to pay. In 2003 the IMF Executive Board established ability to pay criteria that debtor countries had to satisfy in order to borrow beyond the normal limit, 200% of their IMF quota. These conditions included, a rigorous and systematic analysis, that there is a high probability that debt will remain sustainable, good prospects of regaining access to private capital markets, and a reasonably strong prospect of success. The aim was to avoid financing bailouts that soon would collapse. That seemed good in principle, but the IMF's political leaders overrode its staff and board members who came to the same conclusion as ratings agencies and the bond market. There was no foreseeable way in which Greece's debt burden could be paid out of economic growth and tax revenue. Given that its debt was not sustainable, there was little hope of borrowing more in private markets. Investors saw no politically palatable means of paying off the debt. The market in Greek government bonds was limited to vulture funds and the Franklin Templeton Fund, with some $7 billion as of 2015. So IMF acquiescence to ECB and EC ideology and politics was doomed to fail. The government's budget deficit had widened to 13.6% of GDP in 2009. By April 2010 it became obvious that private credit would be forthcoming only at steeply rising interest rates. From Washington, Obama and Geithner urged a bailout on behalf of Wall Street, given U.S. banks' $3.6 trillion exposure to European banks. And regardless of what IMF staff economists thought, the fund's leaders owe their jobs to Washington and Brussels. In practice this means to Wall Street, Frankfurt and the Paris Bourse. The Troika's austerity conditions for bailing out Greek bondholders. Washington and Brussels had three inexorable demands. First and most basic, bondholders should be paid in full. To achieve this aim, the IMF, ECB, and EC formed a troika to lend governments enough money to give bondholders time to dump their holdings. The implicit threat was pay up or we'll render you financial outcasts. The troika's second demand was that debtor countries reform labor markets by breaking union power and rolling back workplace reforms put in place over the past century. The pretense was that this would make labor more competitive, that is, less expensive to hire. Laws protecting workers from firing would be revised, as would policies that gave advantages to unions in wage bargaining. Professions and trades that for decades had enjoyed restrictions from competition law, auditing, pharmacy, engineering, architecture and road haulage would be opened up. Bloated state enterprises, such as the National Railway and other public transportation companies, would be streamlined. The third troika demand was that when countries could not pay bondholders out of current income and tax revenue, they had to start selling their public domain to private investors without imposing limits on how much the new buyers could charge as they set up toll booths on roads and for water, electricity, and other basic services. This ultimate result of bailout stabilization loans has been repeated so often that it must be considered to be the real aim of IMF, ECB, and EC policy. The IMF's head Dominique Strauss-Kahn planned to run for the French presidency and did not want to antagonize French voters or its banks, which were the major holders of Greek bonds, variously reported to range from €31 to €60 billion, compared to €23 to €35 billion for German banks. In May 2010, French President Nicolas Sarkozy rounded up what would become a multi-year €110 billion loan pledge from European governments to pay bondholders. IMF staff economists reviewing the ECB austerity program for Greece found it unrealistically harsh, and believed that a debt write-down was necessary. If Greece, like Argentina, had an unsustainable debt, a big IMF loan could be granted only on condition that the debt was restructured, so said the No More Argentinas rule. Imposing a haircut promptly would ensure that the burden of loss would fall on the private creditors who had lent money to Greece in the first place. Giving Athens a big international rescue loan, with no haircut, would shift the burden to taxpayers. But Strauss-Kahn evidently feared that supporting this position would lead ECB and EC officials to reject IMF participation. The price of acceptance by these two Eurozone institutions was to not interfere with their demands. The above-quoted autopsy of the IMF's surrender, turning it into a junior partner, concludes that a debt write-down simply was not tolerable to Europe's senior-most lenders, the most implacable of whom was the ECB's Trichet. The issue arose at an ECB meeting in the spring of 2010, when Jürgen Stark, a member of the six-person executive board, argued that Greece's debt was unsustainable, and that therefore the solution should include losses for private creditors. The ECB president blew up, according to one attendee. Trichet said, "We are an economic and monetary union, and there must be no debt restructuring," this person recalled. He was shouting. So on May 9 the IMF capitulated, joining the ECB and EC to form the Troika, and funded over a quarter of its €30 billion 3-year standby arrangement with Greece. This was by far the largest loan the IMF had ever made. Although its usual rules limited a country's annual borrowing to 200% of its quota, the Greek loan was 3,200%. This saved Greece from defaulting on a large amortization payment falling due. Shares of French banks, which had invested heavily in Greek bonds, jumped by 24%. Yields on Greek government bonds receded from the nearly 17% level anticipating default to only 15.7%. But instead of reviving the economy, the new borrowing helped finance over €60 billion capital flight from Greek banks to Switzerland and other banking centers. This drain forced banks to stop lending, starving domestic business to the point of leaving exporters unable to obtain credit to ship goods to buyers. The ensuing Greek austerity led to nearly 30% unemployment and a deeper economic collapse than had occurred in the Great Depression of the 1930s. Susan Schodler, a former deputy director of the IMF's European Department, cites two political pressures responsible for jerry-rigging its debt sustainability analysis: DSA Europe's refusal either to accept restructuring or to provide more funding on easier terms, and the IMF's eagerness to be involved, even if the program did not chart a path to debt sustainability and renewed market access. Greece was told to emulate Latvia. It was instructed to starve the economy by cutting government outlays by 7% over the next 2 years, while raising tax revenues by 4%. These conditions were based on forecasts fudged to give an illusion of viability. For example, exports of Greek goods and services were assumed to increase by 65% over 6 years. IMF directors saw that bailing out Greece's bondholders would cause economic disaster. René Weber, Switzerland's IMF representative, found the bailout assumptions overly benign. Even a small negative deviation from the baseline growth projections would make the debt level unsustainable over the longer term. The program collapsed in just 2 years. The Indian director Arvind Virmani warned that the planned fiscal tightening would be a mammoth burden that could trigger a deflationary spiral of falling prices, falling employment, and falling fiscal revenues that could eventually undermine the program itself, so a default or restructuring might be inevitable. But having registered their doubts, the directors did not interfere with Strauss-Kahn going ahead with a loan that forced Greece into depression by taking over debts owed to private bondholders without the write-down that financial markets had expected. The systemic risk loophole to neutralize IMF opposition to bailout loans to enable lending to proceed when the IMF's sustainability criteria were not met, its bureaucrats designed the systemic risk waiver. It was a model of circular reasoning that might well be taught to philosophy students. Severe debt crises all carry the risks of systemic spillovers, notes Schodler. The global financial system was deemed to be endangered if a debt payment was missed or a haircut imposed on bondholders, because confidence was threatened. Any haircut for bondholders might cause panic and contagion. So it doesn't matter what IMF economists say regarding debt sustainability. The IMF is committed to preserving confidence at all costs, confidence that the Troika will lend governments enough to pay their bondholders and speculators in full, but not pension funds. The systemic risk waiver means that no bondholder should lose. Labor and taxpayers must pay for the losses from risky loans, or else there will be contagion. When global bankers wring their hands about the financial system melting down, what they really mean is that the top 1% may lose some of the astounding amount of wealth they have accumulated since the bubble years. To save the 1% from loss, IMF, ECB, and EC policy insists that the economy and its 99% must shrink. Lending arrangements with Ireland approved in December 2010, 2,322% of quota, and with Portugal approved in February 2011, 2,306% of quota, used the systemic risk waiver on debt sustainability, Schodler complained. For Ireland, fund staff pursued a restructuring option that would have reduced doubts about debt sustainability, a write-down of bank debt held by senior creditors, but failed to prevail within the Troika. The claim that debt write-downs for bondholders would create systemic financial breakdown by destroying confidence is a public relations myth. Crafted by bondholder lobbyists as part of their cry havoc strategy, it is kindred to Gaithner's pretense that the ATMs would have run out of cash and people could not have got access to their bank accounts if no bailout occurred. Evidence that this is simply a scare tactic was provided in March 2012 when Greek bonds finally were written down 60 to 75%. There was no contagion. Looking back on the fateful April 2010 decision, Schodler concludes, contagion including to Spain and Italy would have been brought forward, but few argued that it would have been worse than it turned out to be. In a similar vein, Blustein reflects that the IMF should have been on the opposite side of the negotiating table from the ECB, rather than on the same side. But Strauss-Kahn looked to his own political reputation in France and agreed to get the IMF accepted into the Troika by joining the ECB's pro-bondholder policy. Since March 2012 it has continued to use the systemic risk waiver for debt restructurings, because its staff have not found a high probability of debt sustainability. Yet the high level of funding continues. Is there any justification beyond political expediency? The events of 2011 showed that confidence meant whistling in the dark and refraining from measuring the debtor's realistic ability to pay. This suspension of disbelief was politically necessary because once it is recognized that debts can't be paid out of tax revenues and austerity, basic moral principles call for debts to be nullified. No debtor nation should be obliged to commit economic suicide, dismantle its public domain and force 5, 10, or 20% of its population to emigrate, as did success story Latvia, duly followed by Greece. At issue is what interest should take priority, creditor demands, or the economic growth and employment of sovereign nations. The upshot: by March 2011, Greek bonds were again being dumped at heavy discounts, and savings were fleeing the economy. But instead of raising business taxes or cracking down on the notorious evasion by the tycoons who dominated both leading political parties, the politicians froze pensions, increased the sales tax, VAT, that consumers had to pay, and announced a schedule of privatization sell-offs. Large numbers of Greeks refused to pay the higher access charges set for road tolls or other public services. The police refrained from enforcing collection, and public sector labor unions called a 2-day nationwide strike, which soon expanded into an anti-austerity I won't pay movement similar to Occupy Wall Street and Spain's revolt of the indignant. Breaking from the ECB's hard line, German Finance Minister Wolfgang Schäuble proposed a 7-year debt moratorium, and insisted on a haircut for bondholders as a condition for further aid to Greece. He also asked for IMF participation to play a moderating role. His reality check panicked the market, as did many prominent economists who saw the illogic in creditor demands. Martin Wolf explained the impossibility of Greece paying off the bailout loan on the terms being offered. Assume that interest rates on Greek long-term debt were 6% instead of today's 16%. Assume, too, that nominal GDP grows at 4%. Even to stabilize debt, the government must run a primary surplus, before interest payments, of 3.2% of GDP. If Greek debt is to fall to the Maastricht Treaty limit of 60% of GDP by 2040, the country would need a primary surplus of 6% of GDP. Every year, then, the Greek people would need to be cajoled and coerced into paying far more in taxes than they receive in government spending. The Wall Street Journal also saw the mathematical impossibility of Greece being able to pay its debts, given the high interest rates and discounts on Greek government bonds, recognizing the inevitability of default. Germany would like banks to roll over their Greek debt. But Greece cannot possibly pay 17% interest rates for 10 years. So if banks roll over debt at market rates, Greece's eventual default is ensured. The newspaper reported that, as of June 17, 2011, default insurance cost $182 per year to insure $1,000 5-year Greek debt, implying a 63% probability of total loss in 5 years. Focusing on the short run, EU creditors argued that to refuse their bailout conditions would prompt even more capital flight. Banks would collapse and anarchy ensue. Luxembourg's Prime Minister Jean-Claude Juncker threatened that if Greece did not knuckle under to European finance ministers, the EU would block IMF release of its scheduled June contribution to the loan package. On June 1, Moody's lowered Greece's credit rating to junk, Caa1, down from the already low B1, estimating a 50/50th likelihood of default. Standard & Poor's followed suit. On May 25, a mass demonstration in Athens' Syntagma Square erected tents for a long occupation. As negotiations with the Troika escalated, Conservative leader Antonis Samaras said on May 27, "We don't agree with a policy that kills the economy and destroys society. There is only one way out for Greece, the renegotiation of the EU/IMF bailout deal." He rejected Papandreou's €110 bn, $155 bn, bailout package on the grounds that the belt-tightening agreed in return, is choking the life out of the economy. On Sunday, June 5, more than 70,000 Greeks gathered outside Parliament to protest EU demands for €50 billion of state assets to be sold and cutbacks public sector employment. The growing Syntagma Square camp raised banners, "Take back the new measures" and "Greece is not for sale." EU officials demanded that domestic politics should not get in the way of a reinvigorated recovery program, their euphemism for deeper austerity and non-recovery. Protests grew more violent, but Parliament passed a second austerity bill on June 29, capped in July by a pension reform cutting back promised retirement income and raising the retirement age for women to qualify for pensions from 60 to the 65-year level at which men qualified. Talk of Greece leaving the euro weakened the currency's exchange rate as investors sold eurobonds for dollars and even sterling. By July, a new package called for a 50% reduction in the face value of most remaining privately held debt. The new salvation was held to be privatization. The government drew up a timetable for sales to reach €15 billion by 2013. One Financial Times columnist called this a political provocation and an act of economic vandalism, anticipating what indeed happened. Under the scheme now likely to be agreed, any shortfall in privatization receipts would therefore open a finance gap. The creditor countries would then almost certainly ask Greece to plug the gap through even more austerity. Such a strategy is financially reckless and politically irresponsible. Unionized employees of the public power utility moved to stave off privatization, and the inevitable wave of downsizing, by threatening to strike, prompting Papandreou to promise that the government would retain 51% control. Creditors hoped to reverse social democratic values by using debt leverage. Without it, Greece would not be forced to 1. Reduce employment and wage via public spending cutbacks and anti-labor reforms, 2. Privatize its public utilities, and 3. Oblige the socialist/conservative tandem to relinquish control of economic policy to Troika apparatchiks. The restructuring of domestic law debt was completed in March 2012 and of foreign law debt 2 months later. By year-end over 60% of Greek debt was shifted into official hands. Bondholders had won, having cashed in their holdings without having to suffer a write-down. Greek taxpayers paid. Former IMF officials held out hope of rectifying matters. As the risk of a new Greek default loomed in mid-April 2015, Ashoka Modi, former deputy director in the IMF's research and European departments, urged, instead of demanding repayment and further austerity, the IMF should recognize its responsibility for the country's predicament and forgive much of the debt. But this is prevented as long as the IMF adheres to the fateful mistake it made in 2010. Instead of allowing Greece to default on its insurmountable debts to private creditors, they chose to lend it the money to pay in full. Former IMF officer Schodler points out that when that organization's staff saw in 2010 that Greece's debt was unsustainable, they reportedly made it clear that the strategy chosen would involve significant losses and that European official creditors must bear their entirety. Modi agrees, to reassert its independence and redeem its lost credibility, it should write off a big chunk of Greece's debt and force its wealthy shareholders to bear the losses. The collapse of inter-ally debts and German reparations in the 1920s showed that debts that can't be paid, won't be. What blocks this awareness among neoliberal economists is their fantasy is that all debts can be paid by squeezing out a large enough fiscal surplus. Neoliberals are incorrigible in preferring to indulge their pro-creditor and anti-labor sentiments in the face of the reality that fiscal austerity shrinks the economy and hence the ability to produce a surplus to pay creditors. 22. High finance turns democracy to junk. It is not possible to demand that the new Greek government follows the course of the previous one which, we must not forget, failed miserably. Otherwise, elections would need to be abolished in those countries that are in an austerity program. In other words, this means the complete abolition of democracy in Europe, the end of every pretext of democracy, and the beginning of disintegration and of an unacceptable division of united Europe. This means the beginning of the creation of a technocratic monstrosity that will lead to a Europe entirely alien to its founding principles. Prime Minister Alexis Tsipras, Europe at Crossroads, Le Monde, May 31, 2015. High finance and democracy do not go well together. Irish voters rejected the Lisbon Treaty, and Icelandic voters responded with a resounding no in a referendum over whether to accept Gordon Brown's financial conditions. So Europe's central bankers were understandably fearful of giving Greeks a chance to vote against the bailout terms. A no vote would have posed at least a moral and hence perhaps even a legal ground to reject payment of government debts taken on in the face of strong popular rejection. Post-1980 politics from Greece to Ireland, Spain, Portugal, and Italy led parties calling themselves socialist and democratic, as well as Democrats in the United States, to put the interest of banks and bondholders above those of labor and deliver their constituencies to the financial class. Scaling back pensions and social spending while privatizing infrastructure monopolies reverses what socialism traditionally meant. The turnabout was strongest among Tony Blair's New Labour, and by the Greek PASOK socialists joining with the Conservative Party to impose austerity. In 2010 they agreed with German Chancellor Angela Merkel not to permit voter interference with the conditions laid down by the Troika for bailing out French, German and US banks at Greek taxpayer expense. PASOK initially proposed to put the Eurozone's austerity program to a public referendum, but Merkel insisted that this be cancelled when it became clear that Greek voters opposed the program's austerity conditions. The inevitable political reaction to Troika demands for austerity was pressure to reassert control over Greece's national budget and protect its resources. Seeing a policy gap that seemed unbridgeable, the press coined a new word, Greexit, for Greek exit from the euro. By ratifying the bailout's austerity conditions without giving voters a say, Prime Minister Papandreou and his PASOK party leaders destroyed themselves politically. Surrendering to a Baltic-type internal devaluation policy, they claimed that there was no alternative to lowering wage levels and employment. Papandreou himself has admitted we had no say in the economic measures thrust upon us, said one leftist in 2010 as the government was cutting back public spending. They were decided by the EU and IMF. We are now under foreign supervision and that raises questions about our economic, military, and political independence. Just as was feared, the Troika's loan terms made Greece's debt problems worse by stifling the economy. Capital flight increased, forcing Greek banks to reduce their credit lines to businesses, depriving them of the credit they needed to function and export. The ensuing downward spiral widened austerity rather than reducing Greece's budget deficit, the same result that austerity policies had been producing for half a century. Greece became a cruel experiment much like Latvia to test how far a population can be impoverished before protesting and saying, "Stop. There must be an alternative." Budget deficits of Greece's size obviously could not continue. But creditors rarely urge restoring balance by taxing the wealthy or having a central bank create the money for domestic spending, unless it is to give to financial institutions. They insisted that Greece balance its budget by selling public land, tourist sites, islands, ports, water and sewer facilities, and Aegean gas exploration rights. Selling assets is different from taxing rentiers and other well-to-do players. Asset sales do not reduce deficits, they merely finance them. They reflect the failure to tax wealth or create central bank money. The two leading Greek parties were unwilling to tax the elites or reverse the rampant corruption patronage. Such a failure indeed leaves no alternative but for the indebted economy to be carved up by its creditors. Democracy is junk. Papandreou had long advocated holding referendums on national policy. On June 12, 2008, prior to his election as Prime Minister, he had urged Greece to emulate Ireland and hold a referendum on whether to sign Europe's neoliberal Lisbon Treaty. After the Greek government passed the austerity bill surrendering to the Troika's bailout terms on October 20, 2011, he announced his intention to hold a consensus referendum on whether or not to accept the program. The Greek cabinet gave unanimous support on October 31, and a parliamentary vote was scheduled for November 4. Papandreou met with Merkel and Sarkozy in Cannes on November 1, just before the G20 meetings were to open 2 days later. Opinion polls showed that 2/3 of Greeks rejected the conditions attached to the bailout, but wanted to stay in the Eurozone. Demonstrations spread throughout Greece advocating a no vote. So the Germans and French tried to frame the issue in a narrow way designed to get a yes answer: did voters want to be part of Europe? The aim was to avoid asking the really important question, Did Greek voters want to impose a decade of depression on themselves, cut public services, impose anti-union labor reforms, and sell off the Athenian water supply, its port, their beautiful islands and their gas rights in the Aegean to Germans and other creditors? Papandreou probably expected that the threat to hold a referendum would strengthen his hand in preparation the G20 meetings and persuade the ECB to loosen its bailout terms. But Sarkozy and Merkel told him that the Troika would not release the €8 billion being held until it was clear that all the leading Greek parties gave assurances that they would pay according to the terms being laid down. The first bond payment was due in 7 weeks, on December 19. Merkel was reported to have said the aid tranche could only be disbursed once Greece has met all the conditions and there was a positive outcome of the Greek referendum. Finance Minister Schäuble cast the issue as follows: if Greece accepts the burden and efforts required by the aid programs, if it wants to stay within the Eurozone, then we will support it. Returning to Athens, Papandreou reversed his advocacy of a referendum. This is not a question of only a program, he announced, reframing the issue along Merkel-Sarkozy lines. This is a question of whether we want to remain in the Eurozone. Setting his sights on a parliamentary vote, Papandreou told his PASOK colleagues that there was no need for a referendum after the Conservative opposition promised to support the terms of a €130 billion bailout from the European Union, European Central Bank and International Monetary Fund. If we have consensus, then we don't need a referendum. Conservative leader Antonis Samaras chimed in to promise that he would do everything in his power to stop the referendum. These bipartisan statements calmed markets. Bond yields receded, stock prices rose and so did the euro's exchange rate against the dollar. But the machinations to cancel the debt referendum prompted an editorial in Germany's major newspaper, the Frankfurter Allgemeine Zeitung by Frank Schirmacher: "Democracy is junk. He who submits a vital issue to a referendum is a public menace to Europe." This has been the message from the markets and, from the politicians too. At stake was whether Greek politicians would cede economic planning to the EU bureaucracy. Germans had coined a word, ordoliberalism, to describe technocratic enforcement of stability administered from the top down. Geithner intervenes in Euro-Greek negotiations on behalf of US bank gambles. The explosion of global credit took the form of debts that far exceeded the ability to be paid. Bondholders, banks, and wealthy investors would lose from a Greek default, especially the major French and German banks. So would the US too big to fail banks that treated the Greek crisis as a financial sporting event, writing credit default swaps betting that Europe would lend Greece the money to pay. In October 2010, Treasury Secretary Geithner had insisted that the Europeans not write down Greece's debts, fearing that Ireland, Portugal, Spain, and Italy might demand similar treatment. In addition to threatening bank solvency throughout Europe, Wall Street had written so many credit default swaps that the US financial system might crash. Geithner threatened that this would bring down the European economy as well if the ECB did not insist on extracting payment in full. When the G20 meetings began on November 3, 2011 at Cannes, President Obama urged the European leaders to put more money into the European Financial Stability Fund so that it could lend Greece enough to save it from defaulting and incidentally permit US investment banks and speculators to win the bets they had made on Greek bonds. Matters focused on a technical issue: would a majority agreement among bondholders to write down Greek debt constitute a default? Standard & Poor's had cut Greece's credit rating by 2 notches in May 2011, on the assumption that even a voluntary write-down or extension of debt maturities on its 2010 bailout loans would likely constitute a distressed exchange, that is, a selective default. That meant that Wall Street and other banks that had written default insurance would be liable to pay the bondholders. This is what led President Obama to lobby Europe not to forgive Greek loans, but extend new credit to enable Greece pay the bondholders and enable US financial bookies to avoid having to pay off. At the Bochler Foundation's annual economic meeting in Berlin, and also in meetings in Frankfurt, in early November, I heard bankers and other attendees express shock at how US national policy was nakedly lobbying for Wall Street campaign contributors. One politician told me that President Obama had demonstrated to Europe that no matter who was president of the United States, no matter how high hopes might have seemed for a progressive solution, Europe could not depend on U.S. leadership. To protect U.S. banks that took AIG-type gambles by writing default insurance for bondholders of Greek debt, the ECB suggested euphemizing default as a voluntary renegotiation, asking banks and other bondholders to voluntarily write down the debt. But German politicians insisted that bondholders take a loss, especially in view of the steep interest rates that recent buyers of Greek bonds were receiving. Interest is supposed to compensate for risk, after all, but vulture investors were hoping for payment in full. The G20 meetings ended in disarray, unsure of how far Greece could be pushed. Greek politicians' rule against voters. Greece's coalition government feared that supporting austerity would drive voters into the arms of the newly formed anti-bailout Syriza coalition. A leading PASOK lawmaker quit the party, narrowing Papandreou's slim majority to 152 of 300 seats, and several others called for a government of national unity followed by a snap election, which the opposition also demanded. However, Papandreou warned, elections at this moment not only equal disaster but could not take place in the best interest of the people. He proposed, there is one solution, to support the EU bailout, deal with a multi-party approach, without elections, with a strong government. Needing 151 votes to accept the Eurozone's terms, Papandreou won the vote of confidence narrowly on November 4, 153 to 145, and then yielded to pressure from New Democracy in Laos, and resigned halfway through his scheduled four-year term. Greece's third-largest party was Aleka Paparigia's Communists, with 21 seats. Along with Alexis Tsiprasa's Syriza, 9 seats, they opposed the austerity measures and called for elections. Seeing that PASOK had lost its constituency, the New Democrats supported their call, as did the Conservatives. It took 4 days of bargaining between Papandreou's divided PASOK, Antonis Samaris's New Democracy Conservatives and the hard-right Popular Orthodox Party, known as Laos, to agree on how to avoid being blamed for accepting the ECB's austerity program. They announced jointly on November 5, 2011, that there was no alternative but to form a non-partisan caretaker government to implement the €130 billion, $177 billion, bailout plan agreed to at the October 27 Brussels summit. Samaris said that in view of ECB insistence that Greece show a clear mandate accepting the bailout terms, an immediate new election was needed to secure a €8 billion loan tranche in mid-December and avoid default. On November 11, Papandreou turned over the post of Prime Minister to his economic advisor, Lucas Papademos, the same man who had spent his last 2 years at Greece's central bank, 2001-02, arranging the notorious Goldman Sachs debt swap that had concealed the government's actual position for Greece's transition from the drachma to the euro. His success helped elevate him to the post of vice president of the ECB from 2002 to 2010, so his appointment to head the coalition government was obviously to administer Greek submission to the bailout's conditions. Praised in the financial press as a non-political personality with a strong economic background, meaning pro-financial and anti-labor, Papademos warned Parliament that rejecting the Eurozone's bailout terms would be a catastrophe, and urged it to give him a mandate for austerity. He won a vote of confidence on November 16 to negotiate the terms that Greece would have to follow to obtain the loans to bail out its bondholders. A furor erupted when the Financial Times published a 10-page EU-IMF list of prior actions that Greece would be required to take. The terms started with a right-to-work law opening up closed unionized professions in education, construction, and public companies scheduled to be privatized so as to make them more attractive to prospective buyers. Greece also was told to cut 150,000 more government jobs over the next 3 years, especially in healthcare and pensions. The already low €750 monthly minimum wage would have to be reduced, and the annual 2-month salary bonus for private sector workers eliminated. Reminiscent of foreign creditors taking control of Latin American customs houses in the 19th century, Germany called for tax revenue to be put into a special fund giving priority to holders of the new bailout bonds. Athens would only be allowed to spend on the normal functioning of its government after servicing its debt. A Eurozone budget commissioner would be empowered to oversee the Greek parliament and veto spending that might divert tax revenue away from bondholders. To cap matters, the IMF and ECB would withhold future bailout tranches if Greece procrastinated on privatizing key assets. To give the impression that this was being negotiated with some quid pro quo, the ECB offered to relinquish the price gains it had made when it bought €40 billion in Greek government bonds at steep discounts from their face value of about €55 billion. By reducing the risk of non-payment, the ECB had ended up with a windfall, as had many speculators. To alleviate some of the debt burden, the ECB would lend Greece money to purchase and retire the bonds at the low price the ECB had paid. This saved Greece about €15 billion. But it was merely a drop in the bucket compared to the devastation the Greek economy would soon be made to suffer after Parliament passed the economy-wide austerity plan on February 12 to 13, 2012, despite public protests. The problem, of course, is that the neoliberal economists who created the ECB had tied its hands deliberately to prevent the bank from lending to governments. It was set up only to extract revenue from governments, the opposite of a real central bank. Privatizing assets when IMF forecasts of austerity's success fail to materialize, when the myth that austerity will create a budget surplus fails, bankers promote the follow-up myth that the only way to pay bondholders is a mass forfeiture of assets. The ECB and EU Commission accordingly demanded privatizations to finance Greece's budget deficit. Greece is for sale cheap and Germany is buying, reported the Wall Street Journal. German companies are hunting for bargains in Greece as the debt-stricken government moves to sell state-owned assets to stabilize the country's finances. The paper published an op-ed suggesting that Greek bonds be backed by real Greek assets, on which bondholders could foreclose directly if the government missed a payment. "I'm convinced that the only way out of Europe's financial crisis is for Germany to essentially own Greece," suggested hedge fund manager Andy Kessler. "In this case, you would convert Greek debt, denominated in euros, into long-term German bonds backed partially by the good faith of the German government but also backed by Greek assets, utilities, railroads, tollways, airports, cell phone services, tourism, ouzo factories and maybe even the islands of Santorini and Mykonos. If, some say when, the Greeks default, the Germans or new bondholders end up with the assets, much like in a home foreclosure. The new owners would then go in and rationalize each business and fire whom they must to make each enterprise profitable, in private versus public hands. This is an old trick of US manufacturers: sell an old factory to someone else and have new, unknown owners fire the workers. Deutsche Telekom announced its intention to pay €400 million, about $590 million, to raise its stake in Hellenic Telecommunications to 40%, an additional 10% over what it already held, promising to cut labor costs. A European Commission report provided a list of state-owned enterprises slated for privatization, including Energy Public Gas Utilities, DEPA and DESFA, Hellenic Petroleum, HELP, Water Thessaloniki Water, IATH, Athens Water, EDAP, Transport Athens Airport, AIA, Regional Airports, Railways, Trains, Postal Services Hellenic Post, ELTA, Arms Manufacturing Hellenic Defense Systems, EAS. There will also be concessions to manage public assets awarded to private sector companies including Hellenic Motorways, the State Lottery, regional airports and large regional ports. Europe's war against debtor countries was turning into class war, which always ends up being waged on the political battlefield. One financial analyst noted that the money raised for putting up islands and public buildings, ports and the water system for sale will barely put a dent in Greece's now unpayable public debt. Creditors simply hoped to take as much as they could, in the absence of public protests to stop the sell-offs. That is why bankers resort to anti-democratic methods in opposing any political power independent of creditor interests. The aim is to centralize financial policy in the hands of technocrats drawn from the banking sector, not only Loukas Papademos in Greece, but also Mario Monti in Italy almost simultaneously, as described in the next chapter. The fear is that democratically elected officials will act irresponsibly, that is, in the interests of the economy at large rather than catering to the demands of banks and bondholders. The IMF's role in Greece's bondholder bailout prompts a German constitutional crisis. Opposition to a true central bank to monetize public budget deficits is based on the fantasy that this would cause hyperinflation, such as the Weimar Republic suffered in the early 1920s. The reality is that nearly all hyperinflations result from paying foreign debt. The highly political effect of a hard money policy blocking central banks from financing budget deficits is to leave credit and money creation for private bankers. Lacking central banks to monetize public spending, Eurozone governments must borrow from bankers and bond investors. Neither the ECB nor the IMF lend to fund domestic budget deficits. The IMF lends mainly to support exchange rates. But Greece's public debt did not pose a devaluation problem, because it was denominated in euros. This limitation prompted Germany to accuse the IMF and ECB of illegally overstepping their original purpose, citing the IMF's Articles of Agreement. A member state may obtain IMF credits only on the condition that it has a need to make the purchase because of its balance of payments or its reserve position or developments in its reserves. Greece, Ireland, and Portugal are certainly not short of foreign exchange reserves. The IMF is lending because of budgetary problems, and that is not what it is supposed to do. The Deutsche Bundesbank made this point very clear in its monthly report of March 2010. Any financial contribution by the IMF to solve problems that do not imply a need for foreign currency, such as the direct financing of budget deficits, would be incompatible with its monetary mandate. The ECB also aims at saving the banks, which requires bailing out the governments whose bonds they hold. A Greek default would plunge the country's largest banks, the major domestic holders of Greek bonds, into negative equity. But Germany's Constitutional Verfassungsgericht Court has rejected fiscal union and a common Europe-wide budget to be financed by the ECB acting as a true central bank creating money for public spending. The constitutional problem concerns how to allocate among Eurozone members the cost of funding governments and, behind them, banks and other bondholders. If the ECB does not simply create money like the Federal Reserve does, some countries' government, taxpayers, must bear the cost. Germany is unwilling to subsidize other Eurozone countries. That is why former Bundesbank head Karl Otto Pohl told Der Spiegel that against all its vows, and against an explicit ban within its own constitution, the ECB has become involved in financing states, despite the fact that the EU treaty explicitly states that no country is liable for the debts of any other. This is not the social democratic authority that European reformers dreamed of after World War II. It is antithetical to a united Europe empowered to set a common budget, a uniform tax code and financial regulations applying to all member countries. Lacking political and fiscal union, all that is left is a free trade and immigration zone whose financial policy is dictated by creditors, mainly German. Seeing economic planning shifted into the hands of proconsuls empowered to overrule parliaments to channel tax policy to bail out bankers and bondholders instead of promoting growth and employment, Greek voters rejected the Conservatives along with the socialist PASOK in 2014. Both had fatally accepted the EU conditionalities. Greek voters finally got over their fear of confronting European bankers, electing the Syriza coalition in January 2015 to carry out its pledge to reject the bailout's demands for debt servitude and privatization. 23 High Finance installs technocrats as proconsuls. Europe's elites are behaving today as if they understand neither the nature of the crisis that they are presiding over, nor its implications for the future of European civilization. Atavistically, they are choosing to plunder the diminishing stocks of the weak and the dispossessed in order to plug the gaping holes of the financial sector, refusing to come to terms with the unsustainability of the task. Things could get worse in perpetuity, without ever getting better. Yanis Varoufakis, How I Became an Erratic Marxist, The Guardian, February 18, 2015. When former Finance Minister Evangelos Venizelos became PASOK's leader after Papandreou stepped down in 2011, one of his first actions was to declare an amnesty for the tax evaders responsible for much of the budget deficit. As finance minister, he already had shepherded through a tax law in 2011 reducing the property tax by 60% for properties larger than 2,000 square meters, about 21,000 square feet. Mr. Venizelos thus carved out a big exemption for the only people who could afford to pay the tax, the rich. The evidence was visible in the mansions and swimming pools. This was Pasik's travesty of socialism. Hope for a Europe-wide reform had been a great attraction of European unification. Many Greeks felt that perhaps the crisis would be worth it if the foreign technicians would come and help enforce an honest tax system to clean up the corrupt insider dealing. But Venizelos managed to lose the Lagarde list given to him in 2010, naming roughly 2,000 Greek citizens with Swiss bank accounts, including officials with offshore companies, friends and relatives of government ministers, bankers, publishers and those involved in the black market. French prosecutor Eva Joly, whom Iceland's government had retained to clean up its corrupt banks, pointed out, "We know there are 120 billion belonging to the Greeks in Switzerland. This is money that of course is exempted from taxation. If you tax the 120 billion by 40%, you'll find 48 billion. That would have sufficed to pay Greece's foreign debt." But nothing was done, except to arrest Mr. Vaxivanis, who published the list, charging him with invasion of privacy. Instead of helping Greece sequester these funds and stem tax evasion, ECB and EC negotiators demanded that parliamentary leaders pledge not to interfere with capital flight, free movement of capital, and to make labor, taxpayers, pay the national debt. The austerity program of February-March 2012. Matters came to a head on February 9, 2012. The three coalition party leaders agreed to cut public sector jobs, lower the minimum wage by 22%, amputate pensions by 15%, permit new owners to fire employees at will, and reduce 2012 budgetary spending by €325 million. The excuse was that these growth-enhancing structural reforms would promote employment. The actual result was to increase unemployment to 21% of the labor force, and nearly 50% for new entrants 15 to 24 years old. On February 12, Parliament passed the austerity package by a vote of 199 to 74. Tens of thousands of protesters demonstrated in Syntagma Square chanting "Thieves, thieves!" 5 banks and many other buildings were burned and shops on major streets were looted, prompting 4,000 riot police to fire tear gas into the crowd. Laos, the coalition's third party, withdrew its 16 legislators from the government prior to the vote, hoping to gain support in the coming elections against Pasik and the Conservatives. Laos expelled the 2 members who voted for the bailout, while the 2 coalition parties expelled 43 deputies who did not vote for the bill. 6 cabinet ministers and undersecretaries resigned in protest. "Tonight we're deciding our destiny for the next decade," Pasik leader Venizelos announced. He expedited parliamentary rules to restrict debate on the new measures to a single 10-hour session. So that, the financial and banking markets have got the message. Papandreou's endorsement of austerity did not deter the world's Social Democratic and Labour parties from unanimously electing him for a second term as head of the Socialist International that year. But the fears of Pasik defectors proved right. Trying to pay the Troika has plunged the country into a deeper depression than that of the 1930s. Pasik received only 13% of the vote in the May election, drifting down to 12% in the June runoff, down from its former 44%. In 2015 it won only 4.7%, 7th and last among the recognized parties. Fearing that Greece might not commit the economic suicide its politicians promised to impose, ECB negotiators made the surrender ironclad. The February 20 deal listed 24 prior actions that Greece must complete by the end of the month, before aid is released. To prevent the election scheduled for April 2012 from reversing the agreement that they had reached with the leading politicians, EU negotiators insisted that all parties commit themselves again to support the deal. They also demanded faster privatizations. Pasik and New Democracy signed the pledge to obey the bailout terms regardless of the election results. This prompted the columnist Wolfgang Munchau to show righteous indignation akin to Schirmacher's "Democracy is junk" protest, when Wolfgang Schäuble proposed that Greece should postpone its elections as a condition for further help. I knew that the game would soon be up. We are at the point where success is no longer compatible with democracy. The German finance minister wants to prevent a wrong democratic choice. Similar to this is the suggestion to let the elections go ahead, but to have a grand coalition irrespective of the outcome. Clearly the most extreme proposal is to suspend the elections and keep the technical government of Lucas Papademos in place for much longer. Most economic journalists saw what the demonstrators realized: austerity would drive the economy deeper into debt and make the budget deficit worse. Wow, this is what debt slavery looks like on a national level, wrote Eve Smith, editor of the economic blog Naked Capitalism. Greece looks on its way to be under the boot of bankers, just as formerly free small southern farmers were turned into debt croppers after the U.S. Civil War. The Euro's design for turning democracy into financial oligarchy, Greece's economic problem and that of other southern Eurozone members, stems from the way in which the Euro was created in 1999, without a real central bank or European-wide tax policy. The original ideal of European Union was to end the continent's long history of military conflict. That has been achieved, save for Serbia and Ukraine. But the essence of any state consists of three powers: to issue its own money, to levy taxes, and to declare war. A real United States of Europe would have a real central bank to monetize budget deficits, spending the money into the economy in the same way that the US and other governments do. Lack of a public money-creating institution means that budget deficits must be financed by bondholders, and new credit creation by bankers. That means rising debt, whose carrying charges lead to austerity and force recourse to the IMF and ECB acting on behalf of high finance. That is where Europe got off on the wrong track when it created the euro in 1999. Governments cannot create money or levy economy-wide taxes without a parliament empowered to tax one state to spend in others. Europe was not yet ready for such a union. Instead of empowering a parliament to levy continent-wide taxes and spend them where most needed, the EU constitution states that no country's citizens can be taxed to benefit others. Germany and the northern European countries are not obliged to finance Portugal, Ireland, Italy, Greece, or Spain. It is as if the United States could not tax New York and other prosperous eastern states to develop the West and South, but required each state to finance its own growth out of its own tax revenue or bond issues. The Eurozone limited its central bank to creating money only to lend to commercial banks. This meant starting the Eurozone with a financial system controlled by banks and bondholders. Privatizing the privilege of money creation traditionally held by the state, the EU blocks financing budget deficits by public money creation. A real central bank could create its own money as an alternative to taxation, as the US Federal Reserve and Bank of England do. But no such Eurozone institution exists, thanks to banks lobbying that only they should create money and credit. A non-political central bank is an oxymoron. The putative father of the euro, economist Robert Mundell, is reported to have explained to one of his University of Chicago students, Greg Palast, the euro is the way in which Congresses and parliaments can be stripped of all power over monetary and fiscal policy. Bothersome democracy is removed from the economic system. This ideology threatens to turn democracies into oligarchies by locking in a bank-run economy. Viewing government money creation as inherently inflationary, it insists that credit should be kept tightly under commercial bank control. Mundell's idea of fighting inflation was to untax the wealthy, on the pretense that they will invest their income productively as job creators, not destroyers. Also, Mundell, the ECB and IMF aim at reducing the power of labor unions so as to minimize wages, as if this does not also shrink the domestic markets, leading to deeper budget deficits. The euro and the ECB were designed in a way that blocks government money creation for any purpose other than to support the banks and bondholders. Their monetary and fiscal straitjacket obliges the Eurozone economies to rely on bank creation of credit and debt. The financial sector takes over the role of economic planner, putting its technicians in charge of monetary and fiscal policy without democratic voice or referendums over debt and tax policies. Blocking governments from financing public deficits by central bank money creation obliges them to borrow from bondholders. Interest payments absorb a rising proportion of public budgets, leading to bondholder demands to cut back pensions, social security, medical care and other social programs. This ideology of fiscal austerity is the essence of today's rentier war to create financialized New Europe. So here is the conundrum: monetary union was supposed to be a first step toward political union. But its pro-bank bias threatens to break up the EU by forcing Greece and other debt-strapped economies to withdraw. No sovereign nation can be obliged to suffer debt deflation, fiscal deflation, and a steady drain of its population through emigration, shortening lifespans and declining health standards such as have plagued Greece under the Troika's austerity demands. This is the context that has led Syriza Finance Minister Yanis Varoufakis to explain that his aim is not merely to save Greece from impoverishment, but to save Europe by reviving the idea that governments should promote labor and industry, not rentiers. It means public control over banking and credit, tax, and regulatory policy. Instead, the EU's administrative power has been used to block public spending, impose fiscal and financial austerity and support financial oligarchy. Historian Perry Anderson describes how different this is from what was promised when the European Economic Community was created in 1957. Referendums are regularly overturned, if they cross the will of rulers. Voters whose views are scorned by elites shun the assembly that nominally represents them, turnout falling with each successive election. Bureaucrats who have never been elected police the budgets of national parliaments dispossessed even of spending powers. Parties lose members, voters lose belief that they count, as political choices narrow and promises of difference on the hustings dwindle or vanish in office. Financial vultures redefine human rights. Seeing an opportunity to make a killing on steeply discounted Greek bonds as the country's financial position weakened early in 2012, vulture funds mounted a radical legal challenge when Greece proposed a law forcing private sector bondholders to take losses. Their lawyers claimed that if investors receive less than they are owed, that could be viewed as a property rights violation, and in Europe, property rights are human rights. Demanding payment of full face value for bonds bought at a fraction of that amount, they prepared to sue Greece in the European Court of Human Rights. The aim was to redefine human rights to mean the right of creditors to expropriate public assets and reduce debtor country populations to bondage. Public spending to provide jobs at a living wage was to take second place to creditor rights to seize government assets and tie them up in courts for years in lawsuits. To counter bondholder claims in the Court of Human Rights that their property rights had been violated, Greece obtained Eurozone support to impose settlement terms on all investors by writing collective action clauses (CACs) into the contracts of its old bonds. The aim was to prompt the 10 to 15% of bondholders who were holdouts to exchange their old bonds for new bonds, preferring the new discounted bonds to their old ones, which may become worthless. But bondholders ganged up to promote their right to block any international forum empowered to bring debts in line with the ability to pay, thereby violating property rights to seize the property of debtors. What Greece lost by the bailout on February 21, 2012, the IMF and ECB agreed to provide Greece's government with a €130 billion, $171 billion, line of credit, in time to meet €14 billion of payments falling due on March 20. They pressed for investor agreement to reduce the nominal debt, which bond markets already had written down to 1/5 of its face value, to a sustainable 120% of GDP by 2020. The face value of Greek bonds was cut in half and swapped for new bonds yielding a lower interest rate, but reflecting more creditor-oriented terms. Earlier bonds had been issued under Greek rules. As a sovereign nation it could have changed their terms. That is what makes a nation sovereign. If Greece had left the Eurozone and replaced the euro with drachmas, it could have redenominated its bonds in depreciated currency, or written down debts to only a fraction of their face value, reflecting the steep market discounts at the time. To block these options, bondholders insisted on replacing the old bonds with ones issued under London rules specifying that if Greece left the Eurozone, its bonds would still be owed in the euros in which they were issued. Drachma payments thus would rise in proportion to the degree of currency depreciation. Greece also capitulated to German demands that it earmark tax revenue in a segregated account to pay bondholders. When Greece received the €130 billion bailout on March 13, with €28 billion coming from the IMF, markets priced the new bonds at only over a quarter of their face value to yield 13.57%, nearly 4 times the 3.65% coupon, a distress level that indicated expectation that Greece ultimately would have to default. Venizelos told reporters that the holdouts were naive in thinking they would be paid in full. But the International Swaps and Derivatives Association, ISDA, did not declare a formal default, because no bondholder had actually suffered a haircut. More than 85% of bondholders agreed to the swap. Despite being the largest sovereign bailout in history, the Greek refinancing made hardly a ripple in financial markets. Most investors had long since sold out, and recent buyers did quite well. But some 5.3% of bondholders elected not to participate in the refinancing, trying to force the government to make the swap compulsory by obliging agreement by an 85% majority of bondholders. This ploy enabled holdouts to collect on credit default swaps, CDs. According to ISDA's credit derivatives definitions, CDs can be triggered if a debt restructuring is agreed between a governmental authority and a sufficient number of holders of such obligation to bind all holders, making it mandatory. Getting the ISDA to classify the bond swap as a credit event enabled holdouts to collect default insurance from their counterparties. The auction's outcome meant that sellers of the $3.2 billion in outstanding swaps will pay $2.5 billion in compensation to buyers. The amount was small relative to the overall debt swap, because the price of default insurance was so steep that investment banks writing the CDs did not have to take much of a loss. The main losers were the Greek banks and pension funds that had bought the bonds at early prices. The Greek government and its taxpayers ended up in a similar position to that of Ireland, owing debts to the IMF and ECB, to which it is much harder to cancel or renegotiate debts than is the case with private bondholders. The aftermath: a general election was held on May 6, 2012. It was the first opportunity voters had to throw out the governing PASOK party. But both leading parties had agreed to adhere to the loans conditions regardless of the election results. Warning voters that rejecting the bailout would mean leaving the Eurozone enabled New Democracy to narrowly beat Syriza's newly formed anti-austerity coalition, 19% to 17%. A runoff was scheduled for Sunday, June 17. New Democracy again won narrowly with 29.7%, over Syriza's 26.9%, by frightening voters that if Greece rejected the austerity conditions, it would have to leave the Eurozone. The party's leader, Antonis Samaras, formed the usual coalition government with PASOK. Having pledged not to reduce the minimum wage by 22%, Samaras made an about-face and wrote a letter to the EU leaders affirming that his government was fully committed to enforcing the program, its targets, its objectives, and all its key policies as agreed with ECB negotiators in February. Almost immediately, on June 21, the Democratic Left, DIMAR, which an exodus of anti-austerity PASOK politicians had joined on March 22, withdrew from the coalition, leaving the government with a razor-thin majority of 153 out of 300. That was enough to approve new austerity measures on July 17, laying off thousands of workers and cutting wages in the public sector. Privatizations lagged, largely because the EU bureaucracy yielded to US pressure against Russia. The gas agency DEPA was supposed to account for half the stipulated €2.6 billion of Greek asset sales in 2013. Negotiations seemed to be bearing fruit with Gazprom, in which Russia's government owns a controlling 50.1% share. But EU officials opposed the purchase, fearing Moscow's already tight grip on the European market, and warned Gazprom not to proceed with an offer. Privatization was to be only for US and European buyers. The Greek economy was subjected to even more austerity, because the bailout deal with Europe specified that any slippage in meeting the privatization revenue targets must be 50% covered by additional spending cuts. Greece's economic collapse continued unabated. Its debt rose to 175% of GDP by spring 2014, so that paying interest to bondholders absorbed 6.5% of GDP, the 3.75% interest coupon x 1.75. Unemployment rose to 27%, and over 50% for young job seekers. Despite wages declining by about a third, the government announced plans to lay off 15,000 public sector workers and shift another 10,000 to other jobs to drive them down further. Future Syriza Finance Minister Varoufakis described the Troika's approach as being to extend and pretend by having the Eurozone's surplus nations pile huge new loans on the insolvent deficit states on condition that the latter agreed to reduce their national incomes. This led to yet more debt, requiring yet more privatizations to pay it off. Voters reject socialist conservative austerity. Voters in Greece's May 2014 local elections started to turn toward Syriza, which pledged to reject this austerity policy. The next month Greece's highest court ruled that the wage cuts imposed 2 years earlier, in February 2012 on police officers, firefighters, and military personnel under a sweeping austerity plan were unconstitutional. Pending cases are questioning whether wage cuts imposed by the Troika violated the constitution. This ruling led to legal claims against the government for up to €300 million in restitution for cleaning workers, police officers, university professors, and other professions. The mounting pile of judgments has now become a serious obstacle to the austerity drive of Prime Minister Antonis Samaras, with the International Monetary Fund warning this week that the adverse court rulings threaten to undo the country's reforms. Besides potentially having to reverse many of its public sector layoffs, Greece could be obliged to scramble for €1 billion, about $1.35 billion, in back pay. But the damage was done. The EU had broken the Greek economy. Property taxes had increased sevenfold, and Eurostat reported that unemployment reached 27.8% by winter 2013, and over 59% for youth. Consumer spending was down 7%, while U.S. hedge funds were buying strapped Greek banks to take over the financial system. Deepening discontent forced a new parliamentary election on January 25, 2015. European Commissioner Jean-Claude Juncker demonized Syriza's logic as extreme and warned Greek voters not to support the wrong outcome. But resentment against the traditional parties enabled Syriza to win over 36% of the votes, for 149 seats in the 300-member parliament. Greek law awards 50 extra seats to the winning party, so this was only 2 seats short of a majority, which Syriza achieved by working with another opponent of Eurozone austerity, the nationalist ANEL party. In his post-election victory address, Syriza leader Alexis Tsipras claimed that Greece was not obliged to enact the austerity measures or pay the Troika the roughly $270 billion that former politicians had promised. The Troika is dead, he announced, and threw down the gauntlet by appointing Varoufakis finance minister. Claiming that his financial program aimed to save not only Greece but all Europe from neoliberals, Varoufakis described the Troika's visiting oversight teams as clueless political personnel, in denial of the systemic nature of the crisis, is pursuing policies akin to carpet bombing the economy of proud European nations in order to save them. The Financial Times was supportive of Greece's need to make a fresh start than were many socialist parties. An editorial noted that Mr. Varoufakis may be right to query the technical expertise of the Troika. The IMF has already admitted to having been too optimistic about Greek growth. More debt should have been restructured. But what matters more to the reform of the economy is the continuing dominance of an oligarchic class. This includes a banking sector with over 40% of loans non-performing, according to the IMF, which drags on industry. A vigorous recovery may require a thorough banking recapitalization that converts debt into equity and replaces management. Under the Troika's tutelage, very little was done to confront the oligarchs, or to tackle endemic tax avoidance. Isolating Greece to deter emulation, contagion, of debt write-downs to financial interests, austerity's proven failure to revive growth doesn't matter. Their aim is extractive, and they are determined that Syriza not provide a viable alternative. When Varoufakis asked one European commissioner in 2012 why he insisted on raising taxes when the Troika's own models showed that this would worsen the downturn, he was told that austerity was the only way of demonstrating to Italy our resolve to be tough on their people if they fail to tighten their budget. Realism is the greatest challenge to neoliberal austerity, and pro-austerity regimes in Spain, Ireland, and Portugal fear that Syriza's success would spread a more realistic body of economics. Regimes holding power in these countries demanded a hard line to make Greece an object lesson to deter emulators such as Podemos in Spain, which mobilized a revolt of the indignant movement, and Italian parties vied to replace the ruling coalitions in which both left and right politicians supported neoliberal policies. Speaking to his party members on February 28, Tsipras said, Spain and Portugal formed an axis of powers which had attempted to scupper Greece's recent debt negotiations with the rest of the EU. Their plan was, and is, to bring down our government and to bring it to an unconditional defeat before our work begins to bear fruit, he said, suggesting that Spain, in particular, feared the rise of its own anti-austerity left. Leaving the euro threatens an interim of anarchy, but so do EU demands for austerity and privatization. The problem isn't simply that the Troika wants Greece to balance its budget. Europe's finance ministers want Greece to do so in a way that imposes austerity to lower wages, not by taxing the rich. Varoufakis has decried the fact that the formerly left-wing parties have let themselves be co-opted to limit democratic politics to innocuous social lifestyle choices that do not threaten financial interests, while accepting austerity leading to perpetual fiscal emergency and debt serfdom. The great objective behind 19th-century liberalism, he wrote, was, as Marx never tired of pointing out, to separate the economic sphere from the political sphere and to confine politics to the latter while leaving the economic sphere to capital. The financial sector's strategy is to distract voters from understanding how the buildup of debt claims shrinks the economy's ability to pay. Without knowledge of the alternative tax and financial policies available, rentier interests will be able to maintain control over tax policy and central bank money creation. Their great fear is democratic control by the 99% acting in its own interest to legislate debt write-downs, progressive taxation, and a reversal of privatization sell-offs. In other words, to understand that there is an alternative. 24. The Troika's road to debt serfdom. What's so pernicious about the morality of debt, the way that financial imperatives constantly try to reduce us all, despite ourselves, to the equivalent of pillagers, eyeing the world simply for what can be turned into money and then tell us that it's only those who are willing to see the world as pillagers who deserve access to the resources required to pursue anything in life other than money. David Graeber, Debt, the First 5,000 Years. The IMF's Articles of Agreement forbid it to make loans to countries that clearly cannot pay. There is no realistic model by which Greece can pay back the loans from the IMF and European Central Bank. As discussed in Chapter 22, IMF staff economists sought in 2012 to break from the ECB and EU Commission. Noting the depth of anger amongst IMF officials against Germany, Frankfurt, and Brussels, that is, against being tied to the ECB's pro-bondholder lobbying, Varoufakis reported that in February 2013 one IMF economist put it to me in no uncertain terms, the Europeans forced us into a program for Greece that sullied the IMF's image. Former Mexican Finance Minister Guillermo Ortiz warned that the IMF was in danger of losing its credibility and independence by indulging in the same illusory debt arithmetic that has been causing economic disaster for half a century if it endorsed the even more austerity-prone ECB. Austerity worsens budget deficits and raises the ratio of public debt to GDP, he explained, making it highly improbable that the measures announced last week will cut Greece's debt servicing cost by a sufficient amount to meet the new target of 124% or debt to GDP by 2020, as the recession is likely to deepen. During the Latin American lost decade, the region's debt profile deteriorated continually as the fund failed to address the issue of insolvency and treated the problem as one of illiquidity. Every year the IMF would project gross domestic product to rise and debt to GDP ratios to fall, sustaining the illusion that these countries were not fundamentally insolvent. Every year the opposite occurred. The Wall Street Journal revealed a 50-page internal IMF document acknowledging that in making its $47 billion loan to Greece the largest in its history, the IMF had badly underestimated the damage that its prescriptions of austerity would do to Greece's economy. Blaming pressure from Eurozone countries protecting their own banks that held too much Greek government debt, the IMF document admitted that Greece's debt level remained undented, but it was now owed to the IMF and Eurozone taxpayers instead of banks and hedge funds. The IMF also said its own analysis of the future development of debt was wrong by a large margin. The IMF had originally projected Greece would lose 5.5% of its economic output between 2009 and 2012. The country has lost 17% in real gross domestic output instead. The plan predicted a 15% unemployment rate in 2012. It was 25%. The IMF's own published review of Greece acknowledged the finding that the SBA-supported program had made overly optimistic assumptions, including about growth. Financial Times columnist Wolfgang Muncha described this document as an outcry against the Eurozone consensus that austerity would promote growth. But instead of blaming the neoliberal model for the Greek disaster, the IMF tepidly wrote, some considered that to be the case only with the benefit of hindsight. This was the excuse that US and British bankers used in claiming that nobody could have seen the financial crash coming. Recognition of austerity's destructive consequences erupted at the IMF's annual meeting in Washington in October 2013. One official called its debt sustainability analysis a joke. A European Commission official described it a fairy tale to put children to sleep, and a Greek finance ministry official said it was scientifically ridiculous. Staff members accused the IMF of violating its rules by making bad loans to states unable to repay their debts, simply to pay bankers and bondholders. Antonio Borges, a former European director at the IMF, told the Wall Street Journal reporter the preceding June. The divorce between Europe and the IMF is real. Nonetheless, it remained questionable whether the IMF would change its policies. Incoming IMF head Christine Lagarde, Varoufakis wrote, was adopting a pattern first displayed by her predecessor, disagree with Europe's analysis and policies but, at the crucial moment, back down and legitimize these policies through complicity. Lagarde indeed showed how incorrigible the IMF was by saying that it would do the same thing again, even with hindsight. The ECB and BIS demand austerity, not central bank financing. IMF and EU austerity philosophy has been tunnel-visioned in acting as if that the way to spur economic growth is to unemploy labor, lower its wages, scale back pensions and health care, and sell off monopolies to rent-seeking predators. The effect is to shrink economies, not help them recover. The austerity programs that used to be imposed mainly on third world countries are now being applied to Europe to squeeze out tribute. As W.C. Fields replied in My Little Chickadee when asked if the card game was a fair game of chance, not the way I play it, no. By earmarking tax proceeds to pay creditors instead of revive the economy, the ECB seemed to violate the Lisbon Treaty's Article 127, Clause 5, obliging it to contribute to the stability of the financial system. Austerity creates unemployment, instability, and even less ability to pay. Evidently, stability is just a euphemism for keeping bond prices high, as if the sky will fall if bondholders take a loss. And instead of internal devaluation, lowering wages by increasing unemployment, making economies more competitive by reducing production costs, financialization siphons off wage income and hence shrinks markets. This lowers profits, deterring companies from investing and expanding, and this economic shrinkage worsens the government's budget deficit. Ponzi austerity. Before taking over as finance minister to extricate Greece from its debt trap, Varoufakis defined the problem as Ponzi austerity. Neoliberalized governments lower domestic income by enough to pay the European Central Bank, IMF, and bondholders. But imposing austerity shrinks the economy, making it even harder to produce a surplus to pay. Ponzi austerity schemes, just like Ponzi growth schemes, necessitate a constant influx of new capital to support the illusion that bankruptcy has been averted. The Troika's extend and pretend policy gave an illusion of viability by lending debtor countries enough to pay exponentially growing debts to bondholders. The ECB allowed the Greek government to issue worthless EIS, or, more precisely, short-term treasury bills, that no private investor would touch, and pass them on to the insolvent Greek banks. The insolvent Greek banks then handed over these EIS to the European system of central banks, as collateral in exchange for loans that the banks then gave back to the Greek government so that Athens could repay the ECB. If this sounds like a Ponzi scheme, it is because it is the mother of all Ponzi schemes. A merry-go-around of Ponzi austerity which, interestingly, left both the insolvent banks and the insolvent Greek state a little more insolvent while, all along, the population was sinking into deeper and deeper despair. Ponzi growth based on steadily increasing credit must end in a crash. Athens finally will have to default on the bonds that the ECB owned, Varoufakis concluded. But this was something that Frankfurt and Berlin considered unacceptable. The Greek state could default against Greek and non-Greek citizens, pension funds, banks even, but its debts to the ECB were sacrosanct. Pretending that exponentially rising debts can be paid by imposing deepening austerity is leading to clashes in Spain and Italy over whether to be ruled by constitutional democracy or by central planning by foreign creditors who define what is best for indebted economies simply by what is best for themselves. They are unwilling to relinquish tax and regulatory power or money creation to democratic control, fearing that this may lead to debt write-downs, taxation of rentier wealth and reversals of privatization. Ideally, a fair and equitable society would regulate debt in line with the ability to be paid without pushing economies into depression. But when shrinking markets deepen fiscal deficits, creditors demand that governments balance their budgets by selling public monopolies. Once the land, water, and mineral rights are privatized, along with transportation, communications, lotteries, and other monopolies, the next aim is to block governments from regulating their prices or taxing financial and rentier wealth. The neo-rentier objective is threefold: to reduce economies to debt dependency, to transfer public utilities into creditor hands, and then to create a rent-extracting tollbooth economy. The financial objective is to block governments from writing down debts when bankers and bondholders overlend. Taken together, these policies create a one-sided freedom for rentiers to create a travesty of the classical Adam Smith view of free markets. It is a freedom to reduce the indebted majority to a state of deepening dependency, and to gain wealth by stripping public assets built up over the centuries. Fictitious economic models as tactics of deception in place of classical political economy. Today's foundation myth is that all income and wealth is earned productively as if there were no economic rent, unearned income, as a legacy of feudalism's rentier privileges, and no inherited wealth or insider giveaways. Yet these have been the shaping forces of history. That is why they were the focal point of classical political economy to free society from such privileges and bias. A society's analytic concepts determine the kind of reality it creates. That is why parasites start by taking control of their host's brain. Neoliberal enzymes aim to sedate the industrial host into believing that the financial sector is part of the real economy, not external to it and extractive. That is the first myth. Modern national income and GDP accounting formats treat tollbooth systems and other rent-seeking as output. Bankers claim to obtain their salaries and bonuses by creating wealth, adding to GDP. But they demand to be rescued by taxpayer bailouts, or new central bank money creation, when the bubble that they finance bursts, dispelling the economic fictions they have created. The service that bankers claim to provide managing the economy's money in ways that increase prosperity turns out to be a neo-rentier economy based on unearned wealth and income. A second myth is that all debts can be paid without deranging social values and polarizing economies by transferring property to creditors. This fiction is maintained by denying the tendency for debts to grow exponentially beyond the ability to be paid out of current income. An illusion is fostered that paying creditors by selling off public infrastructure will add to productivity and efficiency. The reality is rent-seeking. A parallel financial myth is that corporate raiders create wealth by pump and dump tactics of stock buybacks and higher dividend payouts instead of long-term investment. Financial lobbyists use these myths to numb popular awareness that today's overgrowth of debts can be paid only by imposing widespread poverty. As a cover story for their asset grabs, creditor elites cloak themselves in a libertarian denunciation of governments as being reckless by running budget deficits and central banks for monetizing public spending into the economy. Public investment, regulatory checks, and progressive taxation are accused of being deadweight overhead. By ignoring the degree to which banks lend to inflate prices for real estate, stocks, and bonds, this ideology aims to persuade voters to let rentiers dismantle progressive government and reverse centuries of democratic reform. High finance seeks to appoint its representatives to run the central bank, treasury, and key regulatory agencies instead of elected administrators governing in the economy's long-term interest. The Bank for International Settlements, BIS, insists that debts must be paid. The path of least resistance to a financial oligarchy is to create global authorities to override governments. The IMF and World Bank have performed this function since World War II, imposing austerity and privatization on debtors. The past decade has seen the ECB and EU Commission take a similar hard line. On November 12, 2011, the day after the EU pressured Greece to replace Prime Minister Papandreou with bank economist Papademos, it brought similar force to bear on Italy to replace Prime Minister Silvio Berlusconi with Mario Monti, a Goldman Sachs advisor since 2005 and then European chairman of the neoliberal Trilateral Commission. Like Papademos, Monti served bondholders by implementing austerity, raising taxes on labor and consumers, but not on finance and real estate, and scaling back pensions. On January 20, 2012, he introduced labor reforms making it easier for companies to fire employees, and abolished fixed charges for numerous professions from taxi drivers to doctors and lawyers. When voters were given a chance to reject his policies a year later, in February 2013, his Civic Choice coalition came in a distant fourth. So it hardly is surprising that the financial sector opposes democratic choice. The Bank for International Settlements, BIS, was created in 1929 to help resolve the breakdown stemming from Germany's high reparations debt. The bank was empowered to limit the payment of hard currency reparations to what Germany could earn. The fact that the BIS was accommodating to Germany in the Nazi period led many Allied politicians to advocate dissolving the bank in 1945. Instead, it became a central bank for central banks. Reflecting the capture of such banks by commercial bankers, it now insists that debtor economies must be run on behalf of creditors, even at the cost of imposing prolonged depression, the condition from which it helped save Germany in the early years of its operation. As a meeting place for central bankers, the BIS oversees the Basel agreements that set global capital adequacy requirements for banks to back their deposits and loans. This gives it a crucial role in coordinating global creditor strategy. The June 2014 annual BIS report proposed to use the POST-2008 debt overhang as an opportunity to impose anti-labor reforms and cut back government spending to pay bondholders and banks. Debt stagnation, or merely a business cycle downturn. The starting point of the 2014 BIS report is the main theme of the present book. We are not in a typical cyclical downturn, but have reached the culmination of a long build-up of cycles. Each recovery since 1945 has added more debt, increasing carrying charges that divert spending away from current goods and services, debt deflation, as Chapter 8 has discussed. The debt overhead is preventing recovery. We are in a balance sheet recession resulting from the buildup of debt attached to real estate and other assets. Most business cycle theory focuses on the rise and leveling off of wages, prices, and interest rates, with recessions leading automatically to recovery. But a balance sheet recession forces people to save in the form of paying down debts. Just as the debt buildup has spanned a long series of business cycles, debt deflation lasts much longer than typical business downturns. Instead of being automatically self-correcting, recovery will be slow because debtors are obliged to pay debts by cutting back their other spending. That is the essence of debt deflation. It is like paying reparations. The road ahead may be a long one, the BIS warns. High debt ratios for businesses, households, and governments will take a long time to work off, implying a painful deleveraging and extended periods of feeble growth, making global economic recovery much slower, compared with standard business cycle recessions. But instead of urging that the debt overhead be written down to enable economies to resume growing, the BIS insists that economies sacrifice themselves on the altar of past debts run up to banks and bondholders. Real growth in the form of new capital investment, public spending, and rising living standards is to be crowded out by having to pay creditors. More emphasis on balance sheet repair, that is, saving by paying down debt and reform, implies relatively less on expansionary demand management. Reducing consumer demand and public spending is necessary to leave more income available to pay bondholders. This balance sheet repair means plunging economies into a depression. To make matters worse, the BIS hopes to use the financial crisis as an opportunity to force labor reforms, breaking labor unions and kindred policies to lower wages, scaling back pensions, and cutting back public spending. This is the opposite of what the reform era meant a century ago. Neoliberals have hijacked the term to mean to reform. It is the same destructive austerity that has discredited the IMF's programs. Already in 1982, Raoul Prebys, founding Secretary General, 1964–69, of the United Nations Conference on Trade and Development, UNCTAD, described how creditors demanded that Latin America run its economies on behalf of foreign bondholders. In the name of economic freedom, they would justify sacrificing political freedom, imposing privatization and distorting Latin American political as well as economic development to support client oligarchies. You praise political freedom and individual rights. But don't you realize that in these lands of the periphery, your preaching can only bear fruit through the suppression of freedom and the violation of those rights? A similar complaint might be lodged against the Eurozone's imposition of austerity in the face of voter opposition. Martin Wolf was one of the first to warn against the retrograde BIS remedy and, by implication, the EU austerity policy it echoes, the notion that the best way to handle a crisis triggered by overleveraged balance sheets is to withdraw support for demand and even embrace outright deflation seems grotesque. The result, inevitably, would be even faster rises in real indebtedness and so yet bigger waves of bankruptcy that would lead to weaker economies and so to further increases in indebtedness. The BIS demands fiscal retrenchment. The BIS wants to see monetary stimulus withdrawn, too. It plays down both risks and costs of deflation, despite the huge overhang of debt that it also stresses. The BIS thus has made quite an about-face from its origins. Although it was created to free Germany from impossibly high creditor demands, its 2014 report fails to recognize that fiscal austerity and debt deflation worsen the debt problem by shrinking the economy. It opposes deficit spending. Chapter 4 of the BIS report does recognize debt write-downs as a last alternative. Scenario analysis suggests that a debt trap is not just a remote possibility for some countries, it warns. In some cases, unsustainable debt burdens have to be tackled directly, for instance through write-downs. Admittedly, this means that somebody has to bear the ensuing losses, but experience shows that such an approach may be less painful than the alternatives. For example, the Nordic countries addressed their high and unsustainable debt levels after the banking crises of the early 1990s by forcing banks to recognize losses and deal decisively with bad assets, including through disposals. This provided a solid basis for recovery, which came relatively quickly. Focusing on household debt, the BIS blames banks for reckless overlending in an atmosphere of easier credit, encouraged by central bankers, and urges banks to restructure or even write down underwater mortgages. But there is little recognition of the widespread damage caused by debt deflation as the bank's product. Central banks never discuss publicly the extent to which NG debts, arrears, and penalties simply be forgiven. When polluters cause environmental damage or contractors of badly constructed buildings cause accidents, the remedy is to pay restitution. If IMF and ECB directives have caused economic shrinkage and losses, what compensation is appropriate? ECB austerity demands. Eurozone austerity philosophy was made most blatant in a 2011 Financial Times interview with ECB board member Lorenzo Bini-Smaghi. He seems to be Europe's version of Tim Geithner. To him, the problem is not creditor demands, but pressures to reject them. Reflecting his University of Chicago indoctrination, Bini-Smaghi claims that there is only one solution: adopting anti-labor and anti-consumer structural reforms and fiscal adjustment measures included in the program. When asked about how default or restructuring would solve Greece's problems, he replied that a debt write-down would push Greece into a major economic and social depression, not save it from depression. In the euro area, debts have to be repaid. That has to be the principle of a market-based economy. The reality, of course, is that debt deflation destroys the economy. The interviewer pointed out that Otmar Issing, your former colleague, says Greece is insolvent and it will not be physically possible for it to repay its debts. Is he right? No, replied the Italian banker, it is a fairy tale. A debt write-down would cause Greek banks holding Greek bonds to fail, leaving the country without a means of payment for checking and savings accounts. The economy therefore needs to be sacrificed to prevent banks from taking big losses so that it will not collapse. This exercise in circular reasoning refuses to recognize that if the bonds are paid, this will shrink the economy, making more debts go bad. Criticizing Bini-Smaghi's arrogant attack on Greek voters for being irrational in rejecting austerity, Paul Krugman wrote that he exemplifies the European elite in this crisis: moralizing, sententious, always wrong yet always convinced that the other side of the argument is ignorant and unwashed. IMF and ECB economists try to save face by claiming that their underestimate of the destruction wrought by their demands for austerity was the result of innocent optimism. Yet the same misunderstanding that countries can pay any magnitude of debt, given sufficient budget surpluses. Wage cuts and stripping of public assets has been repeated decade after decade. Greek voters are not so naive. When they finally got a chance to go to the polls, they showed that they recognized quite clearly that austerity does not restore stability. It is financial warfare against labor, social spending, and public ownership. European banks block creation of a real central bank. Bini-Smaghi noted in his above-mentioned interview that after defaulting in the early 1980s, the Latin American countries still had a central bank that could print money to pay for civil servants' wages, pensions. But he claimed that funding government budget deficits was a step toward hyperinflation, by which he seems to mean rising wages. So they got out of the crisis through inflation, depreciation, and so forth. The reality was that currency depreciation resulted from having to pay debt service, to which Bini-Smaghi seems blind. EU rules block governments from monetizing public spending, he explained, in order to force economies to rely on responsible commercial bank credit in contrast to public money creation. In Greece you would not have a central bank that could finance the government, and it would have to partly shut down some of its operations, like the health system. This is precisely the fatal flaw in the euro's design, the lack of a central bank to finance public spending. Varoufakis has described the eurozone as a perverse economy in that it has a central bank without a state to direct it, and states without a central bank to back them up. The problem is political. Creating a real central bank, perhaps by establishing a Greek treasury to perform central bank functions, would infuriate European high finance. Lacking a central bank of their own obliges national governments to rely on bondholders, who extend credit only on extractive terms that tend to be adverse to long-term national prosperity. The choice is thus whether to submit to debt-ridden austerity, or to stop paying creditors and endure the transition period of withdrawal from the euro's straitjacket. There is no international tribunal to bring sovereign debts in line with the ability to pay, or to adjudicate who should absorb the losses from government debt refinancing or defaults. As the next chapter describes, such a venue would define a body of legal principles recognizing the unfairness of bondholders or vulture funds buying defaulted bonds on the cheap and threatening to disrupt national financial systems and cause chaos so as to grab their assets if their demands for payment in full are not met. 25 U.S. courts block debt write-downs. Default is not an Argentine problem, restructuring is not an Argentine problem, it is a world problem, it is a problem of global capitalism, of the system in which we live. Axel Kicillof, Argentine Minister of the Economy. The seemingly obvious response when a nation's foreign debt grows too large to pay, that is, to pay without having to impose a downward spiral of austerity, is to write it down. Shying from endorsing this in 2001, the IMF lost face, as noted earlier, by refinancing Argentina unpayably high debts that went into default almost immediately. In 2005, and again in 2010, President Nestor Kirchner confronted bondholders with a take-it-or-leave-it offer. They either could accede to steep write-downs or not get anything at all. By 2005, the market for these Argentine bonds consisted mainly of speculators who had bought them at heavy discounts reflecting the risk of default. It was obvious that the IMF would not again step in to help bondholders. Sovereign bond markets were becoming limited to speculators. Most evidently came out well enough that 76%, holding $76.5 billion, agreed to the deal. But the restructuring failed, and a new unilateral bond swap was offered in 2010. This time a remarkably high 92.4% of bondholders agreed. However, a small group of vulture funds saw a chance to make a killing. Paul Singer's Elliott Management affiliate in the Cayman Islands had been buying heavily discounted Argentine bonds since the 2001 crisis. By 2013 he had spent about $49 million for bonds with a face value of perhaps $250 million. Singer sued in New York federal court, demanding, and winning, payment at their full face value, plus accrued interest and expenses that amounted to $832 million. Other such funds had bought even more bonds, and waited for the outcome of Singer's lawsuit to claim similar windfall gains. At that time there were few collective action clauses, CACs, binding minority bondholders to the will of the majority. Also, most international bonds were still issued in US dollars, requiring payments to go through the US banking system at some point. To keep control in American hands, U.S. diplomacy has opposed any international court to mediate between debtor countries and bondholders, and has refused to submit to arbitration by the International Court of Justice in The Hague. This leaves no rules or global arbiter to assess how much creditors should lose when loans go bad. Singer's lawsuit against Argentina ended up in the hands of Second Circuit Judge Thomas Griesa. During 2014-15 he handed down a series of judgments that have thrown the legal framework for the world's sovereign government debt into disarray. Griesa ruled that none of the 92.4% of bondholders who had agreed to Argentina's refinancing could get paid a single dollar until Singer's fund was paid in full, with cumulative back interest, legal costs, and an array of damages. Argentina appealed Griesa's one-sided ruling to the U.S. Supreme Court, which upheld its terms, and Singer began to attach property of the Argentine government throughout the world. The cost of this judgment was so large that Argentina would be bankrupted if it complied. Griesa's set of nuclear rulings applied not only to Argentine debt paid to U.S. holders but also to foreign holders. In effect, he ruled that no write-downs are legal. No government's debt can be written down if any holder disagrees, regardless of how voluntarily they may be negotiated or how reasonable they may be. This made it legally unworkable for governments and their major bondholders to negotiate debt write-downs. Argentina's sovereign debt crisis. As a serial defaulter, Argentina has long been in the center of sovereign debt crises. Back in 1890, its default nearly brought down Baring Brothers, the English merchant banking house. Yet by 1953, Juan Perón had paid off Argentina's entire foreign debt as part of his nationalist economic program. Already in 1946, had refrained from joining the IMF, viewing it as an arm of financial imperialism. After Perón overthrow in 1955, Argentina returned to international financial markets, but its debt remained tolerable until its 1976-83 military dictatorship, when foreign borrowing soared from $8 to $48 billion. Matters grew more desperate after 1989. Carlos Menem's Washington Consensus regime gained access to international financing by agreeing to back every peso with matching dollar reserves, with full convertibility from 1991 to 2002. Argentina did not issue a single peso of its own currency without buying an equal value of U.S. Treasury bonds to back it up. This created a 1-to-1 peso/dollar ratio, mainly with borrowed or privatization-derived dollars that sat idle in the central bank as monetary reserves. By 2001 the 1-to-1 link to the dollar broke down, aggravated by low agricultural export prices. Trade dependency and capital flight deepened as industry and food production was subjected to austerity, ending in riots that brought down the government. The country's sovereign debt soared to $82 billion during the regime's last 4 years of neoliberal rule, 1998 to 2002, now remembered today as Argentina's Great Depression or, better yet, as its Great Neoliberal Depression. The ensuing sovereign debt default was the world's largest at the time. It also was the most legally convoluted. To minimize investor risk and hence the interest rate to be paid, Argentina's military junta had agreed to settle any payment disputes under the laws of New York, designating the Bank of New York Mellon as its paying agent. This concession has led to today's legal turmoil, setting precedents that threaten to explode the global system governing creditor claims against sovereign governments for bonds denominated in dollars or that involve payment via U.S. banks. Argentina's debt negotiations are subject to New York State rulings by a judge who has enabled vulture funds to block Argentina and the majority of its bondholders from implementing the settlement they reached to scale down the debt. There were attempts to prevent this anarchic situation. The 2001-02 Argentine crisis led the IMF's first deputy managing director, Anne Kruger, to propose a sovereign debt restructuring mechanism, SDRM. But the United States blocked such an institution. Permitting a judicial power to estimate limits on a government's ability to pay would have let debt leverage pass out of the hands of U.S. diplomats and investors. Argentina's debt write-downs of 2005 and 2010, and the holdouts. Argentina's economy began to recover after 2002 as booming commodity prices helped improve the trade balance. This enabled the new judicialist, Peronista, President, Nestor Kirchner, 2003-07, to open negotiations to settle the debts his predecessors had run up. In early 2005 bondholders agreed, reluctantly, to be sure, to exchange $63 billion, over 3/4, of defaulted Argentine bonds for new ones, worth just over a quarter of the original face value. Bonds with almost $19 billion in face value were not exchanged. In 2010, after another 5 years of negotiation, Argentina made a new agreement with holders of over 92% of its bonds, headed by Italian and Spanish funds. To persuade remaining minority holders to accept the new and final terms, it passed a padlock law stipulating that holdouts would lose their right to be paid anything at all if they did not accept the scaled-down new bonds in exchange for the old ones. After 2010 these bonds were sold at a fraction of their face value as most creditors considered them unpayable. Today's problem lies with the vulture funds that bought these old pre-2002 Argentine bonds at distress prices when repudiation looked probable. These funds are called vultures because they feed on dead bonds in default. Complaining that these hedge funds who have bought the bonds at 20 to 30 cents to a dollar, now want to be repaid in full, citing contractual obligations. Argentine Minister of Economics Axel Kicillof has pointed out that Singer's fund had bought the bonds with the sole purpose of obtaining a favorable judgment to make an exorbitant profit. In addition to demanding 100% of the bond's full face value, Singer asked for 12 years of accrued interest, compounded, punitive damages, and reimbursement for the legal expenses incurred in his approximately 900 attempts to embargo and seize Argentine assets in any countries that would recognize his claim. His ploy had worked before. In 2008, British courts had awarded his fund full face value principal and interest arrears on Congo debt. The ruling enabled him to seize the proceeds of Congo oil sold to Mark Rich's Swiss trading company Glencore International. Pressured by Jubilee 2000 to rein in such practices, Britain's Debt Relief, Developing Countries, Act 2010, capped the amount that creditors could demand from what the IMF classify as highly indebted poor countries, HIPC. The act was directed largely against Singer's activities. Under present English law, bondholders have no rights to file suits. Only the bond's trustee can do that, and the trustee can be compelled to act only if a large number of bondholders demand it. U.S. law has no such protection. Singer's strategy was to cause enough nuisance that Argentina's government would satisfy him on better terms than it had settled with the majority of bondholders. Moving to grab Argentine assets on October 2, 2012, Singer's lawyers asked Ghana to impound Argentina's naval training ship Libertad, docked in the nation's busiest commercial harbor. Argentina claimed diplomatic immunity for its vessel, and on December 15 the UN International Tribunal for the Law of the Sea ruled that Ghana had to release it. But in the meantime, Second Circuit Court Judge Griesa awarded Singer's fund a court victory that gave a novel interpretation to international debt law. Judge Griesa's rogue court rules for the vultures on November 22, 2012, Griesa directed the Bank of New York Mellon, Argentina's designated paying agent, to stop disbursing Argentina's payments to the 92.4% of bondholders that had reached settlement on its pre-2002 debts. No payment to these bondholders could be made, Griesa ruled, until Argentina paid Singer's fund in full under the terms of the old bonds that he had bought at junk prices. This created a crisis vastly larger than the $1.3 billion awarded to Singer. If Argentina does comply with the ruling, Moody's Investors Service said on Monday that it could set a legal precedent for other holdouts who together claim nearly $12 billion in unpaid debts. If Argentina does not fully meet its payments in December, however, the exchange bondholders could demand immediate payment on the entire $20 billion they are owed. And if this happens, the injunction will have turned a relatively minor default into a cataclysmic default that will further unsettle the already fragile global economy, the exchange bondholders warned. Former Argentine Central Bank Governor Mario Bleger accused the holdouts of seeking to profiteer on bonds they had bought at prices that implied a high risk of default. If investors are willing to accept higher risks in order to cash in on the additional spread, he argued, they cannot renege on the potential cost when the risk of default becomes a reality. Default, in this context, is a legitimate, if unfortunate, part of the game. It is not consistent to benefit from a risk-taking premium and insist on full payment in all circumstances. The legal protection extended to bondholders by Judge Griesa goes against the very nature of risk-taking. If all holdouts are eventually paid in full, the entire price-setting mechanism in sovereign bond markets is rendered inconsistent. Former Economy Minister Hernan Lorenzino likened the ruling to the United States sending in the Fifth Fleet judicial, or legal, colonialism. No one in his right mind would accept a restructuring deal, he pointed out, if holdouts with a good attorney could wait and collect 100%. It was one thing for bondholders to settle for a write-down that reflected a lower but realistic ability to pay, but quite different when they knew that those who refused to be reasonable would end up winning much more. Lorenzino promised to appeal the verdict up to the U.S. Supreme Court, where it was expected to end up because of the implications for U.S. foreign relations. These decisions are supposed to be subject to the executive branch, and hence to the Attorney General and State Department over and above the domestic bankruptcy law that formed the narrow basis for Judge Griesa's ruling. The State Department joined the U.S. Treasury in filing a brief with the appeals court warning that upholding Griesa's decision could damage the status of New York as a chief world financial center and cause a detrimental effect on the systemic role of the U.S. dollar by encouraging countries to denominate their debt in other currencies and put them outside the jurisdiction of United States courts. The IMF likewise warned of the systemic implications if higher courts upheld the decision. Ruling in favor of the holdouts would block governments from adopting collective action clauses even when the vast majority of bondholders recognize the need to do so, and thus could risk undermining the sovereign debt restructuring process. The U.S. Court of Appeals brushed aside such concerns in March 2013, refusing to rehear the Vulture Fund judgment with a full panel. This left standing the hedge fund's argument that despite having bought the bonds on the secondary market at discount ranging from 65 up to a more likely 85%, it never agreed to take less than 100% of their face value. It wanted legal rulings to erase the risk that markets had assigned. Judge Griesa reiterated that the Bank of New York Mellon would be in contempt of court if it paid the post-2010 bondholders without paying Singer's funds $1.3 billion in principal plus full back interest on the original pre-2001 bonds. This made default likely, even for Argentine bonds denominated in euros, because the bonds had designated the same bank as paying agent, regardless of the currency being paid. Bond prices quickly fell below 55% of face value, and the price of default insurance rose by 35%. The legal technicalities at issue, the devil is in the details. Argentina had thought that its padlock law had established the majority collective action principle, but what also was needed was legislation from the creditor nations. The Financial Times expressed the hope that the U.S. Congress might write a law similar to what Britain had passed in 2010, stipulating that any company suing one of the 40 heavily indebted poor countries in UK courts for debt payments could only get as much as if they had taken part in HIPC debt relief. Already in 2005 the Bank of England's Financial Markets Law Committee judged it incorrect to use pari passu clauses to block payments to creditors simply because others were not paid. Courts often write down debts for private sector debtors, invalidate claims, or block collection by creditors for various reasons. The IMF has tallied more than 600 sovereign restructurings in 95 countries between 1950 and 2010. But Judge Griesa denied such intervention in the case of Argentina. At issue is the pari passu rule that all creditors must be treated without ranking or favoring one group over another. The only modification for debt relief since 2003 has been greater use of collective action clauses to force recalcitrant speculators to adhere to what a large majority of creditors agree to. Greece's 2012 debt refinancing, for instance, included a CAC stipulating that if over 85% of bondholders agreed to new terms, their decision would bind all remaining bondholders. This bound all parties to an agreement by the majority. Such clauses protected major creditors as well as debtor countries from vulture funds hoping to make a killing by buying bonds that financial markets priced as having little chance of being paid off at par value. To prevent holdouts from interfering with bond refinancing, the European Union now requires all sovereign debt with more than a one-year maturity to be issued with such clauses. However, CACs do not apply to bonds issued before such clauses were adopted. Judge Griesa ruled that without such a CAC clause, any creditor that refuses a debt write-down can hold out for 100% of the bond's face value. This would be the case even when bonds have been bought at only pennies on the dollar after over 90% of holders agree to settle for a lesser amount based on the realities of what the debtor country can pay. The usual interpretation of what at the pari passu concept of equitable treatment means in practice, as Tim Samples, a professor of business law at the University of Georgia, explains, is Argentina's view that what the 92.4% supermajority of bondholders received should be the same principle that the vulture funds should get. But Griesa's idiosyncratic interpretation is that if Singer's fund is paid 100% of the face value of the original bonds, all other holders of the replacement bonds also need to be paid as if their earlier bond holdings were worth 100 cents on the dollar, not the 20% or so at which the market had priced them. In this view, the vultures determine what the majority gets, not vice versa. All parties would have a right to the bond's full original terms, even if a majority agrees to settle for less. So a majority cannot commit other bondholders to a write-down. This definition of pari passu would block governments from settling with a majority as long as there are holdouts. The holdout group will receive far better terms than the vast majority of creditors, spelled out economist Joseph Stiglitz, because any future creditor of any future bond issuance will not receive payment before the holdouts of any previous restructuring. Judge Griesa ruled as if none of this really should matter when bonds are issued with CAC clauses. But sovereign bonds issued prior to the Greek 2012 issue lack such a clause. This leaves them vulnerable to blockage by vulture funds that refuse to comply with majority debt settlements, throwing such settlements into limbo. Calling the ruling in favor of Singer extortion backed by the U.S. judiciary, Financial Times columnist Martin Wolf noted that despite the ease with which U.S. corporations can walk away from their creditors is breathtaking, no such leeway or adjustment exists when it comes to nations and their governments. The intent is to subordinate government power to Wall Street and London bankers. Judge Griessa's rogue ruling was a radical rewrite of international law to mean that there can be no renegotiation to write down dollarized debts that may be made subject to New York's Second Circuit Court ruling that all holdouts must be paid full value of, else they can seize the assets of debtor countries unless a CAC is already in place to override the pari passu principle for each and every bond. This means that the 93% of Argentina's bondholders who agreed to the swap cannot be paid without paying Singer's fund full face value, 100 cents on the dollar plus accrued compound interest, penalties, and legal expenses. The Supreme Court refuses to hear an appeal of Griessa's decision, having failed in their appeal to the full Second District Federal Court, whose judges found no reason to reject Judge Griessa's logic. Argentina's next step was the U.S. Supreme Court in what the Financial Times called the ongoing trial of the century. It looked like a replay of Florida's stolen 2000 election, with David Boies, who had represented Al Gore, acting for Argentina, while Ted Olson, George W. Bush's Solicitor General, represented Singer's NML capital. The Treasury, IMF, World Bank, and French government filed amicus briefs supporting Argentina's position. But in June 2014, the Supreme Court refused to review Griessa's decision, viewing the legal issue simply as one of local contract law, as if it had no bearing on international relations. U.S. bankruptcy law is based on how to divide up the assets of business ventures or families gone broke. Creditors are given discovery rights to find out what assets are available to be seized. Most such proceedings are localized, while life goes on as normal for the overall economy. Seizing foreign government assets is a much higher order of magnitude, but Supreme Court Justice Antonin Scalia saw matters in the same trivial light as Judge Griessa, treating sovereign economies like ordinary debtors, whose forfeiture of property would have only a marginal economic effect. If a case was filed in New York against a deadbeat property owner, and the debtor was ordered to pay up, why couldn't the creditor demand to know if there was property in Florida to go after? Of course, keeping the two steps separate, Scalia said, the creditor would then have to ask the Florida courts to attach that property, but why not let the creditor find out about it? The problem with this reading, Justice Ruth Bader Ginsburg pointed out, was that the right to undertake discovery of all the assets Argentina owned tacitly implied a follow-up right of seizure. In response to Olson's argument that Argentina was no different from other debtors when it came to demands for information about assets that could be taken to satisfy debts, she protested that this is a sovereign. It is immune except as to commercial activity in the United States. Argentina's New York lawyer Jonathan L. Blackman pointed out that inasmuch as Argentina is immune from having to forfeit its military arsenal, embassies, and other national assets, there was no reason to permit creditors to ask for such an inventory. Leaving Judge Griessa's ruling in place to govern Argentine debt, the Supreme Court affirmed that Argentina had to provide Singer's Vulture Fund with a list of all the assets it possessed, anywhere in the world, military and civilian alike, even where they were protected from seizure by sovereign immunity, as was the Libertad ship. The Vulture funds were to be allowed to try again and again, billing all legal expenses to indebted Argentina. On July 16, 2014, Singer's public relations arm ran full-page ads in the Financial Times, Wall Street Journal and New York Times, concluding with the words, "Argentina, default is your choice." The ad claimed that by paying his funds, Argentina's economy would gain as much as $70 billion in lower interest costs over the next 10 years. The meaning was clear enough: Singer's funds would create enough nuisances to force Argentina to pay a high-risk premium in global capital markets if it did not surrender. This is not like simply closing down a restaurant to pay its suppliers and other creditors. Upholding Griessa's ruling threatened to drive foreign countries in general away from borrowing in dollars. Non-U.S. bondholders sought to strike down Griessa's ruling on the ground that the euro bonds are governed by English law, and payments on those bonds are made outside of the U.S. through foreign entities, therefore a U.S. court does not have jurisdiction to impede those payments. The IMF protested that, "We are concerned about possible broader systemic implications." Floyd Norris accused the Supreme Court of turning the world of sovereign debt restructuring on its head. In so doing, the court most likely damaged the status of New York as the world's financial capital. Blocking Argentina's ability to pay via U.S. banks to show good faith toward its legitimate bondholders, Argentina defied Judge Griese's order by depositing $539 million in the Bank of New York Mellon to pay the interest due on June 30, 2014, plus $183 million to pay non-dollar bondholders. The judge directed the bank to return the money, calling the transfer an explosive action that disrupted potential settlement talks with holders of defaulted debt. He also insisted that Argentina send representatives to New York to negotiate with Singer's fund. But it was obvious that there was no solution to negotiate. Argentina's rights upon future offer, RUFO, rule stipulated that the parties who accepted the write-down would share in any new settlement made with the holdouts down through 2014. If it paid Singer's vulture fund 100 cents on the dollar, it would have to pay all the former bondholders retroactively on the same terms. The immediate cost would be $15 billion, amounting to $120 billion over the years to come, far beyond any reasonable scale. As shaped by Judge Griese, the Court of Appeals and the U.S. Supreme Court, current U.S. law forms a financial vice to prevent countries from escaping from debt deflation, rentier serfdom, and seizure of their assets by creditors. Griese's ruling threatens that without restructuring onerous foreign debts, entire economies will be driven into depression, unemployment, and emigration of young labor, capped by pressures for insider privatizations. Creating an alternative legal framework for debt write-downs avoiding such financial warfare requires a global arbiter to override the trial of the century's precedent. Griese's rulings prevent governments in general from scaling back dollar-denominated debts that lack the post-2012 collective action clauses binding minority holders to decisions by a specified majority or, under British law, a trustee representing the majority. At issue is whether a few holdouts can impose anarchy on the international economy by blocking the legality of debt write-downs negotiated as an alternative to outright default or repudiation. In summer 2014, over 400 banks, bond investors, and debtor countries worked via the International Capital Market Association to limit the ability of vulture funds and other holdouts to block settlements and compromises by using collective action clauses on new bond issues. These CACs define the terms for future default rulings, binding all investors to decisions agreed by a 75% majority. The clauses would apply to all of a debtor country's bonds, so as to prevent holdouts from buying a majority of a single issue and then trying to throw the entire spectrum of the country's bonds into courts, as is presently the case. Judge Griese's ruling would be rendered obsolete by defining the pari passu clause to mean equal treatment but not equal payments for bondholders. The global debt overhead has grown so large that the financial war fought over creditor-debtor relations has come to overshadow the class warfare between labor and its employers. In a passionate, even tearful speech on August 19, 2014, President Christina Kirchner, who succeeded her husband after he died in office in 2007, escalated Argentina's debt crisis into an issue of global principle. When it comes to the sovereignty of our country and the conviction that we can no longer be extorted and that we can't become burdened with debt again, we are emerging as Argentines. If I signed what they're trying to make me sign, the bomb wouldn't explode now, but rather there would surely be applause, marvelous headlines in the papers. But we would enter into the infernal cycle of debt which we've been subject to for so long. The practical effect of Judge Griese's rulings has been to make global sovereign debt settlements impossible to implement if they involve U.S. dollar payments or U.S. courts. This blocks any negotiated write-downs of sovereign debt, any write-down at all. Any hedge fund or other creditor, no matter how small their bond holding, can demand full face value for any bond that has been renegotiated, even if the large majority of holders agree to a swap designed to bring debts within a government's ability to pay. Matters came to a head on June 5, 2015. As Argentina had warned, Griese extended his ruling beyond just Singer's funds, to include the approximately 500 other holdouts and vulture funds that did not accept the terms of the 2005 and 2010 restructurings. Argentine economic writer Jorge Vilches points out that Kenneth Darts M Limited owns $595 million worth of defaulted Argentine bonds, more than Singer's $503 million in his NML capital. In addition to Dart, there are approximately $2.4 billion worth of bonds out there that are governed by New York law and in the hands of other holdout investors. Starting to pay these holdouts 100% on the dollar for their old bonds would leave Argentina right back where it started. Dubbed Me Too bondholders, they were awarded $5.4 billion beyond Gries's original ruling to pay Singer $1.6 billion. Economy Minister Axel Kicillof accused the funds of using Singer's claims as a cat's paw to establish legal grounds for the rest to pile on a trap they had planned all along. The vulture funds tried to show that the amount to pay was small compared to the foreign currency reserves, so to make the country pay before other creditors would show up. The opposition economists fell into the trap, asking us to pay the holdouts. As Gries now acknowledges for all creditors of Argentina the same terms as the vulture funds, we will be asked to pay between $15 billion and $17 billion. That's a lot of money considering that our foreign currency reserves are $34 billion. The creditors' ultimate aim, Kicillof accused, was to carve up Argentina by forcing privatization sell-offs. If Argentina takes new debt to pay them, international agencies would make the government implement adjustments and privatize state companies. That has become the financial aim since the Thatcher-Reagan era, in a modern enclosure movement privatizing the public domain of debtor countries. Instead of financing capital investment to earn profits by producing more, the new financial strategy is to pry away rent extraction opportunities and to turn rent extraction into interest. The major such opportunities are currently public enterprises. This financialization strategy confronts countries with the need to create an alternative to being crucified on the cross of existing debts. The tangible economy of labor and production should take priority over creditor demands. This principle needs to be built into a body of international law to enable sovereign governments to override foreign debt claims in the public interest. 26. Financial austerity or a clean slate. Blaming the wolf would not help the sheep much. The sheep must learn not to fall into the clutches of the wolf. Mahatma Gandhi, quoted in D.G. Tendulkar, Mahatma. Over and above Judge Gries's ruling blocking debt write-downs, the global Western financial system has become hostage to U.S. geopolitics. A $9 billion U.S. fine against France's Banque Paribas for dealing with Iran was followed by trade and financial sanctions against Russia. The increasingly aggressive use of such economic warfare to support American diplomacy provided a note of urgency for Russia and China, along with Brazil, India, and South Africa, and Shanghai Cooperation Organization observer state Iran, to create a monetary system immune from such pressures. Thus it came about that on July 15 to 16, 2014, the same days that Paul Singer's full-page newspaper ads warning Argentina about higher interest creditor nation charges if it did not surrender to his demands were published, the BRICS were meeting in Brazil to announce their $50 billion new development bank and a $100 billion clearing facility. Argentine Economics Minister Kicillof headed a committee to work with BRICS officials to propose a global financial court such as U.S. diplomats had blocked within the IMF. Held in the context of deepening military confrontation in Ukraine by the United States and its NATO satellites against Russia, the BRICS initiative aimed to transact trade and investment in their own currencies as well as the dollar, and hence, of U.S. banks. Avoiding financial dependency insulates economies from U.S. economic sanctions that have shown themselves to be more powerful than direct military attack in forcing countries to follow U.S. pro-creditor, anti-labor austerity, asset stripping and rent-seeking. Public media in the West denigrated the BRICS meeting by asking what Russia, China, India, Brazil, and South Africa have in common. The answer is that they all are confronted with the threat of US, Eurozone, and IMF sanctions against countries that do not submit to creditor demands for privatization sell-offs and tax shifts onto labor instead of finance and rent-seeking. Debtor countries are expected to conduct their foreign trade, investment, and borrowing in dollars mediated by the U.S. banking system, U.S. courts, the U.S. Treasury and State Department. This dollarized system has led the BRICS and other countries to create their own alternative in order to free themselves from US sanctions and creditor-oriented rulings. Initiating an alternative to neoliberal rentier policy, the prospective BRICS Bank and Currency Clearinghouse promises not to demand austerity and kindred anti-labor policies, or impose the Trans-Pacific Partnership, TPP, and Trade in Services Agreement, TISA, prohibitions against governments regulating finance and business, taxing or fining them for the damages and social costs, externalities, they cause. At issue is whether governments or banks will direct economies. Letting economies be centrally planned by megabanks will favor extractive claims for debt service, to be paid by privatizing public assets, foreclosing on debtors and raiding companies with takeover credit and activist asset stripping. The new conflict is thus between a financialized rentier austerity and a revival of a classical mixed economy steering markets in the long-term public interest, what used to be called socialism. Financialization is the major dynamic polarizing today's economies. Its aim is to appropriate the means of production and rent-extracting privileges for a creditor class to load labor, industry, agriculture, and governments down with debt. Employment, wages, and capital investment cannot recover as long as the resulting debt overhead is left in place. Debt leveraging is a major reason why the United States and Britain have lost their industrial advantage. Debt-inflated costs for housing, education, and other basic needs have priced their labor out of markets abroad and at home. Germany's ability to resist a domestic real estate bubble has been a key to its success as an industrial exporter. Yet its banks and political leaders demand financialization abroad. It is a classic case of do as I say, not as I do. Eurozone financial institutions have sought to impose Latvia's model austerity on Ireland, Spain, and Portugal, and most of all, on Greece, which is being made an object lesson of how creditor powers will treat countries that try to extricate themselves from debt, unemployment, privatization, emigration, and demographic collapse. Neoliberal financialization is not how to create a viable economy. Academic theories must be mistrusted if they do not explain why financial and industrial objectives are diverging, not converging. Fire sector lobbyists have censored economic theory so as to misrepresent Adam Smith and the anti-rentier spirit of classical economists who believed that a free market required public regulation to keep predatory finance and rent-seeking in check, and to keep basic infrastructure in the public domain. Only by such intellectual clear-cutting to wipe out history could so much of the public come to believe what no generation ever before has believed, that the financial and related rent-extracting sectors are an intrinsic part of the real economy of production and consumption, not external to it and predatory on it, and that they can get money fastest by borrowing to buy assets being inflated by bank credit. Early attempts to align banking interests with those of industry have given way to a world in which the largest corporations are managed with financial strategy in mind. Today's postmodern economic theory depicts quantitative easing, more borrowing, as a solution to today's debt-strapped budgets. Wall Street's public relations handouts promise that activist shareholders can make home buyers rich and pay pensions by stock buybacks and kindred financial engineering, even without the economy really growing, simply by capital gains, raising stock prices by using earnings to buy back their own equity, while downsizing operations and scaling back research and development. While most people, and certainly most economists and the mass media, view these asset price gains as creating real wealth and prosperity, creditors insist that governments can pay any magnitude of debt, given sufficient reduction of wages, social benefits, pensions and privatization sell-offs. That axiom is the cover story for the IMF and ECB to bail out bondholders, leaving taxpayers in debtor countries to suffer ad infinitum. I call this ideology postmodern because it rejects the progressive era's program of taxing rentier wealth and subsidizing public investment in basic infrastructure with a view toward lowering the cost of living and doing business. In a word, the modern economy a century ago was supposed to be socialist. Today's economy is moving in the opposite direction, toward a financialized neo-feudalism and rent-seeking, by spreading the politically soporific impression that there is no alternative. How finance has rolled back the modern era toward neo-feudalism instead of restructuring economies with a clean slate to resume progress, the financial class is using today's debt crisis to vest itself as the new elite to rule the remainder of the 21st century. To consolidate their position, financiers are sponsoring a property grab privatization and waging a war to reduce labor and industry to debt peonage by blocking government's ability to protect society against predatory credit and rent extraction. This neo-rentier economy is reversing the direction of evolution that classical political economy hoped to establish. Instead of supporting industrial capital formation in an alliance against rent-extracting landlords as in the early 19th century, the financial sector has moved into a symbiosis with rent-seeking monopolies, infrastructure, and natural resource privatizers. Money and credit are created to buy these assets, not to finance new industrial capital investment and employment. In the initial wave of asset price inflation, debt is used to bid up prices for real estate and other assets. This financialization involves carrying charges, interest, financial management fees and salaries, legal and lobbying expenses, that turn into debt deflation, leading to austerity and unemployment. Investment and employment slows, debts go bad and foreclosure time arrives. Financial managers find it easier to carve out rent-extracting opportunities than to make profits by investing in more means of production. In the political sphere, they lobby to untax this economic rent, shifting the tax burden off of themselves. The resulting budget deficits lead to cutbacks in infrastructure spending on bridges and roads, other basic needs, underfunding pension plans, and finally by property sell-offs and privatizations. This predatory financial dynamic stifles industrial potential, raising the specter of lapsing back into ancient usury. Much like creditors in ancient Rome, today's financial power seeks to replace democracy with oligarchy. We are seeing a resurgence of primitive accumulation by exponentially accruing debt dependency, foreclosure, and privatization, whose effects threaten to be as devastating as the brutal military conquests of past epochs that reduced populations to serfdom. It doesn't have to be this way. There are many alternatives to today's debt-ridden austerity. Heading the list are debt write-downs and a tax shift off labor and industry onto rentier income and inherited fortunes. Today's tax subsidy for debt financing should be replaced by removing the tax deductibility of interest. And credit creation should be steered to expand the real economy, not merely to inflate asset prices. A more realistic statistical accounting format would show how the economic surplus is invested or dissipated. This in turn requires an alternative body of theory and analysis to distinguish real wealth from overhead. That was the task of classical political economy. For 2 centuries it refined the concepts needed to explain why most of the buildup of wealth owned or owed to the 1% has taken the form of claims for land rent, natural resource rent and monopoly rent, capped by financial rentier charges. These were the forms of revenue that classical economists hoped to collect by levying progressive taxes on land and natural resources, and by regulating natural monopolies by taking them into the public domain. Instead, our tax system favors rent extraction and financial short-termism, enabling bondholders, bankers, stock market raiders and activists to eat into the economy's industrial bone while inflating access prices rise for privatized infrastructure. The aim is to transfer ownership of the vast capital expenditure sunk in the hitherto public domain from roads to education, ports, power systems, medical care and communications to buyers on credit, with the revenue going to bankers, bondholders, and stockholders. Labor is cornered onto a virtual reservation, driven into debt by being obliged to buy essential goods and services and obtain housing and an education at the proverbial company store. It doesn't have to be this way. As Chapter 7 has shown, banking was on its way to becoming a public utility in the years leading up to World War I. If this trend had continued, much of today's world would receive credit cards, use deposit banking services and get loans provided at cost or at subsidized rates instead of burdened with interest charges, predatory fees, and penalties. Most important, a public banking option would have been less likely to extend credit for the asset stripping and rent seeking that characterize today's postmodern financial system. The logic for annulling odious debts, but only those owed to Russia. The most imaginative recent rationales for annulling sovereign debts have been thought up not by Argentina, Greece, or Ireland, but by U.S. strategists seeking to enable Ukraine to avoid paying the bonds it has issued or debts run up for gas imported from Russia. In the wake of the new Cold War confrontation in mid-2014 after Crimea voted heavily in a popular referendum to be reabsorbed by Russia, the Peterson Institute for International Economics floated a proposal by former Treasury official Anna Jelpern to deprive Russia of a means for enforcing its loan to Ukraine. A single measure can free up $3 billion for Ukraine, she proposed. Britain's parliament could pass a law declaring the $3 billion bond negotiated by Russia's sovereign wealth fund to be foreign aid, not a real commercial loan contract worthy of legal enforcement. This would be a thunderclap shaking international debt markets. Its principle would be logically applicable to U.S. claims foreign aid, which includes loans to pay back American bankers and other creditors, as well as World Bank aid loans. The bonds held by Russia's sovereign wealth fund were denominated in euros under strict London rules. Furthermore, the fund required at least an AA rating for bond investments. Ukraine's B-end rating was below this level, so Russia acted in a prudent way to add financial protection by making the bonds payable on demand if Ukraine's overall debt rose above a fairly modest 60% of its GDP. Unlike general-purpose foreign aid, the terms of this loan gives Russia power to trigger a cascade of defaults under Ukraine's other bonds and a large block of votes in any future bond restructuring, Jelpern noted. As recently as 2013, Ukraine's public debt amounted to just over 40% of the nation's GDP, some $73 billion, seemingly manageable until the February Maidan coup led to civil war against the eastern Russian-speaking region. Waging war is expensive, and Ukraine's hryvnia currency ruptured. A quarter of its exports come from eastern Ukraine, sold mainly to Russia, including military hardware. Kiev sought to end this trade, and spent a year bombing Donbas and Luhansk cities and industry, turning off the electricity to its coal mines, and driving an estimated 1 million of the region's civilians to flee into Russia. Ukraine's exchange rate plunged steadily, raising its debt/GDP ratio far above the 60% threshold. That gave Russia the option to make the debt payable immediately, triggering the cross-default clauses it had inserted into the Eurobonds contracted with Ukraine. Jelpern's paper accused Russia of seeking to keep Ukraine on a short leash, as if this is not precisely what the IMF and most financial investors do. However, governments do not normally sue one another to collect their debts in national courts. If this should occur, the pari passu rule prevents some debts from being annulled selectively. That is the problem Jelpern has been describing in the Credit Slips blog with regard to Argentina's debt negotiations. Jelpern therefore raises another possibility that Ukraine may claim that its debt to Russia is odious, addressing the situation where an evil ruler signs contracts that burden future generations long after the ruler is deposed. Repudiating all debts incurred under Yanukovych would discourage lending to corrupt leaders, she concludes. The double standard here is that instead of labeling Ukraine's long series of kleptocrats and their corrupt governments odious, she singles out only Yanukovych's tenure, as if his predecessors and successors were not equally venal. An even greater danger in declaring Ukraine's debt odious is that it may backfire on the United States, given its own long support for military dictatorships, corrupt client states and kleptocracies. U.S. backing for Chile's military dictatorship following General Pinochet's 1973 coup led to Operation Condor that installed Argentina's military dictatorship that ran up that country's foreign debt. Would a successful Ukrainian claim that its debt was odious open the legal floodgates for broad Latin American and Third World debt annulments? Ukraine's sale of bonds to Russia's sovereign debt fund, as well as its contracts for gas purchases, were negotiated by a democratically elected government, at low concessionary rates that subsidized industrial and household consumption. If this debt is deemed odious, what of the EU's insistence that Greece remove its parliamentary leader Papandreou in 2011 to prevent a public referendum from taking place regarding the ECB loan? Loans made in the face of evident public opposition may be deemed to have been imposed without proper democratic consent. Jelpern acknowledges that invoking the odious debt principle is fraught with legal, political, and market risks, all of which would play into Russia's hands. Fraught indeed. The United Kingdom can refuse to enforce English law contracts for the money Russia lent, thereby taking away creditor remedies for default on this debt. But it also would end the City of London's rule of financial law, making it a US/NATO satellite. A kindred legalistic stratagem to hurt Russia would be for Britain's Parliament to pass a sanctions law invalidating the Yanukovych bonds. This would reduce Russia's ability to profit from selling the debt on the market, and deny Russia legal rights to grab Ukrainian assets. Debt contracts are routinely invalidated by the courts, rewritten in bankruptcy, and blocked by traditional sanctions, Jelpern observes. But if this can be done, why cannot the U.S. Congress pass a similar rule annulling vulture claims against Argentina and other debt-strapped third-world countries? Jelpern's paper concludes by suggesting a universal principle: contracts used to advance military and political objectives should lose their claim to court enforcement. This opens quite a can of worms in view of the fact that the United Kingdom and the United States have both used military force in the past to collect debts and influence weaker countries. Is it legitimate for them to punish Russia for doing the same? Are not the vast majority of intergovernmental debts either military or political in character? On this logic, in fact, shouldn't all intergovernmental debts be wiped out? IMF support for Ukraine reflects its policy of backing regimes friendly to U.S. investors. In April 2014 it approved a $17 billion loan program for Ukraine. Normal IMF practice is to lend an amount only up to twice a country's quota in 1 year, but it lent Ukraine's new junta 8 times its quota. Almost immediately, Ukrainian President Petro Poroshenko announced new warfare against the eastern region to try and reconquer Crimea. In June 2015 he announced that the €7 billion debt service falling due would be spent instead on more military attacks on Ukraine's eastern provinces. The IMF loan thus comes near to funding economic warfare. International law, national sovereignty, and real human rights. Should loans be deemed to be extortionate when they require austerity and privatization sell-offs? Such demands suggest that a radical change in legal and financial structure is required far beyond Ukraine. As Argentine writers were quick to point out, when Argentina suffered a massive default in 2001, the global press, including Time and the New York Times, went so far as to propose that Patagonia be ceded from the country as a defaulted debt payment mechanism. The New York Times article followed one published in the Buenos Aires financial newspaper El Cronista commercial called Debt for Territory, which described a proposal by a U.S. consultant to then-President Eduardo Duhalde for swapping public debt for government land. Some Argentinians claim that the reckless loans made to the military dictatorship and the neoliberal Menem regime that drove the country needlessly into debt were odious debts. If such loans are made in the face of evident public opposition, should they be deemed to have been imposed without proper democratic consent? What is needed is a fair court to decide what is payable and what is not. As matters now stand, banks and bondholders seek to appoint their nominees as judges, the likes of Thomas Griesa, treating sovereign debt as if there is no difference between a national economy and a family restaurant going out of business. It would take a different kind of public entity than currently exists to judge how far to impose austerity and transfer property to creditors to settle debts beyond the ability of governments to pay out of current revenue and, in the case of foreign currency debts, out of balance of payments receipts. In the face of concerted financial attempts to establish global neo-feudalism, the world needs a declaration of sovereign human rights and political rights of nations. The principle of self-determination has long been written into international law, but the provision does not include self-determination from creditors taking over governments and appropriating their public domain to extract economic rent. Failure to establish such a body of law will enable creditors to wage a divide-and-conquer strategy to break up one country after another, seize the public domain, impose interest charges as tribute, and shift political control to technocrats appointed to act on behalf of the world's financial centers. IMF, ECB, and BIS policy is marketed with a false view of how economies work, junk economics aimed at convincing populations that there is no alternative to austerity, impoverishment, unemployment and emigration under the rulership of an emerging oligarchy of the 1%. The financial conflagration. Some scenarios while governments seek to avoid being subjected to debt serfdom by writing off their debts, bankers and bondholders are strategizing about how to preserve their financial claims when the day arrives that the debts must fall into default or be written down when austerity-ridden economies are unable to pay, except by borrowing more. Creditors hope to use such conditions as leverage to turn debtors into financial colonies. The first response is an attempt to insure the uninsurable. Realistic bondholders will see that the game is up and debtors cannot earn enough to pay the compounded interest and arrears that have mounted up, especially as economies succumb to debt deflation, austerity, unemployment, and emigration. Far-sighted financial institutions will take out default insurance from the likes of AIG and monoline insurers, and negotiate credit default swaps with whomever they can find as counterparties. This is how John Paulson made a fortune, betting that the junk mortgage market would collapse and going short with his Goldman Sachs derivatives, making AIG and other insurers pay. If a crash could be fully insured, investors would collect as if the economy could continue unimpeded in the face of debt deflation path. But who could afford to pay them? The amount needed to pay far exceeds the reserves of banks and insurance companies. They would have to have set aside reserves equal in magnitude to the entire exponential debt buildup by being invested in the debts that are among those being burned in the great financial conflagration. So either these counterparties holding CDs will go bankrupt when the time arrives that the debts can't be paid, or governments will print the money or tax populations to reimburse the 1% for losses on their investments gone bad. Managers of these insurance companies and banks may sell increasingly risky debt guarantee policies at rising prices. As the Ponzi-like accumulation of debt approaches its climax, their profits will rise and enable them to pay themselves higher salaries and bonuses. Then, when defaults wipe out the debts, insurers will say that there are not enough reserves to pay the CDs or annuities and pensions for that matter, and will fold up business. But managers of companies writing these CDs will have enjoyed enough bubble years to be able to emulate Rome's patricians and convert their takings into landed estates, gated communities, or farms onto which they can withdraw. If the stock markets crash and deprive pension funds and other investors of the financialized savings on which retirees had depended, while the 1% seek to make up their losses from labor and the government, blaming overly generous pensions to the 99%. The reality, of course, is that corporate managers and local governments have underfunded them with overly utopian financialization forecasts. Also blamed will be central banks for spending money to revive employment and GNP. But in reality, austerity crashes markets because central banks refuse to do this. The crash may become prolonged where governments lack the political ability to write off debts owed to the 1%. There is no technological or inherent economic reason for this financial Ragnarok to become the fate of North America and Europe. But it is the choice that is being promoted by the financial sector's lobbyists, pet academics, and public media that fail to admit how debt deflation destroys the economy's ability to grow. Coda, absence of an international court to adjudicate sovereign debts. Existing bankruptcy law from New York State to the London and Paris clubs is designed to carve up assets of money-losing family restaurants, other business and personal bankruptcies, not with sovereign debt restructuring such as have thrown world financial markets into turmoil since summer 2014. That is what has made Argentina so important a battleground to create a legal alternative to the hard creditor rules adjudicated in creditor nation courts or the IMF. U.S. resistance to a new global court outside of its control has maintained a vacuum filled by default by local U.S. law. By letting holdouts demand full payment even when a majority of creditors agree to a write-down, the effect is to block any negotiated write-downs of sovereign debt. This pro-creditor default policy leaves no court or body of economic theory to determine the ability to pay or assess the consequences of debt repayment. Leaving Argentina's debt resolution in the hands of local New York bankruptcy courts has spurred attempts to create an alternative global financial system to the dollar area and its satellite Eurozone. The BRICS have been driven together into a critical economic mass to defend their sovereignty and policy independence. A quantum leap occurred in July 2014. Russia and its BRICS partners, China, Brazil, India, and South Africa, took the lead toward creating an alternative financial system, starting with a $50 billion BRICS bank and a $100 billion intra-BRICS financial clearing system as an alternative to the IMF and World Bank. The aim of these countries, along with Argentina and Iran, is to insulate themselves from neoliberal economic policy, debt coercion, forced privatization sell-offs and asset seizures. Under today's conditions, this will entail debt write-downs, backed by a body of theory to analyze an economy's ability to pay domestic and foreign currency creditors. 27. Finance as warfare. To simple people, it is indubitable that the nearest cause of the enslavement of one class of men by another is money. They know that it is possible to cause more trouble with a ruble than with a club. It is only political economy that does not want to know it. Leo Tolstoy, What Shall We Do Then? 1886. The financial sector has the same objective as military conquest, to gain control of land and basic infrastructure, and collect tribute. To update von Clausewitz, finance has become war by other means. What formerly took blood and arms is now obtained by debt leverage. Direct ownership is not necessary. If a country's economic surplus can be taken financially, it is not necessary to conquer or even to own its land, natural resources, and infrastructure. Debt leverage saves the cost of having to mount an invasion and suffer casualties. Who needs an expensive occupation against unwilling hosts when you can obtain assets willingly by financial means, as long as debt-strapped nations permit bankers and bondholders to dictate their laws and control their planning and politics? The creditor's objective is to obtain wealth by indebting populations and even governments, and forcing them to pay by relinquishing their property or its income. Such financial conquest is less overtly brutal than warfare waged with guns and missiles, but its demographic effect is just as lethal. For debt-strapped Greece and Latvia, creditor-imposed austerity has caused falling marriage rates, family formation and birth rates, shortening lifespans, and rising suicide rates and emigration. War as the catalyst for national debts. The first recorded example of compound interest calculating the tribute owed to the Sumerian city of Lagash by neighboring Umma after a fight over their buffer territory in the 25th century BC. Inscribed on the steel of the vultures, the astronomically high levy led to prolonged future conflict, not unlike the reparations imposed by the Allies on Germany after World War I. From antiquity down through medieval Europe, wars were viewed as profitable propositions yielding loot and tribute. Historians find a military origin of coined money in Greece, in the form of booty being melted down and divided among the officers and troops, with the tithe donated to the city temple. Mesopotamian, Classical Greek, and Roman temples were adorned with the spoils of war, monetizing their bullion in war emergencies to pay mercenaries. The word money derives from Rome's Temple of Juno Moneta, where the city minted its first silver and gold coins during the Punic Wars with Carthage. It was said that the honking of the Juno temple's geese warned Rome's commander of the impending attack by the Gauls in 390 BC. Hence, Juno's epithet moneta, from Latin monere, to warn, also the root of monster, an omen. Money, endless money, is the sinews of war, wrote Cicero in his Philippics, 43 BC. Not only money, but credit, too. Venice financed the crusade against Constantinople in 1204 for a quarter of the loot, which it and other Italians monetized and lent to secular kings to wage their own wars of conquest. This influx of silver and gold from the looting of Constantinople catalyzed the financial sector's rise to power. After 1492, the looting of the New World provided silver and gold to finance the expansion of commerce and also the increasingly expensive imperial rivalries to carve out new conquests. Financializing the costs of war led to public debts and the modern bond market. Rulers borrowed to buy cannons and build navies, pay troops, hire mercenaries, and support allies. Indeed, warfare became financialized long before industry or real estate. And as in any financialized sector, creditors usually ended up with the winnings. Governments issued interest-bearing bonds, a word that originally meant physical shackles on bond servants, a fitting analogy for the position in which governments found themselves. They typically paid off these war debts by selling land, mines, and creating public monopolies to exchange for bonds they had issued. War debts is the mother of royal monopolies. The Church's banking orders the Knights Templar and Hospitallers lent to kings and nobles at the top of the social pyramid, first to embark on the Crusades and then to wage wars backed by the papacy. Being uniquely free from religious censure against gain-seeking along with the high status of their borrowers permitted an end run around church doctrine condemning the charging of interest. It was only a short step to legitimize commercial credit, on the ground that trade helped unify nations as part of divine order, giving each region its own particular role to play in global harmony. Playing the role that the temples of Athena and Juno Moneta had done in antiquity, bankers financed military conquest. Unlike the case in antiquity, owing royal debts to private bankers, often foreign, instead of to public temples led to a proliferation of taxes to pay their interest charges. Rulers sought to pay down the principal by creating crown trading monopolies and selling them for payment in royal war bonds. The new owners tended to be foreign. The Dutch became major investors in England's crown monopolies, including the Bank of England, formed in 1694, as high finance became the mother of monopolies, the East and West Indies companies in Holland, England, and France after about 1600, and the South Sea and Mississippi companies in the 1710s. Remitting their dividends and interest abroad caused a balance of payments drain whose monetary effect was like paying tribute to military victors. The traditional objective of warfare, conquest of the land and natural monopolies to siphon off their rent, has become the prime objective of today's high finance. The strategy is more peaceful, but retains a tributary character. Debt leverage forced Britain and France in the 17th and 18th centuries, the Ottoman Empire in the 19th century, Latin American and African governments the 20th century, to sell off assets to buyers eager to turn public services into opportunities for rent extraction. Since 2008, a similar strategy of asset grabbing has been used against Portugal, Ireland, Italy, Greece, and Spain. The idea is to enable privatizers to turn industrial economies into toll booth opportunities. The idea in today's new enclosure movement is to privatize what used to be called the commons. Russians call this grabitization privatization of public enterprises and natural resources by insiders and their backers. Novelists and historians have been more willing than economists to recognize this dynamic. Honoré de Balzac quipped in Le Père Goriot that behind every family fortune is a great theft, long forgotten or indeed never been found out, because it was properly executed. But not all such origins are forgotten. A century ago, Gustavus Meyer's History of the Great American Fortunes uncovered how many family fortunes were taken from the public domain by colonial land grants, bribery, and insider dealing, and how such fortunes quickly take a financial form. Having gained enough control over government policy to privatize public assets, the financial sector provides credit to buy the right to install toll booths on hitherto public roads, railroads, airlines, and other transport infrastructure. Phone and communications systems. The aim is to extract monopoly rent instead of providing basic services freely or at subsidized rates. Financialization means using this rent extraction for debt service. Avoiding war's financial cost leads to classical liberalism until the world went off gold in 1971. Waging war and paying interest to foreign bondholders required payment in bullion. Gaining monetary bullion by running a trade surplus required competitive pricing of industrial exports. This meant minimizing the cost of labor and its living expenses. Imperial economies that spent vast sums on wars and colonial rivalries raised money by taxing cities and consumers to pay interest on their war debts. In Book V of The Wealth of Nations, Adam Smith describes how each new war loan in England was given a specific dedicated excise tax to pay its interest. By the time of the 7 Years' War between the French and British in America, 1754–63, such war-making and taxing was raising labor's cost of living and hence the basic wage, as did the creation and sale of monopolies. High taxes and prices deterred the development of industry, limiting the ability to wage war. That was the basic conundrum that inspired Britain to transition to free trade imperialism. The perception that military fighting had become a losing proposition economically led early liberals such as Smith to oppose royal wars, colonization, and the taxes levied to pay their costs. The cost of imperial overhead was more than most empires were worth. Smith urged Britain to give the American colonies their independence so as to free it from having to bear the cost of their defense. His contemporary Josiah Tucker described the colonies as a millstone around the neck of England. It was cheaper to give them political liberty, using credit and investment as more efficient modes of exploitation. A rising element of cost in the modern world reflects the pricing of infrastructure services. Public investment traditionally has sought to minimize such costs. But banking viewed great infrastructure projects such as railroads and canal building, capped by the Panama and Suez Canals, as major opportunities to profiteer at the economy's expense. Underwriting fees and speculative gains have been as important as interest extraction, while fraud and kleptocracy always have been rife. That is how America's railroad barons, monopolists, and trust builders became the nation's power elite a century ago, and how post-Soviet oligarchs seized public assets after the neoliberal 1991 reforms. This is what makes financialization antithetical to classical economy's value and price theory. Financial avoidance of public taxes and duties. Now that land ownership has been democratized on credit, a majority of most populations, 2/3 in the United States, and over 4/5 in Scandinavia, no longer pay rent to landlords. Instead, homeowners and commercial property investors pay most of the rental value to bankers as mortgage interest. In the United States, bankers obtain about 2/3 of real estate cash flow, largely by reducing property taxes. The more the financial sector can reduce the government's tax take, the more rent is available for new buyers to pay interest to banks for loans to buy property. This explains why the financial sector backs anti-tax Tea Party protests. It is much the same in industry. Financial analysts pore over corporate balance sheets to measure the cash flow over and above the direct cost of production and doing business. This measure is called EBITDA, earnings before interest, taxes, depreciation, and amortization. Owners and their creditors aim to make as much of this income tax exempt, and they achieve this largely by making interest a tax-deductible expense. Creditors always have sought to break free of tax liability. Lower property taxes leave more rent available to pay bankers, and making interest payments tax-deductible leaves more corporate cash flow available to be paid to bondholders than to stock owners receiving dividends. Banks now receive most of the rental value of land as mortgage interest, at the expense of the tax collector, while bondholders obtain a rising share of corporate profits, or more accurately, of overall EBITDA earnings before interest, taxes, depreciation, and amortization, also at the tax collector's expense. All this lowering of taxes on finance and real estate widens government budget deficits. If bankers can also block governments from creating public money to finance these deficits, the shortfall must be met by borrowing from private bankers, or else, taxes may be raised on labor and industry. And in due course, as public debts grow too large to be paid out of shrinking tax revenue, creditors demand that governments balance their budgets by privatizing public assets and enterprises. The effect is to turn the public domain into a vast set of rent-extracting opportunities for banks to finance. This is the kind of resource grab the IMF and World Bank imposed on Third World debtors for many decades. It is how Carlos Slim obtained Mexico's telephone monopoly to impose exorbitant charges on business and the population at large. It can be seen most recently in the demands by the European Union, European Central Bank and IMF to force Greece and Cyprus to pay their foreign debts by selling whatever land, oil, and gas rights, ports and infrastructure remain in their public domain. What is privatized will become an opportunity to extract monopoly toll booth rents. This financialization and rent extraction is quite different from what classical economists defined as profit made by investing in plant and equipment and employing labor to produce goods and services. The financial sector makes its gains by its privilege of credit creation to obtain interest, fees, and commissions, paid largely out of land rent and monopoly rent. All these forms of revenue are external charges on top of production costs. The role of debt in the war against labor. As labor's wages rose above subsistence levels a century ago, economic futurists depicted a post-industrial leisure economy. Left out of account was that the passport to middle-class status involved democratizing property ownership and education on credit, driving labor into debt to buy housing and, more recently, to get an education. Financial exploitation of labor also occurs when corporate raiders buy out stockholders with high-interest junk bonds as their weapon of choice. The effect is to turn industry into a vehicle for bankers to load down with debt. Corporate raiders may pay their creditors by seizing or downgrading employee pension funds from defined benefit plans, in which workers know how much they will receive when they retire, to defined contribution plans. In the latter, employees only know how much is to be paid in each month, not what will be left for them after financial managers take their cut. It's a big cut. Pension maneuvering becomes a tactic in class warfare when companies threaten to declare bankruptcy if employees do not renegotiate their pension rights, wage levels, and working conditions downward. The rule of the financial jungle is that big fish eat little fish. Companies use employee stock ownership plans, ESOPs, to buy up their own stock, enabling managers to cash out their stock options at a higher price. A rule of thumb has long been that about half the ESOPs are wiped out in corporate bankruptcies. After Sam Zell's leveraged buyout of the Chicago Tribune, the newspaper's employees were left holding an empty ESOP. Federal Reserve Chairman Alan Greenspan described the role of rising personal and mortgage debt in today's evolving class warfare. Under normal conditions, unemployment at the relatively low 1997 rate, about 5.4%, the same as in the boom years 1967 and 1979, would have led to rising wage levels as employers competed to hire more workers. However, Greenspan explained to the U.S. Senate, a high rate of unemployment no longer was needed to hold down wages. All that was needed was job insecurity. As I see it, heightened job insecurity explains a significant part of the restraint on compensation and the consequent muted price inflation. Surveys of workers have highlighted this extraordinary state of affairs. In 1991, at the bottom of the recession, a survey of workers at large firms indicated that 25% feared being laid off. In 1996, despite the sharply lower unemployment rate and the demonstrably tighter labor market, 46% were fearful of a job layoff. Despite the increase in labor productivity from fewer strikes and more intensive working conditions, U.S. wages were failing to rise. A major reason, Chairman Greenspan pointed out, was that workers were afraid to go on strike or even to complain about working conditions for fear of losing their paychecks, defaulting on their mortgage and falling behind on their monthly credit card bills and seeing their interest rates explode as their credit ratings declined. In July 1997 testimony, he said that a major factor contributing to the extraordinary U.S. economic performance was a heightened sense of job insecurity and, as a consequence, subdued wage gains. Bob Woodward reported that Greenspan called this the traumatized worker effect as attrition spread the same volume of work among fewer employees, squeezing out higher productivity. Median U.S. household income rose by a mere 15% during 2001-06, while mortgage credit inflated the cost of housing by 74%. Heavy mortgage debt and other housing and living costs have made workers feel one paycheck away from homelessness. As employees became debt-ridden, widespread home ownership became a euphemism for a cowed labor force. Austerity's squeeze on labor is tightened rents and consumer debt rise, along with shifts to part-time or lower-wage jobs and outright unemployment. Financial appropriation of labor's disposable personal income. The classical idea of a post-industrial leisure economy was to free nations from rent and interest overhead to bring prices in line with necessary direct costs of production, with governments subsidizing basic services out of progressive taxes or new money creation. By contrast, today's financialized version of free markets obliges families to spend their life working mainly to pay banks for the credit needed to survive in today's world. Saddling students and homebuyers with debt has turned their hopes and ambition into a road to insolvency. People can choose which bank to borrow from, which home to buy with a 30-year working life mortgage, and which college to take out an education loan to attend. But whatever their choice, they are subjected to a financialized version of the company store, a deregulated and predatory economy. Something must give way when earnings are unable to cover the stipulated debt service. If banks do not write down their loans, foreclosure time arrives and assets will be forfeited. Next to home ownership, education is the path to the middle class. Student loans are now the second largest category of personal debt, over $1.3 trillion as of 2015, exceeding the volume of credit card debt. Carrying charges on this debt absorb over 25% of the income for many graduates from lower-income families. The 2005 U.S. Bankruptcy Code, written largely by bank and credit card lobbyists, makes it harder to write off personal debts in general, and nearly impossible for student loans to be cleared. The effect is to turn many graduates into indentured servants, obliged to spend much of their working lives paying off the debt taken on to obtain a degree or even for failure to complete their studies, most notoriously at for-profit crypto colleges funded by government-guaranteed student debt. The easiest way for many graduates to make ends meet is to live at home with their parents. Inability to save enough for a home of their own slows the rate of marriages and family formation. By imposing an access fee on the entry point into the middle-class job market, privatizing and financializing the educational system raises the cost of living and this reverses the policy long followed by the United States, Germany, and other successful nations that made their economies more competitive by providing education and other basic services freely or at subsidized rates. Creating a need for loans at the educational choke point turns universities into vehicles for banks to earn government-guaranteed interest. Much as interest charges on home mortgages end up giving banks a larger sum than the sales price received by the sellers, student loan payments often give the bank as much interest income over time as the college or trade school has received as tuition. Consumer credit, home mortgage, and education loans thus treat the labor force much as feudal landlords treated the land and its occupants, as a source of tribute. From finance capitalism to neo-feudalism hiding behind an Orwellian rhetoric that inverts the classical idea of a free market, financial planners are leading the world down the autocratic path that Spain and France took 500 years ago. Without contributing to production, rentier income is overwhelmingly responsible for the wealthiest 1% obtaining 73% of U.S. income growth since the 2008 crash, while the 99% have seen their net worth decline. Yet in contrast to classical economics, Piketty's much applauded neoliberal attempt to explain today's economic polarization does not single out finance and rent-seeking, so his remedy does not include focusing tax collection on rentier income or deprivatizing infrastructure monopolies by restoring a mixed public/private economy. The drive to widen political democracy was expected to avoid this fate. Voters were expected to elect politicians who would put in place fiscal and regulatory checks against rentiers, so that industrial capitalism could use its economic surplus to expand markets and, in the process, raise living standards. The idea of asset price inflation as a financial strategy, extending credit in ways decoupled from helping economies grow, was nowhere on the intellectual horizon. Thorstein Veblen was almost alone in explaining how Wall Street's financial engineering was undercutting industrial capital formation. Paying bankers and bondholders at the real economy's expense is antithetical to industrial capitalism. The financial business plan is to turn economies into a set of rent traps, carving out privileges whose purchase and sale is financed by banks and bondholders. Instead of lowering the cost of basic services to make economies more competitive, the effect is to load them down with debt to extract interest, fees, and rentier overhead. This destructive policy inflates the economy's cost structure by building in higher user fees for the privatized monopolies and a rising flow of debt service to bankers, while imposing debt and rent deflation on the core economy. Replacing government as our epoch's central planners, the aim of Wall Street, the City of London, Frankfurt, and other financial centers is to draw into their own hands all the economy's net income, followed by the assets that produce it. It is easier to make money by financial manipulation and debt-leveraged bubbles than by the hard work of designing new products, organizing production facilities, hiring and training labor and a marketing and sales force. That is why the shift of economic and social planning into the hands of financial managers has undercut the US and British economies as industrial exporters. Financializing the income streams from toll booth privileges is not about earning profits by tangible productive capital investment. It is about appropriating the public domain on credit. This financial mode of expropriation reverses the happy assumption that the momentum of historical progress will, by itself, ensure the primacy of legal systems regulating property and creditor/debtor relationships in the economy's broad long-term interest. The consequence of real estate, corporate control, monopoly rights, and access to education and other basic needs being bought increasingly on credit is to turn nominal ownership into mere stewardship on behalf of the banks and bondholders. This locking of populations into paying financial tribute is now portrayed as a moral and legal right. The rentier rake-off of revenue is not a necessary cost of production. It makes economies less competitive. Instead of the industrial capitalism envisioned by classical reformers who hoped to free the economy from rent-extracting elites, this rentier mode of exploitation is a regression to feudal-type privileges for elites to charge extortionate prices for basic needs. It is what Hyman Minsky called money manager capitalism, allocating savings and credit to serve the 1% in extractive ways, pushing a widening swath of the population into austerity and negative equity. Today's bankers and bondholders are expropriating property owners in ways not anticipated a century ago, when elites worried that socialism might play this role. At that time the financial sector appeared to be the strongest buttress of the security of property, if only because collateral needs to be secure in order to be pledged for a loan. But foreclosure-wielding creditors always have threatened to expropriate indebted owners. The greatest threat to broad income distribution, economic efficiency, and higher living standards thus turns out not to be finance capitalism, not socialism. Families have been pushed, prodded, and seduced onto the debt treadmill to pay a rising tribute for what they imagine is to be their economic independence in owning a home. Bank mortgages accounted for 60% of the overall value of U.S. housing by 2012. As market prices fell while debts remained in place after 2008, the share of homes actually owned by American homeowners plunged below 40%. The price is long-term debt servitude, along with the cost of getting an education these days. The financial cover story to reverse classical tax and economic reforms under classical political economy and socialism, at least of the type expressed after Europe's 1848 revolutions, governments were to receiving the rental income of land and natural resources. Instead, today's financial sector is privatizing these rents for itself and its clients. In conjunction with this rent extraction, the essence of debt serfdom is to siphon off disposable personal income by obliging home buyers, students, and consumers to pay all their net earnings above subsistence as interest. For most home buyers, market equilibrium prices are set at the point where debt service absorbs the full site rental price. This phenomenon reflects the degree to which the core policy aim of classical economic doctrine has been reversed and, if the financial sector has its way, consigned to oblivion. A similar predatory financial dynamic has taken over industry. As Chapter 8 has described, creditors finance corporate raiders who pay out profits as interest and cut back capital investment so as to use earnings simply for stock buybacks and quick dividend payouts to raise its price. Financial short-termism is thus the opposite of industrial forward planning and tangible capital formation. Bankers depict their extraction of debt service as a necessary cost of production, as if the economy would not work without their service of allocating resources to decide who best should receive credit. In reality, banks push debt onto anyone with property to collateralize or earning power to sequester. Their business plan is to maximize financial claims on the means of production, up to the limit at which interest absorbs the total disposable income, leaving debtors to perform the economy's actual work. Pro-creditor ideology depicts loans and credit as enriching borrowers along with lenders in a fair bargain that produces gains for everyone. Borrowers acquiesce in the financialization of real estate as long as they believe that buying homes, or academic degrees, on credit may enrich them. They are willing to submit to austerity if they believe it is a necessary interlude to resume economic progress. The reality is that it sinks them deeper into debt, while widening government budget deficits and leading to demands by the 1% to cut back social services, starting with pensions and social security. Pro-creditor deceptions require censoring the economic history of how financial dynamics actually have evolved, because the lessons are clear enough over the millennia. Little lending has funded new means of production. That is the financial tragedy of our time. Neither the banking system nor the stock market is funding tangible capital formation to increase production, employment, and living standards. Instead, exponentially rising debt service creates a chain reaction that weighs down the economy until it collapses into an inert leaden state. Meanwhile, the 1% endow business schools and think tanks to convince the public that there is no such thing as unearned income and wealth. The demographic effect of blurring this concept can be seen in statistics of rising suicide rates, shortening lifespans and falling birth rates, and emigration. A blind spot to these corrosive effects of financial practice is what makes post-classical rentier ideology value-free. Making money from privatization, asset price inflation, the bubble economy, and corporate looting is euphemized as wealth creation. Banks create credit to bid up prices of existing real estate, stocks, and bonds, while the stock market serves as a vehicle for corporate rating and leveraged buyouts to replace equity with high-interest bonds. Instead of alleviating debt pressures, the financial system raises dependency on further credit to carry the debt burden. The destructive character of financial conquest. The owl of wisdom only flies at night. Only after a major collapse is it easier to see the wrong-headed turns that have been taken. Debt-leveraged buyouts have not financed new capital investment, but have bled companies to pay bondholders and activist shareholders. But until Warren Buffett characterized Wall Street's derivatives as weapons of mass financial destruction, most economists failed to recognize the destructive power of debt creation and how the 1% lend out their savings to indebt the 99%. The effect is much like the physicist J. Robert Oppenheimer's 1965 description of the atom bomb's Trinity explosion, when he recalled the Bhagavad Gita's words of Vishnu, "I am become death, destroyer of worlds." From F. Scott Fitzgerald's The Great Gatsby to Tom Wolfe's Bonfire of the Vanities, novelists have symbolized the very rich as irresponsible auto drivers killing innocent pedestrians. "They were careless people, Tom and Daisy," wrote Fitzgerald. "They smashed up things and creatures and then retreated back into their money or their vast carelessness or whatever it was that kept them together, and let other people clean up the mess they had made. That is what makes the rich different. The collateral damage from their attacks is as irresponsible as it is devastating. They are insensitive to how their actions impact the life of others." Posing as job creators, rentiers claim to be proxies acting like shepherds as a virtual government. Their wealth is supposed to trickle down, somehow, as if by helping themselves financially, they also will help economies grow. So today's creditors call financialization wealth creators, whom Goldman Sachs describes as doing God's work. Just as the drivers in Gatsby and Bonfire responsible for crashes left others to bear the blame, so the 1% seeks to shift responsibility onto the financial victims, the madness of crowds. Governments are blamed for running deficits, despite the fact that they result mainly from tax favoritism to the rentiers. Having used FICA paycheck withholding as a ploy to cut progressive tax rates on themselves since the 1980s, the 1% blame the indebted population for living longer and creating a retirement problem by collecting the Social Security and pensions. This is financial warfare, and not all wars end with the victory of the most progressive parties. The end of history is not necessarily utopia. The financial mode of conquest against labor and industry is as devastating today as in the Roman Republic's social war that marked its transition to empire in the 1st century BC. It was the dynamics of debt above all that turned the empire into a wasteland, reducing the population to debt bondage and outright slavery. Livy, Plutarch, and other Roman historians placed the blame for their epic's collapse on creditors. Tacitus reports the words of the Celtic chieftain Calgacus, c. 83 AD, rousing his troops by describing the empire they were to fight against, robbers of the world, having by their universal plunder exhausted the land. If the enemy is rich, they are rapacious; if he is poor, they lust for dominion. Neither the East nor the West has been able to satisfy them. To robbery, slaughter, plunder, they give the lying name of empire. They make a wasteland and call it peace. The peace brought by Rome turned out to be a world reverting to subsistence production on the land as cities became deserted. Rome became the model of what happens to economies that do not annul their debts but polarize between creditors and debtors. Its history and hence, antiquity ended in a convulsion of depopulation and a dark age. Commanded by a creditor oligarchy, Rome's imperial conquest was belligerent, with an oppressive anti-labor spirit that Tacitus explained elsewhere. Agricola 32. It belongs to human nature to hate those you have injured. The financial sector's awareness of how rapaciously it obtains its wealth makes it fear and hence hate its victims. So we are brought back to the basic theme of this book. Contrary to expectations when the Industrial Revolution was gaining momentum, finance is stifling industrial potential, raising the specter of lapsing back into the ancient usury dynamic with exponentially accruing debt dependency. Much like creditors in ancient Rome, today's financial power seeks to replace democracy with oligarchy. We are seeing a resurgence of primitive accumulation by debt creation, foreclosure, and privatization. The oligarchic strategy is to politicize this financial drive. Here, as usual, novelists are ahead of the economics textbooks. As Mario Puzo summarized matters in his movie scenario for The Godfather, Part 3, 1990, Vincent Mancini, Don Lucchesi, you are a man of finance and politics. These things I don't understand. Don Lucchesi, you understand guns? Vincent Mancini, yes. Don Lucchesi, finance is a gun. Politics is knowing when to pull the trigger. The ECB, EU Commission, and the IMF held the financial gun to Greece's head in June 2015, and pulled the political trigger to pressure Greece to a regime change by threatening the Greek Prime Minister Tsipras with financial crisis if he did not adhere to the program negotiated by the pro-austerity PASOK and conservative coalition he had recently been elected to replace. The weapon perhaps is better characterized as a financial noose, drawn tighter each day. 28 Is the mode of parasitism overshadowing the mode of production? In an era of finance, finance mostly finances finance. Jan Toporowski, Why the World Economy Needs a Financial Crash and Other Critical Essays on Finance and Financial Economics, London, 2010. Nearly all economic writings published in the late 19th and early 20th century defined wealth in terms of the means of production, factories, plant and machinery, technology and public investment in infrastructure and education. Seeing the Industrial Revolution's soaring rise in productivity stemming from the use of energy from water power to steam power to internal combustion engines and electrification, economists anticipated a leisure economy. Today's deepening austerity, unemployment, and emigration is not a failure of this technological potential, nor is it the kind of overproduction crisis that early critics of industrial capitalism warned about, wage labor being paid too little to buy the goods it produces. Employers exploiting wage labor are always a problem, of course. But today's overwhelming economic problem is predatory finance, to a degree that few expected a century ago, with the notable exception of Thorstein Veblen. Thomas Piketty's Capital in the 21st Century has quantified what nearly everyone knew intuitively: the 1% have doubled their share of wealth over the past generation. Less attention has been paid to how they amassed this wealth. It has not been by investing in capital goods and hiring labor in the way textbooks describe industrial capitalists as doing. Most fortunes are made by rent-seeking and debt pyramiding, financializing real estate and corporate industry, and creating or privatizing monopolies. The most pressing political struggle of our time is how to cope with financial centers in control of central banks and governments, plunging economies deeper into austerity, leaving the industrial economy by the wayside. Banks no longer lend to the non-bank business sector, writes UMKC professor Jan Kragel. If at all, they primarily lend to themselves, i.e. to other financial institutions. The taproots feeding this financial power are real estate rent, natural resource rent and monopoly rent, which are capitalized into interest-bearing debt and debt-leveraged capital gains. This financialization based on rent extraction has transformed the character of wealth. Instead of investing in plant and equipment to hire more labor to produce more output, money is made financially, while the economy shrinks. Already in the 19th century, economists across the political spectrum, from Marx to Henry George, described financial claims as fictitious capital. Frederick Soddy, the great English chemist and polymath, called financial claims virtual wealth. But few expected creditor claims in the form of bonds, stocks, and bank loans on the liabilities side of the balance sheet, to become dominant over the asset side, the material means of production. That would be like a shadow taking over a body. But that is what has occurred. There was no thought that free lunch rent would be capitalized into interest-bearing bank loans to become the basis for most bank credit and debt creation. Rent was expected either to be taxed away, if rent-yielding land rent and natural resource rent was left in private hands, or rent-yielding assets would be nationalized and socialized. Financialization of economic rent is mainly responsible for polarizing today's economies, and then shrinking them by debt deflation. Today's financial mode of wealth creation by arbitrage, derivative gambles and credit pyramiding capped by foreclosure and privatization is overpowering the industrial mode of production, making fortunes on a much vaster scale than profits created by industrial capital. These fortunes are made at the economy's expense. In alliance with other rent-extracting sectors, finance acts from above the industrial economy to indebt it and then rake off debt service, while inflating access prices to housing, education and infrastructure services. So much of the wage earner's paycheck must be diverted to pay debt service and rent extraction that the domestic market for goods dries up. Instead of the promised leisure economy, the world is entering a financialized age of austerity. Labor may be paid more and more, but its rising wages are stripped to pay the finance, insurance, and real estate, fire, sector. Unproductive fortune building, free lunches, and their apologists. No one likes freeloaders. Children of the rich are especially prone to worry about being unproductive. Inheritors of wealth, a psychologist on the Wells Fargo Wealth Team observes, feel they don't deserve money and have shame and guilt. They feel isolated and closeted. Even the language we use to describe such people is mocking. There are so many negative words attached to inheritors: trust fund baby, silver spoon, spoiled brat. There's no positive associations. In contrast to this negative but realistic self-image, lobbyists for rentiers provide their clients with a productive mask. For banks, the trick is to convince borrowers that debt leveraging will help borrowers obtain wealth and to accept their losses when their dreams turn into a living nightmare, blaming themselves instead of the system. The public relations aim is to numb popular awareness of the fact that running into debt historically has meant losing the homestead and the public commons of entire nations. Claiming that there is no free lunch, they depict the 1% as productive helpers in a symbiosis for mutual gain. Indoctrinating his Harvard students to defend the 1% who get rich in banking and finance, America's leading textbook writer Greg Manke attributes their wealth to their service of allocating society's resources. Those who work in banking, venture capital and other financial firms are in charge of allocating the economy's investment resources. They decide, in a decentralized and competitive way, which companies and industries will shrink and which will grow. It makes sense that a nation would allocate many of its most talented and thus highly compensated individuals to the task. Bankers appear as prudent lenders guiding credit to what is most productive. Right, comments one blogger. These are the clowns who allocated a shit-ton of capital to building whole counties full of homes with styrofoam pediments during the last housing bubble, which culminated in the largest upward transfer of wealth in world history. But despite the fact that financial institutions have proven to be a disaster in the way they have allocated savings and credit mainly to indebt the rest of the economy, it has been a calamity for the 99%, not for themselves. Their maneuverings have made them rich. Most fortunes grow simply by inertia, accruing interest and rent charges in the recipient's sleep, to paraphrase John Stuart Mill's description of landlords. The winning strategy is to extend credit to indebt the rest of society. The debt overhead that makes most of the money for the 1% is paid for by the 99%, leaving less and less for investment or living standards. So today's main political issue is how to save economies from the Financial sector's alliance with rent extractors and the rentiers' coordinated attack on the government's power to tax wealth or allocate resources. To protect their wealth, the super-rich depict their takings as adding to productivity, and fight against democracy, land reform, progressive taxation, socialism, and strong government as potential threats to their takings. Their weapons are deception, force, and bribery, backed by control of the courts. Modes of production versus modes of appropriation. The financial crisis now plaguing Western economies is age-old. Throughout history, the greatest fortunes have been obtained by lending and foreclosing, above all by privatizing the commons, the public domain, by indebting governments to force sell-offs, or simply via insider dealings and fraud. It would be a travesty of language to say that the resulting privatization rents, financial extraction and capital gains are earned. Somebody must lose when debts grow too large to be paid. So bankers and bondholders seek to capture the government to protect themselves from losses, leaving pensioners, mortgage debtors, and students to deal with the backwash of debt deflation. For the public sector, debt-strapped governments from Ireland to Greece are told to obey creditor demands to scale back schooling, health care, and infrastructure maintenance, and to privatize the public domain. Sacrificing the economy on the altar of debt, the financial system has been saved at the economy's expense. It is a measure of how predatory today's public policy has become that the huge banking conglomerates that provided credit were kept intact, but not the businesses and households whose balance sheets were being destroyed. Solving the debt problem for the 99% would involve writing down the savings and other financial claims on the opposite side of the balance sheet. But the 1% has placed its representatives in the Treasury and the Federal Reserve, and backed the election of the leading congressional committee figures dealing with banking. The political problem always comes down to the question of who will bear the losses. The 1% insist that if the personal, real estate and corporate debts of the 99% are to be written down, the government will bail out creditors. The 99% must pay in another way in their capacity as taxpayers. When debtors no longer can pay funds, making the 99% poorer is thus not an accidental byproduct of the behavior of the 1%. Bank lobbyists have put their own Tim Gaithners in place precisely to act as their defenders in such situations. If they succeed in blocking bad debts from being written down, bankers and bondholders will kill the economy by plunging it into austerity. When debts cannot be paid, the choice is between annulling them, or keeping them in place and letting creditors foreclose or bailing them out with public funds. Favoring creditors polarizes economies by siphoning income and transferring assets upward to creditors. This financial conquest must be blocked by resuming the fight to tax unearned income and indeed, to minimize it in the first place, by protecting basic public services, including banking, from being appropriated by rent extractors. Today's economies will stagnate unless they are freed from rentier parasitism and debt creation. The financial oligarchy will bring its creditor power to bear against labor and democratic government regulation, worsening poverty and stripping the environment to pay the exponentially expanding debt overhead. What kind of post-industrial economy will we have? Today's most pressing economic fight is not simply between labor and employers. It is being waged by rentier interests against labor, industry, and government together. This makes today's reform task more far-reaching than the social democratic movement a century ago. Financial and rentier reforms play little role in the party platforms of today's ostensibly socialist and labor parties. From Britain to Greece and even the United States, they are leading the fight for balanced budgets and fiscal austerity at the Tony Blair, Barack Obama, and Papandreou extreme. It is as if recovery depends on the super-rich getting richer, not on rescuing debt-ridden Greece and Cyprus, Ireland, Italy, and Spain. The problem that will occupy the next few generations is how to undo the financial knots into which today's economies have been tied. Clearing away the overgrowth of debt requires countering the neoliberal junk economics crafted to disable society's defense mechanisms against financialization and unearned income. There have indeed been courageous U.S. officials, such as Sheila Bair and Neil Barofsky, whose sense of fairness was offended by the giveaways to the large banks and their bondholders. Former Wall Streeters Nomi Prince and Eve Smith, the intellectual force behind the Naked Capitalism website, have explained the financial rip-offs at work. UNC's modern monetary theory website New Economic Perspectives provides a commentary on how needless today's financial austerity is, in light of the power of central banks to fund economic growth. But their voices are all but drowned out by the parroting of pro-bank austerity economics across the political spectrum. Nobody anticipated that democratic societies would vote for policies that would support the 1% by impoverishing themselves. Political leaders treat interest and economic rent as secondary concerns while welcoming asset price inflation and privatization. The economic vocabulary has been corrupted to depict exploitation as wealth creation, which it is for the 1% under the current system, but at the cost of the 99%. Latvians have repeatedly voted for neoliberals imposing Europe's most extreme austerity. Most notoriously, Ireland's politicians paid foreign bondholders and hot money arbitrageurs at the cost of imposing domestic poverty. Voters finally replaced its neoliberal politicians, but the new party coalition did not repudiate the debts that were taken on. In the United States, Britain, and France, no major political party or labor organization has challenged the oligarchic principle that tax rules, financial regulations, and the legal system should be run for the benefit of the FIRE sector serving the 1%. Today's passivity by the 99% in the face of a rentier counter-enlightenment reflects the degree to which voters have come to accept the neoliberal financial and tax system as part of the natural environment, as if there indeed is no alternative. What is needed is a perspective enabling people to see the reforms that would counter today's corrosive FIRE sector mode of fortune creation. The difficulty in promoting this understanding is that its logic and implications are radical as they were in the 19th century, when they were sponsored by a broad range of reformers, from the Ricardian socialists around John Stuart Mill urging nationalization of land rent, by outright purchase or rising land taxation, and Christian socialist ideals of communalism to Marxism, based on nationalizing all means of production, factories as well as public infrastructure. It seemed that the residue of feudalism was being swept away at the very least by land taxation and antitrust legislation, while banking was becoming industrialized. But this has not occurred. The leading efforts to free economies from the legacy of feudalism were defeated. After World War I, the focus of value and price theory on economic rent was replaced by a more trivialized economics curriculum excluding the concept of unearned income and the distinction between productive labor and overhead. Will financialized economies self-destruct? Warning against sacrificing the economy to subsidize the financial sector, Chief Financial Times commentator Martin Wolf writes that the key policy guide should be, first, do not pay too much attention to the financial sector's self-interested bleeding. The financial sector has put the economy into trouble. If the government is forced to take part of the risk of putting the system back together again, it must protect the public interests first. As a final do not, he urges, do not bail out mortgage lending via government subsidies. By now it should be evident that the British obsession with speculative home ownership is a snare and a delusion. Let the market deflate, as it should. If creditors have their way, they will destroy the economy. Citigroup chief economist, and former advisor to Goldman Sachs, Willem Buiter acknowledged in 2012 that, the most likely insolvent sovereigns Greece, Portugal, Ireland, Cyprus, and possibly Spain, Italy and Slovenia, cannot grow without debt restructuring. He saw the risk of sovereign default highest for Ireland's €63 billion of official debt. Austerity fatigue in the periphery and growing bailout fatigue in the core mean that the ECB/Euro system is the only Santa Claus capable of filling the solvency gaps of sovereigns and banks in the euro area. But German, Dutch, and Finnish finance ministers opposed this. The financial system had become reckless by joining in a rentier consensus with the 1% to oppose government powers to tax or regulate any form of wealth and against labor seeking to improve its working conditions, wages, and pensions, even though winning the war against labor destroys the domestic market and hence the ability to pay debts owed to the financial sector. It doesn't have to be this way. It is now 2 centuries since the Saint-Simonian proposals to subordinate credit to serve industry. Classical tax policy sought to ward off the rentier economy that the post-World War I century has brought about by untaxing economic rent, privatizing basic utilities, and failing to socialize banking to prevent bank credit being lent against economic rent. Debts cannot be written down as long as people imagine that keeping them in place is necessary to prevent depression by preserving confidence in the financial system. Such confidence helps deepen today's malaise. Industrial capitalism or finance capitalism. Lenin said that capitalists would sell communists the rope to hang them. But capitalists themselves have produced the rope in the form of predatory finance extracting interest, dividends, fees, and various forms of rent from industry, real estate, households and also from governments. Capital gains are produced by debt pyramiding, which paves the way for debt deflation of the real economy. The question is whether finance capital can survive simply by lending to speculators in search of interest, rent extraction, and asset price gains, or gambles as finance capitalism mutates into casino capitalism. Of course, there are many necessary functions provided by banks. But the collapse of today's financialized economies into negative equity is largely the product of a few giant Wall Street institutions. As economist Randy Ray notes, we have 4,500 honest banks. We have a half-dozen huge banks that are run as control frauds. Our financial system's main problems can be found among those SDI's systemically dangerous institutions. We will not get back our economy or our government until we close them. Fiscally, today's problem is akin to that of 16th century Spain, whose landed aristocracy taxed labor and incipient industry in the towns while living tax-free in luxury. In 18th century France, a similar tax shift sparked the Great Revolution. That was the only way to break the rentier stranglehold, adding to the cost of labor and its products. Today's financial counter-revolution against the reform movement of the 19th and early 20th centuries has shifted taxes off the fire sector onto labor and industry, much as did medieval Spain. The Republican administrations of Ronald Reagan and George H.W. Bush cut income taxes on the top brackets and capital gains taxes on real estate and finance, while adding a proliferation of sales and value-added taxes and wage withholding set-asides, and quadrupling the U.S. public debt between 1981 and 1992. Adding this regressive fiscal burden to the debt overhead has left only one way for the economy to survive without cutting back consumption levels: to borrow from banks to buy what wages and salaries no longer are sustaining. So more debt seems to be the only solution to today's over-indebtedness. That is the inner financial contradiction of our post-bubble economy. Financial and debt reform will still leave labor and environmental problems. It is easy to forget how optimistic Marx and other socialists of his day were about the future of industrial capitalism. He expected the industrial mode of production to emerge victorious over all forms of parasitic rentier activities. Enlightened class consciousness and political democracy were expected to usher in a world of rising living standards, better working conditions and less unfair distribution of income. Like most evolutionary economic forecasters of his day, Marx expected industrial capitalism to free itself from the excrescences of landlordism, monopolies, and other forms of exploitation. But the banking and landlord class that were mutual enemies in Ricardo's day have joined forces since World War I. As this has occurred, Social Democratic and Labour parties abandoned the issue of land rent to the liberals and single taxers, whose ranks dwindled rapidly. And despite an early 20th century focus on finance capitalism by Rudolf Hilferding, Lenin, and other Marxists, monetary and debt analysis has been left mainly to right-wing bank advocates, from followers of Ludwig von Mises to Chicago-type monetarists. In the early 20th century, the fight between employers and labor was expected to be the major tension shaping future politics. But today, labor is fighting simply for jobs, seeing a harmony of interest with employers in place of the class conflict of a century ago and imagining that finance helps industrial hiring rather than downsizing and outsourcing it. Housing has become more widely distributed, public pensions and health care have at least been promised, and a new world of opportunities has opened up. But the democratization of home ownership has enabled lobbyists for large commercial and rental property owners to make untaxing real estate a seemingly democratic aim. This demagogy reached its pinnacle in California's notorious Proposition 13, which froze taxes on commercial and rental properties as well as homes. Coupled with other tax favoritism for real estate and finance, the result has been a sharply regressive tax shift enabling financial power to grow stronger than industrial power. Industry is being financialized more than finance has become industrialized. The remedy is to write down debts and reform the tax system. Our financial problem is like a parasite on a sick body. The host needs to get rid of the intruder before it can heal itself. Downsizing finance will not, in itself, avert the threatened privatization of the post office, water systems, roads, and communication, or cure the high cost of privatized medical insurance and other infrastructure. Once you remove the debt drain and rentier burden from industrial capitalism will still leave the familiar old class tensions between employers and their workers. This will still leave the familiar labor problems of industrial capitalism, the fight to provide fair working conditions and basic necessities to all citizens, as well as to avoid war, environmental pollution, and other social strains. However, the rise of financial power is working against all these objectives, preventing society from healing itself. As Alan Greenspan noted in the passages cited earlier, hooking traumatized labor on the debt treadmill is a major factor deterring workers from pressing for wage increases and better workplace conditions. Without resolving the debt overhead and providing a public option for banking services, the other problems are made much worse. Ancient mythology asked how King Midas could survive with nothing to eat but his gold. This threatens to be a metaphor for today's finance capitalism, a dream that one can live purely off money, without means of production and living labor. To avoid this fate, the remedy must add financial reform to the 19th century's unfinished revolution to sweep away the surviving inequities of post-feudal land grabbing, seizure of the commons and creation of monopoly privileges. These are the vestiges of the past appropriations and insider dealing that underlie rent-seeking and endowed a financial system that remains grounded in neo-feudal practice instead of investing in industry and human well-being. 29. The fight for the 21st century. If Europe wants the division and the perpetuation of servitude, we will take the plunge and issue a big no. We will fight for the dignity of the people and our sovereignty. Alex Tsipras, rejecting the Eurozone's bailout terms in June 2015. In 1933, as the wake of World War I's financial wreckage gave way to the Great Depression, the philosopher H. G. Wells wrote a novel about the conflict he expected to emerge by the last quarter of his century. Reminding his readers of the perennial struggle of life against the creditor and the dead hand, he described society's forward effort seeking to break free of past debts and financial claims. Viewing debt as a retarding force, Wells forecast that matters would come to a head in the year 1979 when his fictional character Austin Liveright would publish Bankruptcy Through the Ages. We need only refer the student to the recorded struggles in the histories of Republican Rome and Judea between debtor and creditor, to the plebeian secessions of the former and the year of jubilee of the latter. The year 1979 indeed turned out to be precisely when interest rates peaked at a modern era high of 20%. As an example of the parallel struggle against landowners seeking to avoid taxes, Wells cited England's Statutes of Mortmain, 1279 and 1290, protecting the land from passing to the church via bequest, foreclosure, or sales made to avoid the epoch's feudal duties. Throughout history there has been a constant tension between royal or public authority and creditors or wealthy patrons seeking to indebt the land and its population to themselves so as to replace public power with their own. But whereas the great political fight of the 19th century was to nationalize or tax land and natural resource rents, today's fight must be to socialize banking and finance, which have become the ultimate recipient and hence main defender of such rents. The actual financial crisis of 1979 was resolved in a way that led in the opposite direction from what Wells had forecast and progressive economists recommended. Instead of debtors achieving a clean slate to wipe out the debt overhead, the incoming 1981-92 Reagan-Bush administration sponsored a wave of new credit/debt, so large that interest rates declined steadily during the 1980s. At first, this debt creation was used to inflate property and stock markets. Whereas the Vietnam War and ensuing Carter inflation, 1977-80, had bid up wages and commodity prices, the subsequent neoliberal inflation bid up asset prices, reinforced by tax cuts on real estate, capital gains, and the upper income brackets. This shift to regressive taxation was the reverse of what economists and futurists had expected. Instead of economies becoming more equal, they polarized increasingly between creditors and debtors. The Reagan-Bush budget deficits quadrupled U.S. public debt, while easier credit fueled a debt overgrowth that became precisely what Wells foresaw and warned against, a dead hand of financial claims leading to the crash of 2008 and its aftermath. Contra Wells, the world barely put up a fight to break free from this dynamic. Shifting the tax burden and the cost of bank bailouts onto labor and taxpayers after 2008 gave Wall Street, and its counterparts abroad, the power to hold entire nations in debt. Restructuring the financial system is hard to do when people are engulfed in a crisis, especially when they imagine that they can recover by borrowing more and fear that there is no alternative. The reality is that history is rife with possible remedies. These remedies almost always involve debt write-downs. There is an alternative. If we were designing a perfect world, we would put the economy's long-term interests above financial short-termism. We would organize banking and financial systems in a way to keep credit productive and within the ability of debtors to pay. In cases where predatory credit and debt exceeds the means to pay or threatens to impose austerity and debt deflation, it would be annulled. The reason why the world isn't pursuing such restructuring is that creditors have gained power over governments and public opinion to persuade people that it is possible for economies to continue along the present path, and even that austerity can somehow restore balance and prosperity. Few people would expect that as financial crises intensify and polarize economies further between creditors and debtors, governments will fail to restructure the financial system. But Hayek's hyperbole in The Road to Serfdom characterizes public planning, taxation, and regulation as metaphoric serfdom. This reflects the 1%'s fear and even hatred of democracy, progressive taxation, and public enterprise and social spending programs. In their place, Hayek's acolytes would set economies on the road to literal debt serfdom, a state of dependency in which access to housing and education requires taking on a lifetime of debt. The way that history was supposed to unfold was that banking would provide credit for capital investment. Public services were to be offered at falling prices, ultimately freely, to a widening population. But instead of evolving toward such socialism, bankers and wealthy elites found rent extraction to be their major source of gain. Calling their opposition to a government strong enough to keep them in check libertarian, their aim is simply to replace democratic government with planning by bankers and bondholders. To call their rent extraction and debt-financed asset price inflation wealth creation, is to adopt the vocabulary of rentiers. 10 Reforms to Restore Industrial Prosperity. 1. Write down debts with a clean slate, or at least in keeping with the ability to pay. 2. Tax economic rent to save it from being capitalized into interest payments. 3. Revoke the tax deductibility of interest, to stop subsidizing debt leveraging. 4. Create a public banking option. 5. Fund government deficits by central banks, not by taxes to pay bondholders. 6. Pay Social Security and Medicare out of the general budget. 7. Keep natural monopolies in the public domain to prevent rent extraction. 8. Tax capital gains at the higher rates levied on earned income. 9. Deter irresponsible lending with a fraudulent conveyance principle. 10. Revive classical value and rent theory, and its statistical categories. 1. Write down debts that block recovery. A convulsion of bankruptcy is the price to be paid for the financial sector's sabotage of the tax system and regulatory capture of oversight agencies. Chapter 9 has described how most observers in 2008 saw that overlending for junk mortgages had caused a bubble, asset price inflation, and urged that debts should be scaled back to the ability to be paid, viz. 9 below. Such write-downs in 2008 would have avoided the widespread foreclosures that threw 10 million homes onto the market at distress prices. Banks opposed such write-downs because this would have imposed losses on themselves, their bondholders and other financial players. The Federal Reserve created enough monetary reserves for the banks to make up for their losses, but nothing to bail out homeowners. No pressure was exerted to take troubled, that is, overly aggressive and predatory, banks public or prosecute their officers for the mortgage frauds and underwriting frauds that were part and parcel of the crash. The FDIC was prepared to do this with Citigroup in 2008, using the bank's surviving reserves to cover the claims of insured depositors as distinct from stockholders, bondholders, and uninsured counterparties. But it was blocked by the Treasury. In addition to creating money directly for banks to borrow as reserves, earning a free interest markup, the Fed sought to reinflate the real estate market so that bank mortgages could recover their price levels. Banks refrained from foreclosing on homes in arrears largely to keep Fannie Mae insured loans on their books, adding late fees and penalties to their interest charges against mortgage debtors. Bankers depict even a partial debt write-down as threatening anarchy, their euphemism for having to take a loss when the system they designed and deregulated goes bust. But the alternative to write-downs is financial breakdown and impoverishment. A clean slate would make a public option for banking easier to introduce. This would help banks evolve into public utilities. It also would facilitate the rent taxes that 19th-century free market reformers intended. Trying to save appearances by keeping bad debts on the books has led to debt deflation gnawing into consumer demand and business investment. So we are left with the inconvenient truth that if financial claims are not annulled, the result must be an increasingly top-heavy oligarchy imposing chronic austerity, making it even harder to pay down the debt burden. 2. Tax economic rent to save it from being capitalized into interest payments. To help prevent such financialization from recurring after a debt write-down, it is necessary to reform tax policy by focusing it on rent extraction and capital gains. Otherwise, banks and financial markets will continue to create credit mainly against land rent for real estate, natural resource rent for the oil and mining sectors, and monopoly rent for infrastructure being privatized from the public domain. Land rent heads the list because real estate remains the largest asset in nearly every economy. As Chapter 7 has described, some 80% of new bank credit takes the form of mortgage loans, whose main effect is to bid up property prices. This price rise serves as poisoned bait for home buyers, and also activist shareholders in the stock market, hoping to get rich by debt-leveraged capital gains that increase their net worth on paper. These gains cannot be sustained if the debt creation process smothers the economy. In 2011, the U.S. Housing Finance Agency raised its guarantee for mortgage debt service to 43% of family income, up from the customary 25% rule of thumb prior to the 1980s. Down payments were reduced in 2013 from 5% to just 3%. These looser guidelines enable families to borrow more and housing prices rise to however much a bank will lend. But instead of elevating families into the middle class, the inflation of home prices becomes a treadmill to debt peonage. Inflating prices for rent-yielding assets creates a vested interest in expanding unproductive credit creation to prevent a collapse of asset prices leading to negative equity. This forces the economy to choose between two evils: yet more debt, extend and pretend, inherently short-term, or the inevitable bankruptcies and forfeitures to creditors in the end. Classical rent theory demonstrates what seems to be counterintuitive: raising property taxes holds down what banks will lend, and hence the price of housing, because rent paid to the tax collector is not available to be capitalized into bank debt. But the financial sector popularizes the illusion that lower property taxes will make home ownership more affordable. Bankers know that lower taxes will leave more of the property's rental value available for new buyers to pay interest, or existing owners to borrow against by taking out home equity loans. What homeowners seem to gain in property tax cuts ends up being paid in higher mortgage costs of buying homes. Taxing land rent, and also natural resource rent and monopoly rent, has three positive effects. First, it keeps property prices low by preventing this rent from being capitalized into bank loans. Second, it frees labor and industry from taxes on wages, profits, and sales, alleviating most family budgets. Third, banks will be obliged not to create as much new debt that merely becomes a cost of transferring ownership rather than contributing to real output and productivity. Taxing rent is administratively easy. The United States has over 20,000 appraisers whose job is to assess the market value of buildings and land separately. In the case of natural resources, oil and mining companies typically buy crude from producer countries at low prices reflecting actual production costs. Payment is made by tax avoidance flag of convenience countries such as Panama or Liberia, which conveniently use the US dollar, which sell the oil at a markup to refineries in the oil-consuming nations. This markup is pure resource rent, not profit in the classical sense. It is untaxed. For monopolies, economic rent is revenue that cannot be explained by spending on tangible capital investment and labor. There is a long tradition of untangling the maze of fictitious cost accounting. During World War II, the U.S. government applied this principle in its excess profits tax, much as earlier regulators calculated fair market value for railroad tariffs and other monopoly services. At least, this is what they were supposed to do. Investment bankers put free lunch rent rights at the top of their wish list of assets to be privatized, untaxed and deregulated, precisely because these are cash cows, much like lotteries and other public revenue streams. A debt-ridden, regressively taxed economy in which fortunes are based on rent extraction, and by financial claims on the nation for interest, amortization, and fees, is higher cost than an equity economy basing its tax system on land rent, natural resource rent and regulating monopoly pricing. If such rentier income is unearned and hence unfair, then so are the fortunes and hereditary estates built up from such income. Fortunately, rent takings are reversible. A rent tax can recapture what privatizers and kleptocrats have taken. At issue in today's new enclosure movement to privatize economic rent are two visions of capitalism, financial versus industrial. A bubble economy's mode of creating wealth by 1. Debt leveraging and 2. Taxing labor and consumers rather than economic rent has made America a high-cost economy. To be sure, if governments collect the land rent, many existing property owners will default on their payments to the banks, or will feel obliged to walk away from their property. When banks do not receive what they had set their eyes on, many will see their reserves wiped out even more dramatically than occurred 2008. An abrupt shift to taxing rents or other revenue already pledged to banks will decimate their stockholders and bondholders. Taxing rent thus will require a public takeover of such troubled banks. The financial sector has forced society to make a choice, either submit to turning the economy into a rentier-ridden Ponzi scheme, or subordinate the banking and tax system to the aim of financing growth. That is why reform must be across the board, not piecemeal. It is hard to see how economic rent can be fully taxed without a public option for banking, because the rent to be taxed already has been earmarked to pay interest. Something must give. Being taken into the public domain is the price that banks pay for overlending to the point where interest charges often absorb the entire economic rent and crowd out the tax collector, while forcing indebted owners to default. Under these conditions, turning insolvent banks into public institutions is the easiest alternative to financial austerity and anarchy. 3. Revoke the tax deductibility of interest. Interest is not a cost of doing business when it is paid to transfer ownership rights to existing properties or enterprises. Debt taken on simply to buy assets is pure overhead, adding to the cost of doing business. Making interest payments on such transactions tax deductible enables the 1% to take more from industry, real estate, and commerce. This perverse incentive enables industrial firms to be rated by financial tactics to pay out more to bondholders than they can to stockholders, by paying income that otherwise would be declared as taxable profit. This encourages debt leveraging rather than equity investment, especially for leveraged buyouts that add interest charges to the cost of doing business. Tax deductibility for interest also adds to the cost of living, to the extent that it shifts the tax burden onto wage income and consumer sales. Yet politicians end up giving tax advantages to creditors because the financial sector has become their main constituency of campaign contributors. Just as in the case of leaving economic rent untaxed, untaxing interest payments leaves more after-tax real estate rent and corporate cash flow free to be capitalized into larger loans that raise asset prices for new buyers on credit. The untaxed interest ends up being paid to bankers and bondholders. This transformation of rents and tax cuts into interest, creating capital gains in the process, throws Wall Street's backing behind an anti-growth tax policy whose main product is debt. The convoluted rewriting and watering down of Dodd-Frank bank legislation has shown how bank lobbyists are able to stall reforms and water them down by inserting fatal loopholes. Wall Street's sway over lawmaking and courts, its capture of oversight agencies and political control over campaign financing forces economies to take radical steps to save themselves from austerity and debt peonage. And radical steps, by their nature, must be abrupt. To be effective, systemic reform must be done quickly and totally, not slowly and marginally. 4. Create a public banking option. Chapter 7 has shown that banking was on its way to becoming a public utility in the years leading up to World War I. A public option survives in the post office banks of Japan and Russia. By providing deposit and checking accounts, loans, and credit cards at rates reflecting the actual cost of such services, or even at subsidized rates instead of today's interest charges, fees, and penalties, a public option could free the economy from the monopoly rent now enjoyed by banks. Most important, public banking would have been unlikely to extend credit for the corporate takeovers, asset stripping and debt leveraging that characterizes today's financial system. There are 3 main arguments for establishing a public bank to provide basic checking, savings and credit card services. The most obvious reason is to offer these services at minimum cost. A public option is free from exorbitant salaries and stock options, management fees, and other financialization tactics, not to mention political lobbying and fines for the now chronic misbehavior of the largest banks. A second reason for creating a public bank is the ability of Wall Street lobbyists to undermine administration of Sarbanes-Oxley, Dodd-Frank and the Volcker Too Big to Fail, TBTF, rule, and to block the appointment of Justice Department or Securities and Exchange Commission officials who actually believe in enforcing regulations. As long as both leading political parties view throwing financial criminals in jail as the road to serfdom, the only way to prevent reckless bank exploitation is to set up public banks dedicated to providing basic vanilla services. The third reason for creating a public option for banking is to separate retail banking from the investment banking that is becoming almost indistinguishable from casino trading in arbitrage and derivatives. The failure of existing legislation to restore Glass-Steagall's separation of these two quite different forms of banking, coupled with the inability of Congress to protect the economy from the financial sector, has produced a situation where megabanks can hold the government hostage for bailouts when the exponential growth of financial claims bursts into a repeat of the 2008 solvency crisis. Finally, it is easier for governments to cancel debts owed to themselves than to annul those owed to private creditors. Before credit became privatized, Mesopotamian kings and Egyptian pharaohs cancelled debts owed to the palace so as to avoid widespread bondage and emigration, the fate confronting today's debt-strapped countries. 5. Fund government deficits by central banks, not by taxes. Money always has been a public creation. The paper money in our pocket is a form of government debt. The government created it as a kind of IOU when it paid for goods and services. That is how governments supply economies with money. The holders of such currency in turn are in the position of being creditors to the rest of the economy and pay with this credit, which is given value by the government accepting as payment for taxes. This is the essence of modern monetary theory, MMT, explained best by the followers of Hyman Minsky at the University of Missouri, Kansas City, Randy Ray and Steve Keen. The public debt, including the money supply, would not exist if the government did not run up debts century after century, just like other countries. The deficit is what creates the economy's monetary base, which rises each year in proportion to the increase in public debt. Unlike personal debts, public debts are not expected to be repaid. To do so would extinguish the money supply. That is what happened in the late 19th century in the United States, and it imposed a serious deflation, the cross of gold that was crucifying debtors, who earned less and less income to pay debts taken on at higher prices. The role of central banks is to create money electronically to spend into the economy to spur economic growth without entailing interest-bearing debt owed to commercial banks and bondholders. That is why financial elites oppose central bank financing of deficits. Bondholders prefer to keep governments on a taut financial leash, with central banks creating money only to bail out banks, not the economy. Bankers accuse governments of depreciating the currency and creating hyperinflation, yet over the past 30 years banks have financed the largest inflation of real estate, stock, and bond prices in history. This certainly is not a more morally responsible form of inflation than government spending. Central banks were founded to finance deficit spending. But in recent decades the financial sector has turned them into appendages of the privatized banking system. At the Federal Reserve, helicopter Ben Bernanke and his successor Janet Yellen airdropped money only over Wall Street, a net $4 trillion of electronic credit to U.S. banks since the 2008 crisis. This quantitative easing did not finance investment in new industrial capital, repair deteriorating bridges, roads, and other infrastructure, or maintain employment. Its aim was simply to prop up bank balance sheets by supporting prices for real estate mortgages, that is, to save banks, not the economy. Reinflating asset prices makes it more expensive for families to buy homes, reducing their purchasing power for goods and services. Wall Street has mounted a propaganda campaign to convince voters that government budgets should be run like household budgets, in balance or even surplus. The difference is that households cannot create money. Removing the constraint of silver or gold backing for money has enabled banks to create credit without limit, except for government regulation and capital reserve requirements. Disabling public regulatory power has left credit creation to the commercial banks, which inflate asset prices on credit, adding interest charges to the economy's ownership structure. Asset price inflation became the focus of bank lending and seemed to justify yet more bank lending and became an economy-wide Ponzi scheme. There is an alternative. The Eurozone could have created a few €1 trillion platinum coins to finance deficit spending directly into the economy to help pull it out of austerity. It could have let the superstructure of bank derivatives collapse, wiping out financial gambles that put the banking system at risk. But bank lobbyists and right-wing ideologues have propagandized a narrow tunnel vision to prevent the United States from creating money for other reasons than to benefit Wall Street, and to prevent the European Union from having a real central bank to finance government deficits, except to help bankers and bondholders. The pretense is that money is technocratic and requires professional, defined as suitably tunnel-visioned, anti-government ideologues. Ottawa. Economics professor Mario Seccaruccia recently summarized how radical this anti-democratic view of money is. Ever since the establishment of the modern nation-state in the late 18th and 19th centuries, the creation of the euro was perhaps the first significant experiment in modern times in which there was an attempt to separate money from the state, that is, to denationalize currency, as some right-wing ideologues and founders of modern neoliberalism, such as Friedrich von Hayek, had defended. The denationalization or supranationalization of money with the establishment that happened in the Eurozone took away from elected national governments the capacity to meaningfully manage their economies. Unless governments in the Eurozone are able to renegotiate a significant control and access money from their own central banks, the system will be continually plagued with crisis and will probably collapse in the longer term. To make matters worse, the hands of central banks in Europe and the United States are tied by the impression, sponsored by financial lobbyists, that governments should not run deficits but maintain surpluses that drain the economy's circular flow and oblige it to rely on commercial banks and bondholders. Instead of public credit financing economic growth, bank debt is monetized in ways that benefit creditors at the expense of their host economies. The Citigroup and AIG bailouts were financed with a stroke of the pen. Social Security, Medicare, and other social spending likewise can be financed by the central bank creating money, just as it has created money to bail out Wall Street. Even worse, FICA wage withholding pays for these programs in advance, lending this forced saving to the U.S. Treasury so that taxes can be slashed further for the highest wealth brackets. The essence of modern monetary theory is that governments can finance deficit spending electronically on its own computer keyboards just as commercial banks do. The difference between public money creation and bank credit is that the public purpose is to promote economic growth, not asset price inflation. National prosperity requires spending money into the economy, for instance, for new capital infrastructure investment, health care, and retirement pensions. Budget surpluses would oblige such spending to be privately financed, which means much higher prices for their services. 6. Pay Social Security and Medicare out of the general budget. In 1983, the Commission on Social Security Reform, chaired by Alan Greenspan, recommended that instead of treating Social Security and Medicare as public programs funded out of the overall budget, they should be privatized into a savings program paid for mainly by the least affluent members of society, by steadily raising the FICA payroll tax. These wage withholding taxes are now over 15%, including the employer's 6.2% share of Social Security levies. They do not fall on high-income earners. This regressive tax shift away the higher income brackets functions as a fiscal class war. It has cost wage earners hundreds of billions of dollars. The government has raised user fee taxes on wage earners up to a low cutoff point, freeing earners of more than $120,000 from having to contribute. No such user fees are imposed on banks for their $4 trillion in Federal Reserve quantitative easing credit, the $800 billion TARP bailout, and other subsidies. Any politician who fails to explain that it is regressive income taxation to subsidize the 1% in this way but not Social Security can be assumed to be in Wall Street's pocket or the proverbial useful idiot. The effect of self-funding social spending is to impose austerity on the 99%, freeing the 1% from fiscal responsibility. 7. Keep natural monopolies in the public domain to prevent rent extraction. Financial lobbyists condemn public spending as deadweight, even for roads, the post office, and other basic infrastructure. They claim that privatization will provide these services at lower prices than government can match. Yet all the evidence points to the contrary. This is largely because in today's world, privatization involves financialization, adding charges for interest, dividends, and exorbitant salaries to managers to the break-even prices that must be charged, not to mention using profits or rents for stock buybacks to create capital gains for managers and owners. Over and above these costs, privatizers charge as high a price as the market will bear. This margin is monopoly rent. It was to prevent this price gouging that vital infrastructure traditionally was kept in the public domain. Since antiquity, roads and transportation, canals and civic buildings have been so expensive that private ownership would have exacerbated wealth inequality and created monopolistic elites. Even medieval serfs at least had access rights to the commons to help provide for their livelihood. Monopolies were privatized more in the United States than in Europe during the Progressive Era, so U.S. techniques of price regulation for electric utilities and railroads was more developed than elsewhere. Price gouging was analyzed as an excess of market price over carefully defined intrinsic and necessary cost value. But Europe kept basic infrastructure in the public domain, so there was less of a regulatory tradition for the sectors privatized after 1980. And no such tradition existed when the Soviet Union's republics became independent in 1991. Their rent-extracting grabitization was more extreme than anywhere else in the world. Today's new enclosure movement is privatizing public infrastructure. These giveaways of the modern-day commons are attracting new buyers, who borrow to buy these monopoly privileges and pay banks interest out of the prices they charge. Privatization provides banks with a loan market capitalizing rent extraction rights into bonds, stocks, and bank loans. The Thatcher-Blair model for public/private partnerships typifies this giveaway of public assets. Chicago's financialization of its sidewalk parking meters is a notorious U.S. example. This underwriting gave banks a strong motive to drive government out of the business of providing public services or of regulating and taxing rent-yielding enterprises. Short of deprivatizing, that is, renationalizing, land, natural resources, and monopolies to the public domain, the remedy is a rent tax, backed by a tax on excess profits and unexplained enrichment. 8. Tax capital gains at the same progressive rates as earned income. Some 80% of capital gains are in real estate, reflecting its dominant size in the economy. As in the stock and bond markets, most such gains do not reflect tangible capital investment, but result mainly from banks lending more as they loosen credit standards, e.g., for junk mortgage lending in 2001-08. Real estate prices rise when central banks lower the interest rate at which profits and rents are capitalized into bank loans. The freer the lunch, the more pressure is brought on governments to make rentier gains even larger, by taxing them even less. Real estate gains are not taxed if they are reinvested in new property, or if nominal ownership is located in tax havens, or when owners die. Wall Street traders enjoy a similar loophole that taxes their financial winnings at a low capital gains rate. The remedy is to tax asset price gains at least as high as the maximum income tax rate. Otherwise, the economy will favor such gains over those from tangible investment. 9. Deter irresponsible lending with a fraudulent conveyance or odious debt rule. The most obvious way to deter overlending would be to make lenders bear the cost of loans gone bad. Loans made without a reasonable analysis to ascertain that they can be repaid in the normal course of business would be deemed to have been made fraudulently. Companies defending themselves against raiders in the 1980s cited the fraudulent conveyance principle to claim that the junk bonds and bank loans financing the buyouts could only be paid by carving up the company, downgrading its pension plan, or closing down its long-term investment. For public debt, the guiding principle should be that bondholders should lose if the only way they can be paid is by imposing austerity, unemployment, and forced emigration or sell-offing the public domain. No nation should be compelled to pay creditors before meeting its own economic survival needs. As Greece's debt negotiations were coming to a head, the Parliamentary Debt Truth Committee stated the problem on June 17, 2015, people's dignity is worth more than illegal, illegitimate, odious, and unsustainable debt. The demands by the Troika were found to be aimed exclusively at shifting private debt onto the public sector. The report describes how this asset stripping combined with demands for austerity was the legacy of the Troika's bailout of Greece that only helped private bondholders, not the Greek economy. All the evidence we present in this report shows that Greece not only does not have the ability to pay this debt, but also should not pay this debt, first and foremost because the debt emerging from the Troika's arrangements is a direct infringement on the fundamental human rights of the residents of Greece. Hence, we came to the conclusion that Greece should not pay this debt because it is illegal, illegitimate, and odious. At issue is whether society will save indebted economies or their creditors. Bankers cry havoc at the thought of annulling debts that cannot be paid, as if the thought is unthinkable. But it is less radical than turning economies into the debt-ridden wasteland that was inflicted upon Greece. From a historical point of view, it is more radical to let debt deflation deepen austerity while banks foreclose on property than for governments to protect debtors, whose ranks constitute the vast majority of the population and businesses. Realism and maintenance of viable markets requires recognition that in the end, most debts cannot be paid. At present we are living in a financial interregnum. If the debt build-up continues, the economy cannot avoid an exponentially deepening debt crisis as it follows an exponential Ponzi scheme vector. Banks and bondholders will continue as long as they can, until real reforms are made and rules are set to define the conditions under which debts should be cancelled when they become disruptive on an economy-wide scale. 10. Revive classical value and price theory, with special emphasis on debt as Chapter 3 has described. François Quesnay developed national income accounting to trace how much rent was taken and what landlords did with it. The subsequent value and price theory of Adam Smith and Ricardo served to isolate economic rent, enabling John Stuart Mill and other Ricardian socialists to demonstrate that taxing rent recaptures for society the natural resource patrimony and rising site value. This rental valuation is created not by landlord efforts but by society's overall prosperity and public investment in transportation systems, schools, and other infrastructure that define location, and location. The fight to recover land and natural resource rents for public use, along with making natural monopolies public, including banking, was waged in nearly every industrial nation in the decades leading up to World War I. Taxing rent aimed to lower taxes on consumers and industry, while public infrastructure lowered the prices of key economic needs. The past century has reversed matters, by privatizing the land's site value, mineral rents and basic infrastructure rents, to be paid mainly to banks as interest. Seeking to erase memory of classical rent theory, today's financial power grab pretends that Adam Smith and his followers sought to free such rent-seeking from taxation and regulation, not free economies from rentier elites. Failure to create a more progressive tax system reflects the inability of 19th-century free market doctrine to achieve the political and lawmaking power needed to liberate economies from the vestiges of feudalism. 1. Landlordism stemming from the military conquest of Europe and the regions it colonized. 2. Banking in private hands with creditor-oriented laws. And 3. Monopolies created by public fiat and sold to pay royal war debts or, more recently, deficits from cutting taxes on rentiers and the rest of the 1%. How to manage a debt write-down. Whereas the fight of the 19th century was to nationalize land, natural resources, and monopolies, today's fight is to socialize banking and finance. By becoming the ultimate rent recipients, banks and bondholders have emerged as the major defenders of rent-seeking. Having made collateralized rent-extracting privileges the basis of our credit system, mortgage debts and those of oil and privatized monopolies, banks can argue that reviving the classical program of taxing economic rents will bring down the financial system, turning these rents into interest and backing the economy's savings. These savings are highly concentrated in the hands of the 1%, to be sure. But the symbiosis between banking, real estate, and monopolies has enabled these rentiers to depict their interests as being those of labor and industry if one leaves out of account the concepts of economic rent and unearned income and its fictive wealth. The reforms cited above cannot be achieved as long as the debt overhead remains. Even with current rent extraction in place, spurring recovery requires freeing businesses and families from the debt burden. History shows how excessive rent extraction and not forgiving debts reduce economies to debt servitude and collapse. But it also reveals that there always has been a wide range of alternatives to reverse the spread of indebtedness. If clean slates seem so radical as to be nearly unthinkable today, it is mainly because rentier ideology has suppressed awareness of most of civilization's customary proclamations spanning 3,000 years, from Mesopotamia and Egypt to Athens, Sparta and Judea. Proclaiming clean slates to restore economic balance, annulling the accumulation of debts when they grew beyond the ability to be paid, kept pre-Roman civilization financially stable. Mosaic law placed this principle at the core of Jewish religion, Leviticus 25. Yet modern Christianity all but ignores the fact that in Jesus's first sermon, Luke 4, he unrolled the scroll of Isaiah and announced his mission to proclaim the year of the Lord, as the Jubilee year was known. Restoring the Jubilee year became the basis for early Christians to break away from Rabbi Hillel, whose prospole clause was used by creditors to force debtors to waive their rights to a clean slate. Jesus's position, reflected also in the Dead Sea Scrolls of the Essenes, prompted the wealthy establishment to fight so strongly against him. By this time it was too late to win the fight against Rome and its increasingly violent creditor class that ended up bequeathing a pro-creditor post-Roman law to Western civilization. It should not be surprising that the lesson of financial history is that debts that can't be paid won't be. The great policy question of our time is how not to pay them. Will nations permit creditors to foreclose and take the public and private assets into their hands, holding populations in bondage? Or will they declare a clean slate and start again? Something must give, either finance capitalism or the post-rentier industrial capitalism that seemed to be evolving towards socialism a century ago. Merely marginal reforms cannot save a badly warped economy. So much of the economy's land rent, natural resource rent, monopoly rent, industrial profits, personal income, and central bank money creation has been attached to pay bankers and bondholders that the only means of reform is a thoroughgoing clean slate. At the end of today's dynamic of interest-bearing debt and its dysfunctional financial and tax system is an economic dark age and privatization of the commons. When rentiers insist that there is no alternative, they mean that they have attached and interwoven their debt and property claims so tightly throughout the economy that any systemic alternative threatens chaos in the short run. Their aim is to limit any reforms to merely marginal scope, leaving the present financial and rent-extracting system in place. Banks and bondholders hate classical political economy because its logical conclusion was what was called socialism, before today's socialist parties changed the meaning to endorse neoliberal austerity. Marx became the bête noire of vested rentier interests because he showed how the dynamics of industrial capitalism were radical in striving to subordinate the landed, financial and monopoly interests that survived from feudalism. This required a strong enough government to cope with the rentier interests and break their post-feudal stranglehold. Instead of that future materializing, a financial counter-revolution strives to convince voters that a government strong enough to regulate and tax finance, insurance, and real estate, fire, is the road to serfdom. That is the parasite's strategy to numb the host's brain so that it doesn't realize that the free luncher is draining the host's growth for itself. There are a number of ways to cut the fortunes of the 1% back to what used to be deemed normal. Many such policies were suggested in the wake of the 2008 crisis. They involve scaling back debts to market prices in the context of the ability to pay out of current incomes. For the vast category of owner-occupied homes, for example, one way is to assess the market rental value for overmortgaged properties and make this the monthly payment capitalized into a self-amortizing 30-year mortgage. The bank, and more to the point, its bondholders and uninsured counterparties, would absorb the loss, having overlent against the property's value. Another solution would be to get an honest appraisal of the property's market price and write down the debt to this level, which was supposed to be what banks lent in the first place. A third approach would be to calculate the occupant's actual income, not the liar's loan figure filled in by the bank's mortgage broker, and set the mortgage payment at a specified portion, e.g. the once traditional 25%. Congress established write-downs along such lines as a condition of TARP in October 2008. But as Chapter 11 has described, incoming President Obama's choice was to leave these debts in place. In 1931, the world economy recognized a need for a clean slate by declaring a moratorium on the dead hand of intergovernmental debts stemming from World War I. A similar act is needed today for today's sovereign debts in the Eurozone and indeed throughout much of the global economy. The model remains that of Germany's economic miracle. In 1948, the Allies enacted their currency reform, cancelling all debts except for the wage obligations that businesses owed to their employees, plus modest personal and business savings and checking deposits up to a specified amount for basic transactions. The German economy was made essentially debt-free. That was the miracle, and what made its free market economy viable, a debt-free market. It was politically easy for the Allies to cancel German debts because nearly all were owed to former Nazi supporters. But today's banks and bondholders hold the reins of government, their treasuries, central banks, the IMF, and ECB. These creditor interests instinctively put their own gains above the aim of economic recovery, to a point that ends up being self-defeating, bringing down the whole financial superstructure. What if the debts are not cancelled? One way or another, today's debts will not be paid. They are too large to be paid off without further impoverishing economies and leading to further waves of default. But in the interim, until the hopelessness is recognized, a steady stream of foreclosures and privatizations will polarize economies between creditors and debtors. Sooner or later, economies will recognize that they must choose between becoming an increasingly polarized financial oligarchy or making a fresh start by clearing away the residue of overlending and financial malstructuring. The political problem blocking debt write-downs is that one party's debts, mainly those of the 99%, are another's savings, especially those of the 1%. It is not possible to annul debts on the liabilities side of the balance sheet without wiping out savings on the asset side. As long as savings, mainly by the 1%, takes the form of debt claims on the rest of society, they will grow exponentially to hold the 99% in deepening debt thrall, monopolizing the surplus in a way that shrinks the economy. The present course is for governments to support the financial sector, not bring debts within the ability to pay. The one-sided U.S. support for creditors since 2008 has averted a debt write-down. Early in 2013, the Fed announced that it would buy $40 billion of mortgage-backed securities each month, almost $500 billion over the course of a year, while the government's housing agencies guaranteed some 90% of the securitized mortgage packages being written. Financial Times columnist Gillian Tett described this government activism as a travesty of a free market. Banks stopped writing new mortgages unless the government took all the risk, as also is the case with student loans, by guaranteeing payment out of the public purse in the event that homeowners cannot afford to carry the debt revival. Observing that state support like this is unprecedented anywhere in the Western world, Tett cited former Treasury Secretary Paulson's warning, "Today the government is guaranteeing 90% of the mortgages. If the government keeps doing this, and markets aren't allowed to work, we'll be right back where we were in 2007 and 2008. Today's government intervention is not socialism. The appropriate word is oligarchy." Debt protests from Iceland to Greece and Spain are rejecting bondholder demands for austerity and privatization sell-offs, voting pro-creditor regimes out of office, and demanding referendums over whether to pay financial tribute to creditors. That is why creditors are shifting their support away from democracies to insist that their designated technocrat lobbyists be assigned control of economic policy. Bondholders see rising pressure for debt write-downs as an assault on their idea of free markets. But their idea of freedom connotes debt serfdom for the population at large. Their travesty of the classical idea of rent-free markets poses the implicit question: if governments are to intervene to enforce creditor claims and bail out banks while imposing austerity, why not act instead on the side of the indebted majority? Why not choose growth rather than shrinkage ending in bankruptcy? The costs are much less, because financial recklessness would be avoided. Unthinkable as a broad debt cancellation may seem, once we recognize that it is impossible to pay today's volume of debt, at least without tearing society apart and imposing financial neo-feudalism, what remains practical is that the debts won't be paid. There ultimately is no revenue to pay. If we acknowledge this fact, then as Sherlock Holmes remarked in The Beryl Coronet, it is an old maxim of mine that when you have excluded the impossible, whatever remains, however improbable, must be the truth. The truth is that today's debt overhead can't be paid. Today's political fight concerns just how they won't be paid. If government debts to foreign creditors are paid by forced privatization sell-offs, the former public domain and infrastructure will be turned into rent extraction toll booth opportunities and economies will be impoverished by rentier austerity.